crude is very volatile. In a day, it has crashed by nearly, say, 9-10%. Now, if the crude prices remain anywhere between the band of, say, less than 70 or, say, maybe up to 60 to 70 band, I think that is very favorable for OMCs because their profitability, working capital, all the things get a boost. And conversely, it is to some extent negative for the companies like your ONGC, your Oil India, etc. So to that extent, I think there could be some sort of trading uptick in oil marketing companies today. However, in the longer term, I think these are very, very volatile companies. One will have to wait and see where actually the crude oil stabilizes. But based on the current day's move where the oil prices have crashed, I think it remains to be quite a likely to be quite a good day for oil marketing companies.
Okay, oil marketing companies, got that. By the way, I'm just looking at a note that CLSA has put out on Nykaa. They've initiated coverage with an outperform rating. Target is 229. We'll just get the Nykaa stock up for you. Did well in trade yesterday as well. Yeah, it was up 3.5%. 203 is where it is, and CLSA feels it can get to 229. They're talking about the rapid growth in the beauty market. And they see as the underperformance phase for Nykaa perhaps ending. That's a CLSA view. Amnish, the reason I picked this particular note out was because there's a lot of interest in consumer stocks again in the market. How to play the rise in discretionary spends, the fact that there's an income tax cut, etc. So suddenly everyone's talking consumer. I don't know if you like Nykaa, if not this. Give us some thoughts here.
Look at in various baskets, even when we were talking about that there is some slowdown in consumption, the discretionary consumption was doing well. So there was absolutely, you can say no doubts about that. So for example, you look at travel, you look at your aviation, some segments in discretionary, particularly on the premium side, they were all doing well because the middle and upper middle class, they continue to do well even during that phase. Now, coming back to, you can say the benefit of tax cuts, yes, it will be there. Now, there could be a very wide basket of products which it could impact. It could impact real estate. It could impact, say, your auto, particularly, I would say, two-wheelers. It could impact some discretionary spending in apparel. It could impact something like your, for example, beauty products. So it could be far and wide impact of that. However, having said that, the problem in the industry today, in addition to, you can say, little bit of growth, is the competitive intensity. Because due to these platforms, lot of these companies today, they are going through an hyper-competitive phase. So that is why I think it has to be a very, very stock-specific call. And even if the consumption demand scenario doesn't look bad, one should not expect any big bubble to happen in such stocks. You will make money, but one should expect maybe you can say double-digit, 10-12% kind of a return, and not something like 25-30 one should expect from these.
All right. Amnish, stay with us. What we're going to do is take a quick commercial break here. Up next, some technical trading ideas. Sudarshan Sukhani and Mitesh Thakkar are going to be with us with exactly that coming up. Okay, welcome back. 9 minutes to go for the pre-open session to kick off. Sudarshan Sukhani and Mitesh Thakkar are with us with what they'd want you to do as far as the new trading session is concerned. New morning and new headlines and I guess a much better picture overall. I mean, if you are bullish, what's your sense, gentlemen? Mitesh, you go first. How is the GIFT Nifty, of course, is indicating a flourish of an opening. But if you get a gap up, that's the question then. Realistically, how do you put in trades?
So, Prashant, I think it will be a gap up and it will be a big gap up, about 200, 250 points kind of a gap. Now, I think that will also mean that we open around the highs which we made on the 11th of June, which is around 25,220. So I think that's where, I would want to take some profits, but I suspect that this gap up could have followed through. So if we see the markets and indices get past 22,250, maybe then you would want to take a 80-90 point kind of a stop and look at a long position with targets of 22,500 plus.
All right. Good morning, gentlemen. Sudarshan, what about you?
Yeah, good morning. Well, yesterday I had explained why we must go long at every dip, and yesterday was a dip. I'm referring to that only because today is a big gap up, and today is the time when if you have any long positions taken yesterday, this is a very good time to take profits. This doesn't mean the gap up will not sustain, but the chances are after a 200 or 250 point up, a gap up, markets will consolidate and they will also have minor corrections. So perhaps today you can step aside, wait for, if you get a 150, 200 point correction from the opening, and that is possible during the day when a sharp sort of decline and panic can set in, then re-enter and buy. If you don't have a position, buy only on a 200 point dip, otherwise avoid the gap up.
Got that. Sudarshan, let's get through trades specifically in terms of stocks. What's on your radar?
Well, Hindalco is a buy with a stop under 648. Coromandel is a buy. It's coming again in my list with a stop under 2267. Nykaa, which has come the first time, I think, is a buying opportunity with a stop under 200. This is only a swing trade. Keep it for just a few days. And ICICI GI, General Insurance, is a buy with a stop under 1937.
Mitesh, what about you?
So I have a buy on Hindalco as well. That's a common stock. Looking at targets of 685 and a stop around or below 650. Polycab is a buy with a stop at 6150 for targets of 6450. Kotak Bank is a buy. Keep a stop below 2166. Look for targets of 2230. And the final buy call is Escorts. Keep a stop at 3280. Look for targets of 3450.
All right. We'll take a quick commercial break here, gentlemen. Thanks very much for those trading ideas. More later. We'll come back with a pre-open session. We'll also have Sandeep Agarwal of Sovilo Investment Managers to discuss, the implications of Accenture's earnings. Stocks, IT stocks yesterday were a little lower. Coming up in just a bit.
Welcome back. This is Open Exchange. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. We're still in conversation with Abneesh Agarwal. Abneesh, I wanted to ask you about VIP. You know, the various reports that are indicating that there could possibly be a deal where PE firms take over from Mr. Piramal. I think as a house, you all were reasonably optimistic on prospects, and I think you all were one of the lone voices that was optimistic on the prospects. What's your view? A stock that was sub 300 rupees is closer to 430 rupees right now. All the good news in the price, even if there is a deal?
Okay, actually, one has to look at that the VIP stock corrected from 650, 700 rupees because the company was not doing well. There was too much inventory in the system, which I think over the past 5-6 quarters, they have not brought it down to very reasonable levels. So that is one part of it. And operationally also, inventory went down, warehousing cost went down, and the things should start improving. Now, the second aspect is that the travel is doing well. This time around, 1Q, we have got 1Q and 2Q good marriage season in comparison to what it was not. So to that extent, I think fundamentally it might be closer to the, you can say, bottom. At around, say, sub 300 rupees, the stock had actually declined a bit too much, and it was always in the news that there could be some change in the management, some PE player, or some other domestic player might come in. So I think if you look at the acquisition, you can say possibility, then there might be still some room left in this stock because the fundamentally things have bottomed out. And usually when the acquisitions happen, because the stock has actually come up by around 15% from the bottom, I think you can see that there could be still some juice, but whether it will be the kind we have seen in the last 2-3 months, kind of that or lower, that is something which we'll have to wait and watch.
Amnish, one is, of course, Z. I don't know if you have a view, was up 10% yesterday, was limit up. And the other is these smaller defense stocks had a field day yesterday. I mean, they've had a field day for a while. Garden Reach, Paras, Zentech, Idea Ford, some of them were up 10% a piece. Any thoughts?
See, as far as Z is concerned, as we talked last week also, that the promoter stake in Z is very low and now they are intending to increase the stake. Now, I think in the latest, you can say the investor communication, which they have indicated is that the losses of Z5 will come down significantly from plus 500 crores. So I think that is very meaningful because for a company like Z, so that effectively means that 2 to 3 rupees addition to EPS straight away if they are able to eliminate those losses. But how will they do it remains to be a very challenging and difficult task because today, I think we are gradually and slowly moving towards, you can say, OTT world. And OTT, you have got, you can say, Jio Hotstar is there, then you are having Netflix is there, Prime Video is there. The competition there is intense. And I think Z is very strong as far as your broadcasting is concerned, but you have to be equally strong in OTT if you want to have a very long-term view, say 5 years, 7 years down the line, where majority of consumption of the content might shift on the OTT platform. So I think because the stock had been butchered, it was lying low. I think it is bouncing back. Now, to what extent it will go, we will have to wait and watch, depending upon, you can say, how the things play out for this particular name. And regarding the defense stock, I think defense as an industry is coming up. You can say, when the demand for the larger defense equipment goes up, then all the ancillary suppliers will also gain to that extent. So I think going by what is happening around the globe, in terms of wars, in terms of repositioning, I think defense stocks will continue to be in the limelight for some more time.
Look at the rupee open, 86.11 compared to 86.75. So that's a big move, rupee strengthening against the dollar this morning as the dollar itself takes a bit of a dive lower. Nothing large, but of course, I mean, here, I think the rupee is especially sensitive because we are such a big oil importer. I mean, the worst case was that there's some disruption with regards to that. So that has not come through. That's not happened. And I think you're seeing a bit of a relief move as far as the rupee against the dollar is concerned. A full 60-65 paise move on the dollar rupee this morning.
That's the rupee, but the equity market pre-open, at least from what we have right now, it's only 1-2 minutes. It's up, but it's not the big surge that the implied open was indicating. The implied open was indicating almost 300 points higher. Right now, the Nifty seems to be a little more measured, just about a 0.5% increase coming through. Some of the oil marketing companies that Nigel was pointing out, they're doing really well in the pre-open session, 4 to 5% up on many of these stocks like IOC, BPCL and HPCL. Amnish, thanks very much for all your thoughts and the context this morning. You have a good day. But with that, we'll move on now and put the spotlight on the IT space. Accenture, remember, came out with numbers just yesterday, and the company was citing significantly elevated level of uncertainty despite reporting what was a good third quarter set. To discuss what the implications are for Indian IT, we have with us Sandeep Agarwal, fund manager at Solio Investment Managers. Sandeep, great to have you on. Thank you so much. That's the question. Accenture reported a good Q3, but they're sounding very cautious, and some are arguing their bookings have been soft for the future. What's the read-through for us?
Hey, hi, good morning, and thanks for having me on the show. So, if you see the Accenture numbers, I think the numbers were quite good, and also, they have upgraded the guidance, but it was a technical upgrade in the guidance because it was Q4. But I think the problem is that they have made a comment on the call which says that CY25 is uncertain. So now CY25 remaining uncertain means that next year guidance will also be muted. And secondly, if you see the whole story around Indian IT for last 3-4 months since they have started performing was that H2 will be better than H1, which technically is very difficult because you have a lot of furloughs in the manufacturing side in December, and then you have less number of working days in February. But still people were hopeful. Now with this, it also implies that for us also even H2 may not recover at all. And secondly, the stocks have run up quite a bit in last 2-3 months massively. Some of them have gone very, very high. And also, the biggest worry is that for the first time in last several quarters, we have seen a significant, weakness in the outsourcing book, which has never been the case in case of Accenture because they were always doing extremely well on the outsourcing side, and on the consulting they were a little weak. So all these things seems to have one consensus call, which is there that Indian IT companies management cannot give a bullish or a certain guidance when they come out with result on this backdrop. So that is the reading I have.
Slightly out of the box question, Sandeep, since we talk about stocks near term, we will, right? In terms of what you like, etc. Can one of the larger IT companies, really pivot in some way, in a big way? Which kind of, is from an investor perspective, good, but of course, for them, in terms of latching on to better growth areas instead of doing what they've always been doing, or you think it's too hard? I'm talking about the larger ones. The smaller ones are nimbler, and we spoke with Latent View, for example, earlier. They're talking about moving from systems integration to AI integration kind of work. But what about the larger ones, Sandeep? Possible?
The larger one, obviously, they are doing good amount of work, and they are investing, they are training people and all. But you have to remember the base of the new business, which we are talking about, will be very, very small even after 5 years. So whatever, even if you grow them at, let's say, 30-40%, the impact of that on the overall numbers is very muted. So if you recall, after 2021, many of the mid-cap companies and really mid-cap like Persistent, Coforge, LTTS, LTI, many of them, became 10x, 8x, and they became actually large cap if you don't do a relative comparison with the TCS. So, that happened because these companies' base were small and they were able to grow the new technology at a phenomenal pace. So I think this time also it will not be different. The smaller companies, because they have a small base, the new business which can grow in triple digit or maybe high single digit, all those businesses can really change their composition and the growth numbers in next 2-3 years. So I would say that, from that perspective, the smaller and mid-size ones have that chance, but also remember, in uncertain times, it can go either way. So it is very, very difficult to comment. And additionally, what I'm hearing on the channels that, there is and I personally believe also that risk is there that, rupee will start appreciating because of multiple factors, crude going down and all. And if that happens, then, the little bit of benefit which was there to absorb the wage hike cost and other costs for the Indian IT companies, that also goes away. So I will be really concerned about the EPS growth X of buybacks. That is what my view is.
Okay, so concerned about overall EPS growth from the IT sector, got that. Sandeep, the point that you made about some of the niche mid-cap IT players that have done so well, right? And they have beaten the large IT services companies hands down. But even there, it's become very differentiated. There are companies like Coforge that have continued to grow well, continued to guide very strong. And then there are companies like KPIT Tech. This morning, we've woken up to yet another I won't call it a profit warning, but basically it's a mid-quarter warning of sorts. They're saying that ramp-ups are very slow, deal conversions are even slower than before. So I'm not able to understand if this is a company-specific issue or is this ER&D in general? Is it an auto segment issue? Just give us some more color on what's happening with mid-cap IT, where some of the yesteryear stars are now struggling.
So you're absolutely right. You have to remember this is more driven by the industry where you have exposure. So Coforge always had an advantage of having, good exposure to the travel industry, and they have benefited a lot after COVID because of that, because travel has consistently been going up and there have been mass scale implementation of, the softwares, the applications and everything in that space. So they have a big beneficiary of that. ER&D was doing phenomenally well till this, tensions started in Europe and some part of Middle East. And because of that, what has happened, the stocks of ER&D, which were insanely expensive, and at the same time, there is a disruption in the manufacturing side. So both have come together and they have disturbed this, and this profit warning and all, indirect, direct, whatever you are seeing, this is actually because of that. And I think that ER&D is actually a much better theme for long term than IT services. But the problem is that ER&D's peg ratios are much, much higher than the IT services peg ratio, although IT services peg ratio themselves are expensive. So, you have to play more industry specific games rather than, just, mid-size, small size or large cap. That will be really challenging to make money. So I would say you have to get the size correct, you have to get the technology correct, and then you have to get the segments correct. So it is a combination which you have to get right.
So I know you can't talk stocks, so just tell us, where are those pockets where you're getting this beautiful amalgamation of reasonable valuation? Segment seems to be providing some comfort and growth as well.
See, there are pockets in ER&D, very unknown kind of names which are doing decent, and you have to really, really do very, very lot of hard work and research to get them. And there's some pockets in IT services also where the services pieces are in Gen AI and digital, and the sizes are so small that this small percentage can make a big difference. As we run a PMS and we are bound not to disclose any names, but I can tell you that there are 2-3 names in AR&D, there are 2-3 names in the IT services. At least 4-5 names are there where you can still make a lot of money. But yes, in next 6 months they may also not make money because stocks have run up crazy. I am not very comfortable with the peg ratios which the industry is going through.
Okay, all right. Sandeep, thank you very much. Good speaking with you. Appreciate your time here on CNBC-TV18. I think we've come to the end of the pre-open session. Let's just look at the Nifty at the end of the pre-open. Is it, we look at it initially. So yeah, this is more like it. 200 points, not 100, 200 plus points on the Nifty, 25,000, just under 25,200 is where we are at. So you're going to open up at about that 25,222 level, which is the, first resistance at the upper end of the channel, which the market got to, and then from where it sort of corrected. So you're going to cover that distance right to the word go as the indication. Sudarshan and Mitesh are back with us with the 9-10 call. Sudarshan, what do you have?
Buy Coromandel with a stop under 2267.
Okay, and Mitesh?
Buy Escorts for a target of 3450.
Okay, all right. Gentlemen, Coromandel and Escorts are the two trades coming through from Sudarshan and Mitesh respectively. We'll focus on Nykaa and Page Industries now and what the street is saying. Mangalam is here with exactly that. Mangalam, morning.
Good morning. So two initiating coverages, one on something that makes you look good from the outside. The other one is the one that something makes you feel good from the inside. So we have CLSA initiating coverage on Nykaa. They have an outperform rating, 229 rupees share price target. And they say that the beauty market is rapidly evolving in India. And Nykaa is a clear leader, nearly $16.5 billion in gross merchandise value, has the potential to grow in high teens over the next 5 years. And the only fly in the ointment for them is the Nykaa fashion business, which they don't see as standing out in a crowded space. But they believe that so long as beauty is doing well, driving growth and profitability for them, the drag on fashion is absolutely okay and manageable. They expect the EBITDA margins for the company to expand by 310 basis points over the next 3 years. The only risk is slower than expected growth or faster than expected ramp up of competition. Page Industries, on the other hand, Goldman Sachs has initiated coverage. They have a buy rating target of 52,000 rupees. They say that industry levels for inventory seem to have normalized, so which means that over the next 3 years, they can grow their sales at a compounded average of close to 12.2%, and this is much higher than the last 5 years of around 8%. And apart from the innerwear segment, outerwear segment is likely to do well for them. Remember, that is a high value margin accretive product. And the management expects to add nearly 200 to 250 exclusive brand outlets. Exclusive brand outlets have a higher salience of outerwear products selling for them as well. So this is another driver for them. All these factors doing well for Page Industries. So both Nykaa and Page in focus today.
Okay, all right, Mangalam, thanks a lot for that. Well, let's hop across to Vinny. She's here to tell us about KPIT Technologies. Vinny?
Hi, so like we spoke earlier, KPIT Tech, that mid-quarter update that's coming from the company, not anything exciting there, right? Business environment they're seeing is weak. Deal pipelines and the conversion over there is much slower than expected. Demand in US and Asia is also not that great and a bit uncertain. In Europe, yes, it's good for the company. And ramp-ups, that is also at a slower pace is what they're seeing in terms of wins coming in there. Profitability could be a bit of a hit because there's not going to be any one-time gain. Other income could be lower as well this time. So that's a bit of a concern coming in here. Now, on the back of that, Kotak Institutional Equities is saying that they're giving a sell rating, target price of 1,000 rupees per share, and they've cut the EPS for FY26 to 28 by earnings growth actually by 3 to 4%. Now, JP Morgan too is saying that they've given a target price of 1,500 rupees per share, but now they believe that Q1 FY26 could see a decline coming in, and even the bounce back in Q2 could be slow, but that's something that they will watch out for. Before Q2 FY26 come in, Q1 will be a weak quarter. They've cut the organic growth by 4% for FY26 and also cut FY26 to FY28 CAGR growth from 16.5% to 14.5%. So some bit of a muted performance is what we're expecting from KPIT Tech in Q1.
Okay, all right, Vinny, thank you very much for that. So KPIT in focus. We're just about under a minute away from market open. And we look at, of course, the 200-point gap up, which perhaps we should get around just under the 25,200 level. And then we look at the other indices, stocks, of course. I mean, it's a very sort of oil-related look at stocks, I guess, right at the beginning. And then, of course, we'll look into other stuff as well. But thematically, oil marketing, oil producers, paint companies and the like, etc. I mean, we've seen a big decline on oil this over the last 12 hours or so. So what do we have coming up in just a bit from now? We've got the first rate starting to tick in, 25,170. Nifty Bank is up about 0.8% as well, I think. So just settling down there on the Nifty Bank. Yep, now you got a firm 0.8. So both are starting very, very strong. Small cap index is up even better, 1.2%. The mid cap index is up about 1% or so as well. So this is the overall picture on the indices which are starting up. Right out of the gates, I mean, it's everything up. Some 8 is to, not 8 actually, some 15 is to 1 kind of advances decline ratio. But this is just the first 30, 40 seconds that we're looking at. Heat map on your screen in a bit should give you a sense. I think it should be all up kind of a day. We'll just have a look at that. Okay, you've got 2 names down. One is the oil producer, the other is NTPC. But apart from that, 48 out of the 50 names starting the day in the green. And we are past that 25,222 level, which is the first resistance for the market. Let's see if you're able to hold on to these gains. Surabhi.
Yeah, it's an all-green kind of a day. Take a dart, throw it anywhere. It'll land on the green side of the board, that sort of a day. In terms of sectors, by the way, PSU banks are having a very good start. PSU banks and PSUs in general, UCO Bank, Aircon, Union Bank, lots and lots of those stocks on the upside. And of course, there are the PSU oil refiners, HPCL, IOC, and BPCL. Nigel was alerting us about them in the morning. And indeed, they're up between 3 and 4%. So PSU pack is looking good. On the Nifty, everything is up, but the biggest gains coming in for Adani Ports, 4.5% up on that stock. There's Shriram Finance, about 3% up. Geo Finance, Adani Enterprises also. There's Ultratech Cement, it's M&M, JSW Steel, I mean, you name it. It's just a long list of winners. IT is also fairly strong this morning. TCS, Wipro, these stocks are up between 1 to 1.5%. You've got Reliance up about 1%, SBI, HDFC Bank, ICICI Bank, all 1% gainers, so looking really good. The only stock that's down, obviously ONGC is not a surprise, down about 2%. NTPC is down 2.7%. We'll just look a little deeper into this and see if there's any particular reason. About 3% lower on NTPC. making it the biggest loser right now on the Nifty. But otherwise, solid-looking screen, 260 points higher on the Nifty, Nigel.
Well, that's right. From the broader markets, a few more stocks just to highlight. Enviro Infra Engineers, that stock is in focus. They've secured projects worth around 300 crores in Chhattisgarh. So that explains why Enviro Infra is higher in today's trading session. Idea Forge had a good close to trade yesterday. The stock, I think, has more than doubled from the recent lows. Today, as well as opening on high volume. So Idea Forge as well as higher. Let's pull both those two up. Enviro Infra as well as Idea Forge. Both of them should come up for you on the screen. You have Bagel Projects, that won an order yesterday. I think we have the management schedule later today. That stock, in fact, is up and about in today's trading session. So solid up move is what we're seeing on that particular name. And the other one is Avalon. Nimesh had alerted that could be a large trade. I think that large trade has taken place, on that particular name. So Avalon as well is a little bit low, but that's courtesy the large trade that we've seen. KPIT Technologies, commentary a little bit skittish. The street is taking no note of that. The stock we're talking about is Avalon. So pull up Avalon. KPIT is lower as well because of the skittish commentary. But all in all, a solid start to trade. We hope that we end closer to these levels. The crude sensitives, well, they are on fire. OMC is up and about. BPCL, HPCL, IOC, all up between 3 to around 5%.
All right, we've got the market holding on so far. 250 odd points in the 250 odd points higher is what you have. I mean, the other one is Indigo, which is up about 3.5%. By the way, Indigo is the largest volume-led gainer right now. So it's a pretty straightforward kind of screen. Adani Ports, interestingly, is the other one, right? I mean, they've got, that port in Israel, which they operate. So that's up about 4% as well. I mean, the oil stocks, of course, are there. What else? I mean, Page Industries is up 3.5%. Mangalam was talking about Page. Hitachi is up 3%. Union Bank is up 3%. JM Financial is up about 5%. And you go down the list, Aarti is up 4, PG Electroplast is up 3, lots of stuff coming through. And this is early on, in the first couple of minutes of trade. K Fintech is up about 2.5%. So lots and lots of movers at this point in time. And of course, it's predominantly on the upside, nothing very much on the downside at all. I mean, some reversal. So I was talking about defense, right? I mean, if defense should go up as conflicts rise, they should perhaps cool off a little bit as conflicts abate. Cochin is down 1, Garden Reach is down 3.5, HAL is down 1.5, Mazgaon is down 1.7, BEML is down 2.5, Bharat Dynamics is down about 2.5%. So if you look at the defense names, they're all kind of seeing a little bit of profit booking, nothing very much. I mean, they've all been such big winners. MRPL and CPCL, Chennai Petro, were both up between 7 and 10% yesterday. I think they're also cooling it a little bit, apart from the straightforward oil producers like ONGC and Oil India, which are down 2.5% and 3.5% respectively as well. So, as I said, it's a thematic kind of a day, but there is a broad lift coming through as well. 25, 240 is where we're at. Shreyash Devalkar is with us of Axis Mutual Fund. Shreyash, good morning. Great to have you back on the program with us. Appreciate it. Let's just hope now that the ceasefire stands and it's a bit of a clearing event for markets, and we can look at other things now. So, what are the other things which the market is going to focus on? Does the market need to readjust at all, or I mean, this 200, 250 odd point move that we have today? That's it. I mean, we didn't see any large risk off on the back of the conflict in the first place to begin with. What's your sense?
Yeah, so that Raj risk off was definitely was not there in the market. And in that context, definitely when it comes to, it's internal sector rotations. So we have seen some correction actually a little bit correction in the stocks which are crude oil price sensitive, and those stocks actually have seen some reversal after that. At the same time, overall from here on, if we want to look at what next, then definitely this overhang of geopolitical issue, whether with this development, whether it is over, and we should move on with the domestic as well as other export-oriented parameters. So if we try to move on with that, few parameters are there. Definitely, we have seen rate cuts. We are seeing now crude oil prices coming down, and its impact on overall credit growth. So what one should look forward to is with cut in the CRR, the cut in the repo rate, and improving liquidity, how the credit growth will shape up from here on. Because there are 2-3 elements which are in their favor. One is liquidity. Second is now the ECB. Actually, versus ECB, the domestic loans are actually much better, and that should give some kicker to the credit growth. And lastly, the retail credit growth should may actually come back. So with this, I would actually look forward to that piece on an overall macro front, when and whether it is coming back and how soon it will come back, with the festive season just few months away. So that is one part. On the exports front, there has been uncertainty because of tariff to these geopolitical situations. That overhang also is everyone is watching out for. In my opinion, if you look at IT, then in case of IT, that overhang need to come back, need to subside from here on. So that is the other place and where the valuations are reasonable. And thirdly, the other space where the valuations are reasonable is auto. So I'm just highlighting the spaces where the valuation compared to pre-COVID are reasonable, which is banking, that is lending, then there is auto, and then there is IT. So in these spaces, if there is some chance of growth to come back, then market should look forward to it.
Okay, IT and auto, these are some pockets you're looking at. Got that, Shreyas. Good to have you on. You know, that was what I was coming to, just to understand the broad house view where you're looking to place, new bets. We just had a discussion on IT, and I think it's still a debate out there because we're not getting the kind of growth numbers that the market would like to see. I mean, large cap companies are still giving you anemic growth, mid-single digits, not even seen high single digits in a while. And mid-cap companies, they're not all moving together as a basket. Some are up, some are struggling. Can you just expand on that point on IT? How do you find valuations and why are you willing to look at it?
Valuations wise, definitely one comment I might have made earlier on this show that yes, this sector has, despite slowdown, this sector has not got derated. So the first decade of this century, the growth was 15% and the multiple was 20-25. Second decade, the growth was 10% and the multiple was 15 to 20. And now the growth is around 5% and the multiple is around 20-22. So with this, as far as valuations are concerned, on the PE basis, definitely the valuations are not have not corrected commensurate to the growth slowdown. On the other hand, the cash flow profile of this sector has improved a lot compared to 2 decades ago, and that's where, including the dividend and buyback, that actually lends some support for the valuation, and especially in the context of every other sector which has got re-rated a lot. Now coming to the growth, so obviously without growth, nothing moves up in India, just because whatever metric of valuation we can use, it may be free cash flow yield or it may be PE basis. So on the growth front, that's what my point was, that yes, with the global uncertainty. So the global uncertainty is leading to the indecision. And that indecision first started with the tariff uncertainty and now with the geopolitical issues. So on both these front, I think the tariffs and the negotiations are on, and probably we are at the fag end of it. So that is one. And secondly, on the geopolitical situations, if this subside further. So in both these situations, if the growth for the sector improves, then there is a chance. Now, as you're rightly highlighting, the large versus mid and small. So the large cap, actually recently there was a result of Accenture as well. The large cap is seeing some pressure on overall growth for some time, and that's where the opportunities are to be found out at in the multiple sub-segments of IT. It can be in the niche segments, the companies which are focusing on the niche segments in this, and some companies are there in the products as well, and some companies are there in engineering R&D. So it need not be the traditional way of investing, wherein the growth would depend more on the revival of the global outlook. But at the same time, there are pockets where there can be growth.
Hi, Shreyas. Good morning and good to see you, Ben. What about travel and tourism? You're quite bullish, I think, on the prospects out there. How do you play this theme, though? You have hotels, you have, the one listed, quality aviation stock. What's the view out there? How do you play this entire travel and tourism theme? Hotels, what else?
So in travel and tourism, there are multiple aspects. Definitely, see, this sector now is a discovered and established sector. So actually, so is most part of the market where there is a, so to say, structural growth in last 2-3 years. And those, this is hotel and basically tourism is one of them, like EMS services and manufacturing. So hotel tourism is one of them. This sector being already discovered, there are names obviously in the hotel space, they are in airline, or with airline there are not many options. Then you have certain companies which are derivatives. Some companies are there in the IT as well, who are focusing on the niche areas of tourism. There are players also in the luggage segment, but then their growth has been patchy. But then market should look into it when the growth comes back in that segment. So in all segments, actually, the what market is focusing on is the segment where there is a consolidation and there is a few winners, few clear-cut winners, which are emerging without much incremental competition. And that's what you are noticing, that market has flocked to those. While there are certain segments where there is a competition. Now, the luggage segment, there is a competition, newer brands are coming. And in that context, though the sector is doing well, the companies may not have done well the way you wanted. And that's where it's a combination of both sector tailwind and consolidation in the sector, and you being with the winner.
Okay, all right, got that point. Overall on earnings, Shreyas, I mean, that's the big hope for the market, right? That eventually we'll get a revival. FY25 was an aberration. What would you say? 10 to 12%, more than that, less than that? What do you expect on the earnings revival front?
I think actually FY26 already, in my opinion, the earning cuts have happened because earning cuts were there for last 2 quarters now, 2 to 3 quarters since September quarter, especially it started big time. And with these earning cuts, which we have already seen, in my judgment, FY26 earnings probably may not see further cuts because all the issues which we market knows, which is a NIM impact on the banking sector, which is high weight and which actually drives the earning for the Nifty 50 or any large cap index. So in that context, most of this news and earning cut for FY26 is there out there in the market, and I in my opinion, it may not get further cut. FY27, obviously, that earning scenario has to emerge from here on, and in that probability is there. Yes, you may see some earning cut on FY27, but FY26, I think it's broadly there.
Okay. All right, got it. Shreyas, good talking to you this morning. Thank you very much for joining in and giving us perspective on the market. The market continues to chug along quite well. Actually, before we move on to our next guest, quick stock 25,200, right at the top of our recent trading range. And this is a range that's been on for a good month now. And we're right at the top of it. So let's see, 1% higher, looking good today on that screen. The next sector that we're putting the spotlight on is actually the hospitals in the healthcare space. Now, we had big news come in over the weekend. Amazon has announced its entry into the sector with the launch of an at-home diagnostic service. PB Fintech, of course, we know, is going to be investing close to 700 crore rupees in its healthcare arm. They're looking at building their own standalone hospitals, and maybe the first of those hospitals would be completed by the end of this year. Let's discuss these developments and what it means for the sector, for patients, for the incumbent players. We have the management of Narayana Healthcare now joining in. Narayana itself is looking to offer integrated healthcare services across the board as well. We have with us Sandhya J, Group Chief Financial Officer at Narayana Health. Sandhya, always a pleasure to welcome you on our shows. And like I said, I mean, it was a slightly long preamble, but just to put things in context, because there's a lot changing. You yourself are looking at clinics, you're looking at insurance, you're looking at a far more integrated healthcare offering. So what does this changing landscape really mean for competition, for patient services? Opening thoughts.
Good morning. Thank you for having me here. So if you look at Narayana's mission and what we've been trying to solve from the day we started, we've been trying to solve for accessibility, affordability, and availability. And that is really the goal of healthcare. So the more players that come into the market and with different perspectives. So for example, Amazon comes with a very heavy tech enabled service orientation, which is a positive movement to the market and so on and so forth. So we do believe that these are positive developments to the sector. Coming closer home, I think as regards to our own integrated care journey, we believe that we should take responsibility to keep our customers healthy and not treat them when they're sick. And that's the premise in which our entire integrated care business has been built. And we are hoping that we are able to create that value to our customers.
Sandhya, can you give us some more numbers with respect to your own foray? Before we talk about, the entry of other players like PB and Amazon, just, set the stage for us in terms of the clinic program that you have, the launch of clinics. How much money are you putting to work? When will this business be profitable? And similarly, insurance. What exactly are your plans and what are the targets there?
Sure. So we have already launched more than 10 clinics in Bangalore. We have about 4,000 people, lives insured in our insurance plan. We don't look at these as separate developments. We look at them as a holistic way by which we offer care. So which means that the clinics work closer to where people live and therefore more routine care for people. And when they are in need of coming to the hospital, the insurance operates like a financial enablement. So that's really the model. The other part that we are trying to solve with the insurance business is we are trying to solve for the missing middle, which is people who don't have access to many public healthcare who cannot afford insurance today. So it's a low cost, no frills insurance. So that's the other segment that we are targeting for. From an investment point of view, we've committed 400 crores in this business over the next 3 to 4 years. Our break-even will be cohort by cohort. Like, for example, the first set of clinics that we established, the first cohort of clinics, they've completed 18 months and they've already broken even. The second set of cohorts are now going through that journey. So it's a cohort by cohort model. The same thing with insurance. We would take insurance into a particular city. So right now, for example, we've launched insurance in Bangalore and then we're
got that.
in Calcutta. So we're looking at a 2-3 year break-even period on a city-to-city basis.
Right. Got that. And good to get those plans across as well. Sandhya, good morning. Prashant here. Now, let's just talk about Amazon Diagnostics, right? Is it going to be a threat to players like you, to other players in the system? It's a tech giant. They're promising fast turnaround reports. I mean, routine test results within 6 hours. The reports to be found on the Amazon app. Of course, they'll do what they can. But as things stand right now, with the information we know, do you think there will be a threat?
I cannot comment for other players, but for us, we don't see them as a threat because we've always said that diagnostics is very important. Preventive is very important. A lot of the healthcare that people are availing today is because they did not attend to themselves on time. And growth of a diagnostic business only enables people to manage their healthcare better. It will definitely motivate players to invest in tech and be more customer focused, which is where the industry has to progress. For example, if you take Narayana, most of our reports are delivered in less than 60 minutes on the app. And it's a total digital experience. So we've already cracked that model inside Narayana. And it will probably motivate us to do more and more of that so that we are able to match up to the how the demand is being consumed.
In a way, do you expect them to act as an aggregator, Sandhya? Amazon? I mean, their entry as you see it?
See, I cannot comment for their strategy, and they always try to pivot along multiple axes. So I'm guessing that they may want to look at aggregation as an axis as well, but I don't think it's my place to comment on that.
All right. Hi, Sandhya. Good to hear your thoughts. Well, on integrated care, you mentioned a couple of times. I think last year the cash burn was close to 65 crores. Do you see this coming down this year? And just want to revisit the break-even timeline for that.
So we've committed about 400 crores over 4 years for the integrated care business, which is insurance plus clinics. We will burn cash in the integrated care business. That's because we're opening more clinics. So at a cohort by cohort level, we are breaking even. So this year, we will not reduce the cash burn. It will increase. But our first set of clinics have already broken even. And we will continue that cycle.
Yes. Got it. Okay. All right. Specifically on the insurance part of the business, which is also part of integrated care, as you said, could you give us some more color? You'll have launched a new product. I think it's Arya in 2025. So if you could, give us some kind of number, some kind of guidance, premium growth you're targeting, number of policies you're looking at in FY26?
So we haven't publicly disclosed the numbers that we are targeting, but we are looking to grow in the focus markets, which is Kolkata and Bangalore in FY26. So these are the key markets. And of course, there are other markets that we will expand into. We are already present in Mysore. Now, the model is that it's an integrated experience. So we start with a proper intervention in terms of what are the health needs of the individual, and then we build on the journey along with that. So it's not like when you fall sick, we'll pay for you, but we will manage your health. So that as a concept is taking some time for people to understand and latch on to. So there has been a slow progress, but this is the model we want to build. So we are fully committed to growing this business. So we will be able to share more numbers as we start building out.
Sandhya, so just to understand this insurance piece further, I mean, you're a hospital chain now looking to offer insurance solutions. PB Fintech was an insurance aggregator platform, and now they're looking to set up hospitals, get a separate company going with separate set of investors. So we're just trying to understand, I mean, how this really works out, and what's the end game for you? Of course, I mean, better solutions to the customer are well taken. I'm just trying to understand from a business perspective, how will this be priced? What is the scale up that you have in mind? And what will it mean for you in terms of profitability margins? Just explain the business in this.
For integrated care?
Specifically for the insurance business that you're setting up. Not clinics, just insurance.
Okay. So our insurance business model is similar to other insurance providers. The only difference being that it has a lot of preventive components inbuilt into it. So, and we are also, because we work very proactively regarding the health outcome, so we also have access to a lot of data, because of which we are able to proactively manage the health requirements. So the way we have priced our insurance product, number one, it factors the element of trust. And we have spoken about the ecosystem of trust, and I don't want to repeat it. That helps us bring the costs down. The second part is that because we are proactively intervening, therefore the cost of care also goes down. So that is priced in, and that benefit is passed on to the customer. So that's our financial model. So just give an example, Aditi is a policy which is priced at about 1,000 rupees per month approximately for a family of 4 for a 1 crore coverage. Now, it just looks like a lot. That kind of policy doesn't exist. But the reason we are able to do it is because the care is managed completely inside our network, and it is managed in a proactive way. So that helps us build the cost, bring down the cost. And that helps more people who don't access insurance today access insurance. So that's really the theme with which we are building this.
Sandhya, we'll leave it there. Thank you very much for joining us. Good speaking with you, and good luck. It's done very, very well. The business and, of course, the stock as well. That's Narayana Health for you. But, I mean, in terms of Amazon Diagnostics, as Narayana looks at it, not a threat, at least not at this stage, more tech-enabled sort of online aggregator at this point in time. We'll take a quick commercial break here. We're going to come back with an interesting conversation with a new IPO, which is coming up. A well-known brand, especially here in Mumbai, Kalpataru, The management is with us here in our studio, so going across to them after this quick break.
Well, Mumbai-based real estate developer Kalpataru is going to be raising around 1,590 crore rupees, and the subscription for the IPO opens today. Do you know the company will utilize close to around 1,200 crores for debt repayment and other general purposes as well. Joining us on the show today, we have Mr. Parag Munut, the managing director, and Mr. Chandrasekhar Golekar, the chief financial officer at Kalpataru. Good morning, gentlemen. Thanks a lot for coming down to the studio. I was just looking at the anchor book and some solid names have featured out there. So good on y'all. That appears there's a fair bit of interest, and I think we should pull up some of those names on the screen. That said, this is going to be a fresh issue. So all the money comes back, and primarily it's going to be used for debt repayment. As I mentioned earlier, around 1,200 crores of that will be used for debt repayment. So a couple of details. What is the interest cost savings on this 1,200 crores? That was what were you borrowing at, point number one. Point number two, the debt number, if you could update us, post this 1,200 crores, what does it come down to?
Thank you, CNBC. So we are quite pleased. I mean, it's the first day. I mean, issue opens today, and this is really good to have us on CNBC. Thank you very much.
Appreciate it.
So the issue is of 1,590 crores, as we know, and precisely 1,192 crores is the debt repayment. All of it is going to the financial institutions and bank, which will reduce yearly interest. Minimum reduction will be around 100 to 120 crores or so. So far as the debt equity ratio and everything, because today the net debt in the books as of December, which is the reported accounts in the financials, is around 11,000 crores. From there, if we reduce the promoter CCDs, which then later got converted into equity in the month of March, just 3 months ago, and the cash and bank balances, what remains is 9,200 crores. So from 9,200 crores, it will come down to 8,000 odd crores because of this 1,200 crores repayment. And the equity, because of the conversion of CCDs, I mean the conversion happened at 1,440 crores worth of conversion. Therefore, the equity rose to 2,500 or so. December was around 1,500, then 940 crores got converted. So 2,500. And that further will increase to 4,000 because of the 1,600 issue.
Yes.
So post-issue, it will be therefore just below 2 or so.
So it comes down to ballpark around 8,000 crores. Got that?
Roughly.
Got that number. Are there further plans? Because this is something that could be plaguing investors with regard to the debt on the books. You have explained that you're sounding pretty confident as well. Are there any other plans to reduce debt? Maybe some land parcel monetization, internal cash flows as well will come about. So just on this debt part, are there plans to reduce it further?
So yes, absolutely. So organically, the real estate debt, we need to understand how the real estate sector works. So in real estate, it's a capital intensive sector. More so if it is in MMR Mumbai, where prices are as such high.
Yeah.
So in the initial years of the project of 1 to 2 years, maximum 2.5 years, the capital is provided in two forms. One is equity, another is debt. So debt is an ingredient part of this whole mechanics. Now, when the debt is utilized for the underlying projects which are throwing cash flows, which we typically call it as ongoing projects, which we have 2.5 crore square feet. Out of which we will be actually delivering around 1 crore square feet, 11 projects in FY26 and FY27 together. They are going to throw handsome cash flows, net operating cash flows, because almost all of the land cost is fully paid already in past. And that represents actually part of the debt, frankly.
So the cost has been taken up front and
Yes.
the revenues will come. So let's just start from a little bit of basics. Gentlemen, thanks for coming in. Parag, if I can come to you. Tell us a little bit about the, the business per se. This is, for our viewers who don't know, it's a well-known brand, I mean, and it's very visible around the city. But just tell us a little bit, what segment are you in? How much, I think, Mr. Jogelkar mentioned some land parcels, etc. How much developable area you have? Just the basics. I mean, give us a sense of the size of the business.
Thank you, Prashant. Thank you, CNBC. Yeah, we are a 55-year-old brand, so we have been in the business for 55 years. Started from Mumbai. We have been in the whole region. We are one of the only developers who have been across all the 7 micro markets of Mumbai. So starts from Altamont Road, Carmichael Road, all the way up to Mira Road or Thana. We've been in Thana for about 30 years. We've worked in Panvel and all. So we have a deep insight onto the market. At this moment, and Pune, we do Pune. We are Pune for 30 years. At this moment, we have about 50 million square feet. That's about 5 crore square feet of projects which are broken up into ongoing, which is about 25 million square feet, 2.5 crore. Ongoing means they're going across every micro market. These are in 25 projects. And the forthcoming is which we launched in the last 6 months, because after we filed the DRHP, or in the next 18 to 24 months, we launch. That's about 16 million square feet. That's about 1 crore 60 lakhs. And the balance, 5 projects, which comes to about 7.8 million, about 78 lakh square feet, is planned, which will get launched from 24 months to 36 months. Now, this 50 million square feet, as he said, it's out of that 75% is owned land. So we've paid all there's no litigation, nothing, all clearance are there. The balance is a JV, JD and redevelopment. Redevelopment has become a strong thing in Mumbai. So we have some of them going on. We're doing redevelopment from 15 years. What we play across is play across from luxury, premium, aspirational. We have across the whole field, all spectrum. So we have a deep insight on what customers are wanting in each field. So case in point is our portfolio at this moment of projects, our inventory, 70% is sub 3 crores. That means Mira Road, Thana, Mulund. So we have that cycle. 10% is between 3 crores and 10 crores. And the balance 20% is 10 crores plus. So we know what customers want, customers demand. And
in terms of the business, Parag, just one thing. Is it, you said that, are you moving towards more JDs and, not acquiring land outright, more asset light? Is that the way forward? What's your sense?
For the near term, it is a asset light model, as we have enough lands which we have bought. And because of the DCR regulation changes which has happened in Mumbai, the redevelopment has got a lot of boost. It's making Mumbai younger. It's making with all the amenities and facilities within the Mumbai. Everybody has to have additional parking, amenities. So that, we are doing redevelopment from last 15, 20 years. So that will give us a lot of boost. So that will be the growth.
So Mr. Manoj, actually I had a big picture question, but since you brought up redevelopment, let me take up this part first. Help us understand from an operational perspective and a margin perspective, how does a redevelopment project compare with, say, a project where, whether it's a JDA or whether it's, a project based on your own land? I'm just trying to understand the brass tacks of the business.
So in redevelopment, your investments are less because
Absolutely.
You're not buying the land.
Yeah.
And especially in redevelopment, once all your approvals happens, then you tell the society to move out, then only your investment happens in the land.
So how much higher would the profitability or the margin, say, on such a development be?
So margin-wise, it would be about 25% and all that. When you own land, your margin would be higher because you get the capital appreciation also on the own land. Could go higher.
Okay, Mr. Jogelkar, I think you want to just add a point. No, and the mix that you'll in the next immediate 1-2 years, yes. What will the mix be? And what will that imply for margins?
So first of all, today we are 75-25, as Mr. Parag mentioned.
Yeah.
So that will generally continue for 2 years because, we will add more properties, but that will take time to come into the launch, etc. So far as margins are concerned, he is absolutely right. Initial capital investment in the redevelopments and joint development is very, compared to the greenfield land acquisition, it is quite low, number one. And greenfield land acquisition takes little more time to develop because we have to go through the title, the approvals and everything. Therefore, the land appreciation, whatever rate we get, that is why the margins there are higher than the redevelopment. And because in redevelopment, once we execute definitive documents, we have to immediately
and you have to
start
hand over the project.
So
as
the
well
time
quickly.
gap is not much.
Okay, so Mr. Manoj, now I'm coming to the bigger picture question. The Indian real estate space is going through a lot, right? Largely family held, but now it's getting corporatized, from the Oberois to Macrotech to so many companies have come to the market. Now you're coming in. A lot of companies are also having pan-India aspirations. I mean, look at the Bangalore boys, Prestige and all of them coming into Mumbai. How intense is the competition in the Mumbai market for you? And will you also think of going out of Mumbai, Pune, this zone anytime soon?
Sure. Good question. There were top 7 cities of Mumbai. Out of that, the sales happen in 50% of sales happens in MMR region, Mumbai Metropolitan Region, and Pune. The launches and sales. So this is the biggest market in a way. In that, we being there for so many years, we have a deep loyalty, reputation, customer experience. So we don't feel the competition to be so much. We definitely will go out. We have one project in Hyderabad. Hyderabad is a deep market. It's a growing market. We completed, it got good sales. The first phase completed, second phase 60% sold out. We look at there. We finished one project in Noida, fully sold out, did well. So there is, but at this moment, because of great opportunities in the MMR and with the infrastructure boost finally coming in MMR in the last 10 years has really made a very attractive market.
Just one question, Parag, on the timing of the issue itself. Any thoughts? Why now?
Why now? Maybe we should have done it earlier. But we thought...
Because we've had a very strong last few years of real estate, right? I mean, so you could have gotten in early. You're coming in, I don't know. I mean, any thoughts on the timing?
So we have another listed company. So we know the play of listed company. We realized that we should come when we have the right amount of projects and we have a right runway for the next 4-5 years. And we were all there. So all these 25 projects and the other projects, we got them all ripe up. And that's the reason.
And for the industry, which year in the cycle are we in? Normally in the 10-year cycle? It's going to be interesting because your IPO is open today.
Middle of the cycle, early part of the cycle, where are we?
Some clues from the analysts and all the analyst agencies which they do. We have average inventory of 16-17 months in MMR.
Okay.
Ready to move in inventory is almost negligible. When these are the two parameters, we should always keep watch on this. That means that geography where, I mean, what this data relates to is not picked up.
Okay, all right.
Okay.
That is point number 1.
Months, okay.
Which was earlier 35 months.
Okay.
3 years back.
Okay. And just to add to what Parag said, is that why now? So as the projects, we launched 1 crore square foot of projects in last 3 years. And we are completing 1 crore square feet of projects in next 2 years. I mean, 26 and 27. And secondly, promoters have infused 1,440 crore, almost equal to the size of IPO, just less than that. In March, in form of equity in the company at 517 rupees per share. So for the viewers to note, promoters have infused 517 rupees per share and the issue is being offered at 414 rupees, I mean, at a higher band.
That's how you must have gotten, right? GIC Singapore, Bain Capital, SBI Mutual Fund, SBI General Insurance. I'm sure that had something to do with convincing those marquee investors to come on board.
Well, thank you very much, gentlemen. Good luck with the issue. And I think this will be the first of many interactions over the coming quarters, years. Thanks very much, Parag.
Thank you. Thank you, Prashant. Thank you, Surabhi. Thank you. Appreciate.
Yeah. Okay, well, that is the Kalpa through real estate business, which is coming to the market. So watch out. Well, I just move on now, and we are now joined by Nikhil Bhandari, a co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs. Nikhil, thanks for waiting. Good morning. Appreciate your time here on CNBC-TV18. I'm looking at the title of your report, The Great India Energy Climb. So let me ask you, let me throw it open to you. Just the top 2 or 3 takeaways from the main points that you're making through this report, Nikhil. You tell us.
Yes, absolutely. Thank you. Thank you guys for having me on the show. Now, look, the main anchor punchline is that we are seeing a structural shift in India's power and the energy demand. We now expect the power demand to grow at over 7% per year through FY35. Now, that's a significantly faster run rate than what we previously expected. The important thing is this isn't just driven by data center, AI, or EV charging, which is the theme of the West for the power demand growth. What's really driving this is the income growth. As more households move up the ladder, they buy more air conditioner, washing machine appliances. So that's driving the growth. The big push towards the manufacturing is driving the industrial power demand growth. So again, we're not upgrading our GDP forecast. We're just upgrading our power consumption intensity to GDP forecast, leading to this punchy power demand forecast number. Now, the other thing that we have done in the report is we have looked at the supply side. Where are the likely bottlenecks in supplying this demand growth? The first one we've talked about is the potential ceiling for the growth in the renewable capacity. After a huge runway of growth in the last 10 years, we have some technical constraints around ramping up renewable at a similar pace for the next 5 to 10 years. So we talk about the bottlenecks there and what's needed to break the bottleneck, which is the battery storage. We also talk about more thermal capacity still needed to avoid a potential energy deficit, which could be as much as 9% by FY35 if we go with just the current pipeline or the current target of the thermal capacity addition of the power system. And the last bit is the bottleneck is the distribution electrification. We've done a great job electrifying our generation, transmission infrastructure, but distribution, the last mile, still needs to be electrified, and our transmission and distribution losses are still high at 18% versus the world average below 10. Now that sets up the investment themes because investors need to own the bottleneck in order to create alpha from a stock market perspective.
So across these three themes, Nikhil, talk to us about how to play on the equity side. Just take us through one by one.
Yeah, sure, absolutely. Look, we can't specifically talk about the stocks, but I'll put the framework here. So the opportunity clearly for investors is to own the bottlenecks directly. The first is on the renewable side. The bottleneck on the renewable side is not the solar cell or solar module manufacturing anymore. We're already in overcapacity for modules. In a year or two, we'll be in overcapacity for solar cells as well. Our demand constraint, our demand size is going to be more limited. We are already growing 25 gigs solar per year. We can get to the run rate of 30, 35. But if we keep doing that for another 2 to 3 years, we have a theoretical limit on the coal, because you need a larger base load. And in order to, when you're 45% of the capacity mix is solar during in your total power capacity, we have to flex down coal during the morning time when sun is shining. And there is a theoretical limits around it. So that defines the demand for me. If demand is growing 30, 35 gigs a year, we have more than enough solar modules and cell capacity coming online. The real bottlenecks here are the polysilicon, the batteries, and somebody who can take polysilicon all the way to create into module and power out of it. We think that is the business model which is eventually going to survive. So that is one. The second is who's going to help us create more thermal power generation, given we have a 7% power demand CAGR, and we have some constraints in the growth in the renewable capacity after reaching this a huge size of 45% in the capacity mix. So thermal generation is another bottleneck. And third is the distribution. It can be played through either the equipment side, because we need to electrify the last mile distribution. We need to put more smart meters, more low and medium voltage distribution lines. And for that, we also need the companies who can work on the ground and electrify the distribution and privatize the discom. So again, those are the main themes that we are focused on from a stock picking perspective.
Yeah, I know. We're regretting the fact that we can't get down to individual stock names or understand that you have limitations, Nikhil. But just talk to us at least about this. I mean, investors could look at an integrated player like NTPC that's doing everything from thermal to renewable to even nuclear they're getting into. Or maybe a Tata Power that's looking at both ends of the spectrum. Or you could try and target niche stocks and niche companies. For instance, I mean, mentioning offhand, there was this news item on NLC India. They're setting up a battery storage plant now in Tamil Nadu. So what should people look at niche pockets like the solar cell manufacturers or someone who's setting up, a battery storage system? Or are you just best off with integrated players for the next 1-2 years?
Our call is really to directly own the bottlenecks. And the bottlenecks, as I mentioned, are who can make the polysilicon, who can make the battery cell, not just the battery packs. Cell is the harder thing to do, not the packs. Packs is a low entry barrier business, but cells is really hard. Who can manufacture the cells? Who can really provide me the equipment for the last mile distribution electrification? And who can build the thermal generation for us? So again, to us, it's more about owning the bottlenecks directly rather than we own every piece of the power value chain. Look, there has been a strong beta in the sector 1 to 2 years ago, and that's because we started seeing power deficit. And when the beta is there, typically the whole sector may do well. But in order to create alpha, we believe we need to own the bottlenecks directly. And these are the bottlenecks that I mentioned.
On thermal, I mean, while your point is well understood that there are certain constraints to ramp up on renewable, but this focus on thermal again, is it a short-term thing? I mean, for next 2-3 quarters, or is it the next 2-3 years that we're talking that the focus will remain on thermal, and therefore you're looking at, ways of playing that, coal, etc.
Yeah, look, this is a 5 to 10 year view. Look, there is a discovery of thermal as an important part of India's energy mix still. If our power demand is growing 7% per year and renewable is intermittent in nature, and we don't have a lot of batteries manufacturing locally, I think thermal will still play an important role in the India's overall energy mix and the power mix, because we have to balance both the decarbonization, the environment, but at the same time, the growth that I talked about, the structural rise in the power and energy demand growth in India. We have noticed clearly government did triple out the thermal coal plant addition target about 18 to 24 months ago. And they're looking at about 88 to 90 gigawatt of thermal coal plant addition by FY32. If we assume that comes as per plan with a couple of years of execution, timeline. In addition, we're still seeing about 9%, up to 9% energy deficit in the country by FY35 for certain weeks during FY35. Now, this is not just the non-solar hours evening deficit we are saying, we're talking about the energy deficit. So we need some more reliable round-the-clock solution beyond renewable. Now, what are the options we have? Beyond coal, we've got nuclear. Yes, that'll be an important solution, but nuclear takes longer than coal. So that's a 10-year and onward story, which will be an important part of the mix. But we have a problem heading into the next 5 or 10 years from an energy deficit perspective. We have another option is the gas-fired power plant, but the gas is the most expensive solution on the power cost curve in India. So again, India isn't really at this point building more gas-fired power plants. The third option is hydro. Again, we are going hydro aggressive, which is makes sense, but hydro plants also takes longer than thermal coal. So again, from the reliable round-the-clock solution beyond renewable, the thermal coal still is an important option for the India's power mix in order to meet this 7.2% CAGR in the power demand growth for the next 10 years.
Got that, Nikhil. Good conversation. Thank you very much for joining us, and really provides us with a framework in terms of how to think about the plays around the growth and power demand through various angles. Thanks very much once again. As Nikhil Bhandari of Goldman Sachs with some perspective there. 240 points on the Nifty, 25,200, still holding very, very nicely. Mitesh is back with us with what he'd want you to do with specific trades. Mitesh, what do you have?
Yeah. So there's some good traction in auto stocks, and Ashok Leyland has just got into a positive setup. So buy here with a stop at about 237 for targets of around 250 to begin with, and then we'll look at higher levels. The other stock which I like, that's Bank of Baroda with a buy with a stop at about 235 for targets of 247.
Okay, all right, Mitesh, got that. Thank you very much. We will take a very quick break on that note. Come back on the other side. We'll have Manisha joining in with the latest update on the commodity world. Welcome back. So the equity markets are having a good morning. Yeah, still 230 points up on the Nifty. And that's actually thanks to the commodity markets because that collapse in oil prices, that has made the equity bulls quite happy today. So let's go back to Manisha. Manisha, what's the latest?
You know what, Surbi, yesterday, same time, we were talking about on how the crude prices surged 5%. We're talking about almost an 11% of a decline if you count yesterday and the kind of declines that we are looking at today as well. So overnight, we've seen 8% of a cut coming in. Asia's open 4% on the lower side. We seem to be gaining a bit of that ground there. But in the last 1 month, now we're just about 9% on the higher side. And for 2025, overnight, we've turned negative for this year. We were trading up by nearly 8% yesterday when I was talking to you, and we're down by 7%. So all of that clearly has changed very, very quickly. Clearly, as we've been talking about, we are trading now at around 2-week lows when it comes for the crude oil prices. It's back at the levels before that Iran-Israel war began. Clearly, Trump announcing ceasefire agreement and the kind of statements after that we've seen from Iran and Israel coming in also seem to have taken off that premium that crude prices was holding for some time now. And then Iran's retaliatory strike that we saw in Qatar also not leading to any casualties and not too much of damage as well is what gave us sigh of relief. The oil prices also clearly have avoided that worst case scenario of Strait of Hormuz closure as well. And that was a premium that was building in for prices. Trump's statement telling everybody to keep an eye on crude oil prices, ensuring that it does not keep up. Everyone keep oil prices down. I'm watching is the statement or is the tweet that Trump put out yesterday seems to be working at this point in time. I also want to put out on what brokerages have been saying in case there was a de-escalation. Remember, we heard all of those statements from Bank of America to Citi to Mizo saying that the prices can go to 95, 120 as well if there is a worst case scenario of Strait of Hormuz closing. But now we're talking about all of these groups talking about, now that you're talking about de-escalation, you could be looking at the crude prices coming off as well. So Mizo says that de-escalation can bring the prices down to 65. There are similar statements coming in from Bank of America, while they talk about 75 as an average for this year, which is where we already are. But they also talk about a range of anywhere between $60 to $80 until 2030 as well. Cities talked about 55 if we do not see Iran, if we do not see this escalation, and if there actually is an agreement between US and Iran, then the prices can come off quite sharply. 55, 50 are the kind of levels Cities spoken about, Bank of America has said, and Goldman Sachs talked about that as well. But moving forward from here, there's just so much to watch out for. To begin with, the Fed's rate cut plan for the month of July. We've seen a lot of statements come in from the Fed officials to this. And then you also have the 9th of July tariff deadline. It is going to be about the big, beautiful US tax bill passage as well. And then the street will absolutely watch out for the Jerome Powell's testimony for Congress today. Further cues would be coming in from this one.
Okay, all right. Thanks a lot for that quick update, Manisha. But let's get back to a couple of stocks that are moving around. And Vinny joins us to tell us about KPIT Technologies that's under some pressure. Vinny?
Hi, so yes, we have KPIT Tech that's in focus today. Why? Because they came out with their mid-quarter update. Now, when you look at this update, they're talking about the business environment being weak. There's uncertainty globally in terms of geopolitical tensions, overall tariff scenario. So that turns out to be a concern for the company. Deal pipeline. They're seeing strong deal pipelines, but the conversion of these deals, that's at a slower pace than expected. Demand trends in Europe is good, but US and Asia, that's where they're facing a bit of a problem. Ramp-ups for the wins that are progressing well, but that is also going at a slower pace. So most of the things are happening, but at a very slow pace. Now, they do not expect any one-time gains also supporting the profitability in Q1 FY26 versus Q4 FY25. So yes, a bit of an impact in terms of profitability over there. Forex also, the rates have seen a sharp change coming in. So that is also something that of an impact that we could see coming in Q1 FY26. Now, on the back of this, we have Kotak Institutional Equities that's written a note as well. They've given a sell rating target price of 1,000 rupees per share. They've cut the FY26 to FY28 earnings by 3 to 4%. I beg your pardon. JP Morgan has also written a note. Overweight rating is what they're maintaining, and target price is 1,500 rupees per share. They believe that Q1 could actually be a quarter of decline for the company, and then a bounce back maybe is something we could watch out for in Q2 FY26. They've cut the organic growth by 4% for FY26 and also cut the FY26 to FY28 CAGR growth from 16.5% to 14.5%. So yes, a bit of a pressure is what we're expecting to see in Q1 FY26, and that's why the stock is falling in trade today.
Okay, all right, Vinny, got it. Thanks very much. Explains that 5% drop on KPIT Tech today. We'll take a break, come back on the other side, and then we put the spotlight on something rather interesting, the rise of a global short drama market. We have Karan Taurani joining in. What is the short drama market? We're talking getting your attention in 90 seconds, literally. And what kind of disruption perhaps could it bring for incumbent media companies? Raj Nayak and Karan Taurani join in on this discussion. Welcome back. Well, time for some drama. And we're talking literally, actually, because we're putting the spotlight on the rise of the global short drama market. Now, what is a micro drama or a short drama? These are very, very short, bite-sized video stories which seem to be rapidly gaining attention of viewers, and they're garnering thousands and thousands of viewers. Investors are making a beeline for the segment as well. And by some estimates, the global short drama market has moved from being about a $6.5 billion market to over $7.2 billion. And of course, the numbers are still growing. This market is expected to double by 2030. Now, why are we talking about this? Because some of the Indian companies, for instance, listed Z Entertainment, decided to enter this market with a small buyout. I think the startup is called Bullet, and they have decided to partner with it. So we have Karan Taurani, Executive Vice President at Elara Capital, as well as Raj Nayak, Founder and Managing Director at House of Cheer Networks, to help us make sense of this. Gentlemen, I'll start with an admission. I have never seen a micro drama. The reason I started looking at it is once we heard that Z is getting into this segment. So let's start with the broad thought here. Karan, I mean, is this a passing fad we're talking about, or is this becoming serious business?
Hi, Sunil. Good morning. I think if you look at the content creation ecosystem, we have always seen innovation in some or the other manner historically in the last 20 years. We started off with social media. We went on to YouTube, then we went on to Reels, which was by social media, then OTT content, web series content, binge watch, and now we are to this kind of content which is micro drama. So I think it's much needed. Innovation on content is a good thing, and it's much needed. Second thing is that you have to look at the audience base. I think India as a market is quite favorable. We have got more than 400 million Gen Z users. Now, this user base demographic basically is open to trying out new things. And if you look at the acceptance, I think currently there is some bit of acceptance for the global micro dramas today in a market like India in the urban markets. How this scales up in terms of the non-metro markets, how the consumer base grows, that's something to be watched out for. But definitely innovation is needed, and Gen Z is willing to try this kind of thing.
No, absolutely. We're no denying that. There's no disagreement on that at all. But do you have any early numbers, Karan, in terms of how big is the size? I mean, if you look at overall OTT market in India, I don't know. I mean, micro drama would be what, 1% of it, 2-3%? Do you see it gaining serious potential?
Yes, so I think if you look at the India OTT market, we are SWOT market and AWOT market put together. We're at about $3 to $3.5 billion. And a large portion of this market is dominated by YouTube. YouTube has been the major aggregator. Now, the problem here is that if you look at these OTT platforms, by broadcast OTT platforms, like, for example, Hotstar, the likes of Z5, the likes of Sony Live, these have been very small in terms of revenue contribution. They haven't been able to scale up beyond the point. And the problem for this is because large part of their consumption in the OTT platform would come from catch-up TV content. So it's need of the hour to innovate for this kind of content. Obviously, in terms of numbers, I won't have numbers in terms of how big this microdrama market would be because very small as of now. But yes, definitely, if these guys are able to execute well in terms of quality of content, if there is acceptance from the consumers, they can give a tough fight to someone like YouTube as well.
Okay, all right, got that, Karan. Well, let's get Raj into the discussion as well. Hi, Raj, it's been a while since we spoke. I enjoyed your review you put out on Sitare Zameen Par over the weekend. So that was pretty good. I backed that as well. But that discussion for another time. You've seen everything, right? From the traditional daily programming to the rise of OTT. Will microdramas disrupt or coexist with the long-form OTT content in India? What are your thoughts?
I think it will coexist. I mean, disruption, everybody said when TV came and OTT came, TV is going to die. When radio came, people sang the same song. But the fact is, I think it will coexist. But what is important now is, just look at yourself. The amount of time you spend on your phone, right, is more than what you spend on television. People are consuming news on their phone today. And TikTok or Instagram is a great example of the number of hours people spend on scrolling for content. So microdramas, in a way, if it's done well, like some of the companies in China have done very well, as long as every minute or 2 minutes, whatever the content is, as long as there's a cliffhanger at the end of every episode, and it's seen more as a viral video rather than just a X episode, I think it can go on, and I think it will catch on because I look at people in Bombay sitting on trains. They will just keep consuming content, and content consumption is going to happen. We are a country with, I think, Karan just gave some numbers. Gen Z itself is about 200 plus million or whatever it is, and there are more than 900 million handphones in this country. So I think it is here. It will grow. It's like in the FMCG business, what came as sachet. People started selling sachet shampoos. I think that's a similar kind of concept here. And monetization will be easier, in my opinion. It will be faster because you can price it as low as, say, 25 paise per episode, that kind of a thing. The payment gateway is going to be a challenge. As long as they fix that, I think content generation is not going to be such a big problem because most of the content it's a challenge in a way, but most of the content that's done at the moment, even in China, is based on AI. Okay, but but that over a period of time won't give you original content. That's a challenge that we will have. But if you can fix that, if you can address that, I think it's a huge market, very big market.
Wow, and we've come such a long way. Imagine the average time duration of a song in a Hindi movie would be what, at least 2-3 minutes. From that time, we've come to this discussion of microdrama. So content is really changing. But gentlemen, let me ask you again, just to press that point on monetization, if we have any kind of proven track record, or even some instances that we can draw from globally, whether this format is working business-wise in terms of generating slightly meaningful revenue? Raj, any ideas here?
I don't have exact numbers, but what I know is, look at it this way, right? When we did advertising, in a 30-second commercial, you told a story. Now visualize in a 2-minute, you'll be able to tell a much better story. That's the way to look at it. And monetization, I think, will happen. It's easier to monetize only because your ticket price can be so small, because your content creation is going to be extremely cheap, because you're not going to do 5 or 10 episodes. You're going to do 100, 200 or 300 episodes. All you need is a one set and good story with a good plot. And every day you can shoot, in a matter of 15 days, you can shoot all the 100 episodes, and that's it. And then you just keep releasing them every day.
Interesting, Raj. So you have answered a few of our queries there. They can coexist, could be monetized, and pricing is going to be interesting as well. And we have a big Gen Z population as well. But before we wind down in the conversation, Karan, let me come across to you. How do you think platforms might approach monetization? What are your thoughts? Do you think it's going to be ad-driven, subscription-based, or do you think it'll be via branded content?
I think for a market like India, we will initially move the AWOD way, for this kind of content. We have clearly seen in the past as well, the way YouTube has scaled up. They obviously are large because of the AWOD. If you look at the content which is behind the paywall, is largely the premium nature of content. Now, this kind of content, probably is very low cost in nature. That's the good part. ROI in this content could be extremely attractive. So I think initial inroads will be via AWOD. Globally, there are more concepts and more models where this content is also seen as scale in terms of SWOT basis. Last but not the least, I think all these platforms need to get a very good technology over here, because a lot of your monetization through advertising will happen via AI. So they need to have a really sound technology-based system to really monetize this kind of content and build upon that.
Just clarifying, this medium has its own language. When you say AWOD and SWOD, is basically an advertising-based model versus a subscription-based model, right, Karan?
Yes, absolutely. So initially, the scale will happen on advertising-based model.
On the advertising side. Got that. Thank you very much. Very, very interesting subject. And I think we'll probably have more conversations in this as the market evolves. So thanks very much for those interesting thoughts. Well, with that, we're completely out of time. So we're going to wrap up this edition of Bazaar. Thank you very much for being with us. Markets are in steady form. Chartbusters takes the action forward.
Nifty and Sensex sharply rebound from Monday lows, with the Nifty scaling its 2025 high as hostilities between Iran and Israel seem to subside. Broader market gains in line with the benchmarks.
ONGC and Oil India, they trade with cuts while oil marketing companies jump as crude oil prices fall to sub $70 per barrel mark, the lowest levels we've seen in the last week. This after US President Trump's ceasefire announcement relieves worries of oil supply disruptions.
Shares of KPIT Tech fall as the company in its mid-quarter update points to an uncertain business environment and lower than expected deal conversions on the back of tariff and geopolitical concerns.
Page Industries trades higher after Goldman Sachs initiates coverage with a buy rating and a target of around 52,000 rupees per share. The brokerage says industry inventory levels seem to have normalized and expects the outerwear segment to see consistent growth recovery.
And after a week of rallying, defense stocks fall on profit booking following US President Donald Trump's announcement of a ceasefire between Israel and Iran. The stocks had run up significantly in the wake of geopolitical tensions. Now the tensions abate, the stocks lower.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And as you can see to the top of the screen, all the indices, they are blinking only green this morning. So it's a good start, Mangalam. You've got a couple of dips in today, but those dips are getting bought into, telling you the kind of mood the markets are in.
The markets are in good mood. And, you know, every 15-20 minutes, you have another sector that picks up pace. So the first dip that was bought into was led higher by the IT pack. So you have the Nifty IT index. And now if you pull up the metals index as well. So not only are we seeing some traction in the IT pack, we have the metals index, which has now picked pace as well. So the last few minutes, we have JSW Steel, which has moved higher. We have Nifty Metals moving higher. Tata Steel too has moved higher. Generally, the global sentiment, looking peaceful is good for the metals pack itself.
Yeah, that's right. And, Vedanta, actually, that one as well has moved up. It's taken support at around the 20-day MA, and I think that's gone ex-dividend. So that's why the returns don't appear that great. But, actually, that needs to be adjusted for the 7 rupees as well. So Vedanta is the other one that I'm looking at out there. It's the consolidated play on base metals, and you get exposure to all the base metals out there. So that's the stock I think I'll track.
A bunch of stocks doing extremely well, and we have, Delivery, which had seen a bit of a downtake over the last few trading sessions. There was a Jefferies downgrade that came by. The stock has done well now. Interglobe Aviation, of course, crude prices reducing and their market share increasing does well for Indigo Airlines as well. So a bunch of stocks doing well, nearly 2,100 stocks in the green for just under 500 stocks in the red. We have Somil Mehta of Midday Asset Share Count for a quick technical check on the market. So, Somil, it has been fairly volatile the last 12 days or so. Now it seems like after a long time, the Nifty is broken out of the range. Do you think this is sustainable? And what are the next levels that you're looking at?
Absolutely. I think we've been stuck in a range for a little while. And today, I think we have broken out convincingly with a gap. Now, the next level to watch out for on the higher side would be 25,600. That would be my target for the short term. Medium term targets are definitely higher, which will be 26,300, 200 levels, which are all-time highs. However, we need to focus on the short-term targets, 25,600, with very stock-specific and sector-specific focus. As today, I think metals are doing good, railway stocks are doing good, and financials are doing good. So focus more on sector-specific and stock-specific. And on Bank Nifty, I think we've already broken out of the range, and the next target for Bank Nifty would be around 57,500, 57,600. That would be my short-term target for Bank Nifty.
Okay, got it. What about individual stocks, Samal?
Railway stocks, financials, and metals, three are the sectors which I'm focusing on. I have two stocks, one from financial, that is L&T Finance. This stock has broken out of a small consolidation on the upside, momentum indicators, fresh buy signal. So L&T Finance, great setup. Stop loss would be 192. Target would be 210. The next one is from the metal pack, the heavyweight Hindalco. Hindalco has broken out of a small triangle pattern on the upside, taking support at 200 daily exponential moving average. Great setup. Stop loss would be 645. Target would be 720.
All right, so those are a couple of stocks that Sumit has gone ahead and recommended right now. Believes that the next target on the Nifty would be 25,600 itself. A couple of these cement stocks doing well. Ambuja Cement has moved higher, and we're also seeing some traction in IEX and Siemens. So pull up those two stocks. We'll see the intraday chart. A bunch of buying ideas taking place right now in the markets right now at the high point for these names. So with that, we'll get you some more ideas for profit. We have Jitendra Gupta from Money Control Pro joining in with the stock. Jitendra.
Hi, thanks. I think Engineers India, which delivered strong performance in fiscal 25, deserve attention. Its order book stands at an all-time high of rupees 12,000 crore, with order inflow jumping almost 141%. Now the company expects margin to normalize, with management focusing more on cost optimization and control. Obviously, this will lead to higher margins going forward. International growth is another big push. EIL is opening a new office in Saudi Arabia to boost its presence in Middle East, and of course the overseas orders already contribute almost 2,800 crore to its total order. Management expects more orders from sectors like oil and gas, infrastructure and chemicals. In fiscal 25, international revenue rose by almost 32%. Currently, international orders are almost 13% of total order book. On the domestic front, EIL continues to reduce its dependence on oil and gas sector. It's a non-oil and gas segment such as chemicals and others are contributing almost 30-35% of its current order book. With a strong order pipeline, better execution, government push on infrastructure, of course, the cash in the books, EIL provides strong visibility for the next 2 years, and it is set to deliver strong earnings growth. Moreover, at 20 times its fiscal 27 estimated earnings, stock offers good value.
All right, with that, we'll take a short break. On the other side, Jitendra Kumar Agarwal, who's the Joint Managing Director at Genus Power Infrastructure, joins in to talk about their business outlook. Stay tuned. Welcome back. You're watching us here on Chartbusters on CNBC-TV18. The stock on our radar is Genus Power. The company looking to continue its growth trajectory despite a slowdown in tendering activity. Currently has an order book of over 30,000 crore rupees. Where does this business go? And more importantly, what does the company promise for the future? We have Jitendra Kumar Agarwal, who's the Joint Managing Director of the company, joins in now. Thanks a lot for joining in, sir. Before we talk about immediate numbers, etc., we gather from market intelligence that last week, there was a block which was launched by GIC. It was close to around 650 odd crores. Not sure if you're aware of, any communication, but that block was called off. Can you tell us if they gave you any reasons why, and is there a block which is likely in the very near future? Did you have a communication with GIC?
So, you have to understand one simple thing. GIC has two arms. One arm, they invest in the company as a shareholder, and one arm, we have created a platform with them. The other arm, we are not in touch with them on day-to-day basis, Chickwick's investment. So that particular arm and wanted to sell. This is the way they do the business. So once they've invested in the company has given them a great return. So they come out, maybe that is the way they work. So there's no communication between us regarding this block deal.
Okay, all right. The question is that, because businesses, you're promising for the business to be good, you've given them good returns, etc. If they wish to exit for the very near term, shareholders, apart from them, will have to face this liquidity event, right? So, just trying to understand.
So, that is the business model of an investment firm. How they work is better known to, but what I understand, they're getting very good returns. And you have to understand one simple thing, the platform which is created between Genus and Gemstar, that is what matters the most. Today, that platform has an order book of 28,000 crores. And further, we are bidding almost every tender that is coming in the country. So we are working very, very strongly together.
Okay, all right. Got it, Mr. Agarwal. So we'll keep this aside then. Let's focus on a little bit more on the shareholding though. The promoter entity had sold some small stake in the company, right, in the last year. Any further plans for them to sell any stake? And if demand is strong for your stock, there is close to around, I think, a large trust holding, which whenever that gets sold, the money comes back to the company. Any plans of liquidating that? So if you clarify on both the promoter holding and the trust holding, will you look to sell it?
So currently, we don't see both of them. Neither we are going to sell our own holding or nor the trust. So company has sufficient funds arrangement for the current business, so none is required.
Okay, all right.
And just on Chiswick, just to complete that entire loop, they launched a block for 3.6% equity. They have about 15% equity. So at some point, this entire 15% will come into the market, right?
My common sense says that whatever they have invested, they have made much more than that. And with 3.6%, maybe that clearly gives them a very good upside. That is the only reason I can see behind it.
Okay, all right. Let's focus on business then. Since we're talking about GIC and that JV you briefly mentioned on, and as you mentioned, there are two separate arms. One part of the street is actually concerned with regard to these receivable days and the working capital cycle remaining elongated. Could you tell us what are the plans for this year? The working capital days that were last year, will they come down? If yes, by how much? And also your cash flows, will they turn positive? Because last year, in fact, you had a negative year.
So you have to understand the business. I'll take some time on this. The arrangement between Genus is all the orders are procured by Genus. They go to the platform, and platform is funded by GIC and Genus together. Then all the business comes back to Genus as an EPC player. So once we have a business as an EPC player, we start the project. And during the initial days of the project, all the investment is done by Genus Power. All this material is supplied by us, software is done by us, installation is done by us. And once the meters are getting installed, once you start getting the operation go live, which practically takes from the day the project starts to 6 to 8 months. After that, the cash flow starts coming in Genus Power. So all the projects you will see are in the initial stage. That is the reason you have seen the growth of, there's more investment in the working capital in last financial year. Even in this financial year, in terms of number of days, you will see every month it will come down. But in the overall value, because we are growing very fast, it will go up. So absolute numbers in this year, in terms of working capital investment will go up. But in terms of number of days, you will see improvement every month.
So when does your cash flow from operations turn positive?
So cash flow from operations turns positive. Almost it will take 12 to 15 months where it will become a very, very positive cash flow.
All right. And in light of all this that you're talking about, if you could give us a sense on what rate at which your revenues and margins can grow in FY26, but more importantly, FY27, given all those projects that you're writing right now, you will be executing later as well.
So we have given a guidance of 4,000 crores during our call. So we maintain that guidance, and I am strongly feel we'll do much better than that.
That's this year. The year after that?
Year after that, I have further see a growth of 20-25% at least.
So you will do much better than 4,000 crores. One assumes that could be 4,300, 4,400 crores. On top of that, a 25% growth. So close to 6,000 crores by FY27 cannot be ruled out.
I cannot give any numbers right now, but I'm pretty confident on the way the business is going on.
And in terms of profitability, margins?
The margins, we have given a guidance of 18%. So we will definitely beat the guidance.
Okay, all right. What about order inflow, sir? Yes, your order book is solid as of now, and it gives you many years of visibility. But of late, we haven't heard of any big order wins. Do you expect that to turn in the coming year? I'm not sure whether last year we had a lot of elections, state elections, you had the central election as well. So could that be one of the reasons? I'm not sure about that. But could you tell us, in the coming year, in the next 6 months or so, should we hear about some more order wins?
So just to give you a little idea about this, in this country, we have total around 300 million smart meters that has to be replaced. As on date, only 130 million smart meters orders has been decided by the government. So more than 50% market is still remaining. So we have a very good future ahead of us. At the same time, as on date, there are tenders worth 45,000 crores in the market which are live, which should get decided in next 6 to 9 months. So I see a very good order flow coming in next 6 to 9 months.
Could you give us a sense of what the order inflow could be over the next 6 to 9 months? Because 45,000 crores is in the market for you to bid. What would your past hit ratio suggest?
So I don't want to get into that, but I can say we are a very, very strong player in the market and will surely do well.
Got that. And what proportion of your current revenue and order book is from India, and how much of that is from overseas? Because you do have a lot of new projects that you've launched, right? New products. Yeah. I think we are going through some...
Yeah, he's back.
Yeah, go ahead, sir. I think we're...
I could not hear you. I'm sorry.
I said, so what we're trying to understand is what proportion of your revenue comes in from overseas, what comes in from India, what does your order book mix comprise of right now? You have some new products that you want to sell outside of India as well, right?
So currently our export business is, in terms of percentage, is very, very low because the domestic business has grown multifold. And international business takes its own time to establish. Currently, we are focusing significantly on 4 or 5 markets where we see next 3 to 4 years, we should have a revenue stream of at least 500 crores from our international market. But it will take 3 to 5 years.
How much is that export number right now as a proportion of sales, and where does that number go to over the next, say, 5 to 6 years?
So currently, we are doing around 90-95 crores in the international exports business, which we feel in next 3 to 5 years, the way we are working on some strategic markets, it should be around 500 crores.
500 crores. All right. And just a quick word on your capacity, sir. Getting orders is great, but what kind of capacity you have on a per annum basis, if you could quantify it? How many meters did you sell last year?
So last year, we made around 1 crore plus meters. Okay. And this year, we are already producing almost 1.4 to 1.5 million meters comfortably every month, starting from July onwards. So this financial year, we expect, yes, it will go up significantly.
And capacity?
So capacity, you can say, is around 17 to 18 million meters annually.
Okay. And
20 million meters is required.
All right. And you don't need to put in any more capex, right? For now, 20 million is what you're comfortable with for you to get to that 6,500 crore revenue.
So currently, we will not be making any major capex, but yes, some tidbit capex continuously keeps going on in our business, but it won't be any major capex.
All right, we take that point. Thank you so much. Thank you so much, Mr. Agarwal, for joining in and giving us your outlook for this business. Close to 4,000 crores revenue, which you're confident of beating in this year. Margins around that 18% mark and 25% plus revenue growth in the year after that as well. Exports moving from nearly 100 crores to 500 crores over the next few years. That's about Genus Power. The only event that we need to watch out for is the liquidity that comes in from GIC at some point in time. With that, we'll take a short break, and as we do that, let's get you an important news update. Your favorite business news channel, that's CNBC-TV18, which is India's business news leader, is now just a click away on the CNBC-TV18 all-new mobile app, which gives you in-depth article, financial world updates, all that you need for finance at your fingertips. And you got to download that app. Apple Store or Google Play Store is where you get it from, or just scan that QR code, which is up for you on the screen.
Welcome back. Well, keep an eye out on a few stocks actually from the broader markets. You have Swan that's actually moved to the high point of the day. So I think we should get that stock up for you on the screen. Bajaj Consumer, a relative underperformer, but today the volumes are massive on Bajaj Consumer. So I think we should get that as well up for you. Swiggy is another name that was trading in the red just at the start of this hour. Swiggy's moved into the green, so big uptick is what you're seeing. And smaller metal counters as well. And if you look at Imfa, that stock has moved up. Mukund as well, the other one, the stainless steel player that the street is hoping that they'll turn around at some point of time. That stock as well has moved to the high point of the day. So some of these stocks in the broader markets are now standing up and getting counted.
Nigel, I'm just looking at a couple of these rice-based players because we don't know how much of the exact exports, etc., happened to Iran or how much of that was stuck from a listed company standpoint. We know the data for the industry, but these stocks were slightly worried when the uncertainty was on, and now they're picking pace. So pull up something like a KRBL, that's up 5% at the high point of trade. Kohinoor Foods up 2%. I'd like to see LT Foods as well. Again, these are companies where not a lot is exactly known about how much goes into Iran, etc., but they just play around on the sentiment of Irani's exports to of basmati rice and others. Now that there is truce, then the street is bidding them higher as well. KRBL, of course, is among the top gainers, up around 5%.
And the management we just spoke to, Genius Spa, I think that stock as well has perked up a little bit post those guidance in terms of revenue growth potential, as well as importantly turning cash flow positive. That's going to be the important one to track. But on that note, though, we have completely run out of time on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.
Hello, good morning and welcome to Trading Hour, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, with me is Ormas Pataki as well. Ormas, good day coming in for the markets. We are seeming like bulls and bears here, but surely they picked your side today. I'm happy about that. No complaining. 25,200, we're managing to hold on to that. So it's a good day coming in. And broader and also doing well like yesterday.
Oh, yes. New highs for the year. And the index would only be hopeful that another 1,000 points away from 26,277. Hopefully that should arrive soon as well, is what the bulls would be hoping for. And it is the index heavyweights that are taking the Nifty higher in that 250-point gain, be it HDFC Bank, be it ICICI Bank. It's a 550-point advance on the Nifty Bank as well. And that is also heading back towards its previous earlier highs of around 57,000, and there you can see another almost 600 points higher now on the Nifty Bank. And the broader markets, they did well yesterday after that recovery from the lows, and they are continuing to do well in today's session as well. Another 550 added on the mid-cap index, and the small-cap index too, painting a similar picture, if not better, doing fairly well for themselves. A 200-point gain on the small-cap index as well. Here are some of the movers in the broader markets though, and there are exponential gains today. Enviro Infra Engineers, there's a 300 crore odd order win that it had, and the stock is up 14% in today's session is Enviro Infra. It's a recent listing. JM Financial is up 10% in today's session as well. We'll get to some of the other gainers in just a bit, but Vinny, you know, the broader markets, the gainers are far outnumbering the losers as of now.
Absolutely, and most of the sectors are today trading in the green except for Nifty Media. But let's shift focus and now talk about commodities, because that's the space everyone focuses on given the volatility and geopolitical tensions that we see and the change that keeps coming every day. Manisha is keeping us updated with all of that. Manisha, good morning. And crude, as fast as it went up, overnight we did see that fall coming in as well.
Well, absolutely. You know, 5 to 7% of a move every day clearly seems to be becoming a norm. And I don't think that's going to change anytime soon for the rest of 2025 as well, given the fact that you have so much to watch out for in the coming year as well. But at this point in time, after that 7% decline in the overnight markets, we're looking at Asia opening 4% down as well. At this point in time, is down by nearly 2% or thereabout. If you look at the last 1 month, well, that criteria or maths also has changed. We're up just about at 9% right now. And yesterday we were talking about on how we've turned positive for 2025. Well, not anymore. After that overnight move of decline very sharply in case of crude, we are down by 7% for the crude oil prices for 2025 at this point in time. Well, just to reiterate on what we've been talking and the reasons that you've seen the crude oil prices come off, one very important point is that the reason that we are back at the levels that we saw before Iran-Israel war began is the US president's statement that came in suggesting that there is a ceasefire now between Israel and Iran. And in the last few hours, we have seen those kind of statements coming from Israel and from Iran as well, cementing what the US president said, and is the reason we're looking at that easing coming in sense of prices. Also, apart from that, while there was Iran's retaliatory strike on US base in Qatar, we do understand that the damage was not too much and there were absolutely no casualties. So that also led to prices coming off. Apart from that, it also has to do with the oil market's worst case scenario of a closure of Strait of Hormuz. Well, that clearly has been avoided, at least for now. So that premium is also off. And then very interestingly, the US president yesterday tweeted saying that this is for attention for everyone. Keep oil prices down. He said, I'm watching. This is what he wrote on Truth Social. He also says that you're playing right into the hands of enemies. Don't do that. So these kind of statements as well coming in from the US president is something that was the talk of the town on Twitter yesterday. Well, if you look at various brokerages, we've already spoken about on what all of them have said in a worst case scenario. If Strait of Hormuz does get closed, on where the crude prices could go, then perhaps triple digit as well. But now, since we have seen some de-escalation, Mizuho Group sees that $85 was a possibility if it would have escalated, but de-escalation can bring the prices down to $65 a barrel. That's exactly where we are trading right now. Not just them, trading.com also says that they're looking at a range between 65 to 85 for the rest of 2025. Bank of America has talked about 75 as an average for this year, and they feel that 60 to 80 is a range that can hold for until 2030 as well. And then you have Citi suggesting that if there is de-escalation and a ceasefire and US and Iran also agree on a nuclear trade, then you could be looking at prices coming all the way down to $55. Well, that's about geopolitics, but there's just so much to watch out for going forward from here. You have Fed rate cut plan in June. That's what various Fed officials have spoken about in last 2 or 3 sessions. July 9th is a tariff deadline. That is something that the markets will watch out for. And then apart from that, it also is going to be about hordes of data coming in from US, passage of US tax bill, that is back on radar, and Jerome Powell's testimony tonight. Well, that's going to be the most important thing to watch out for today.
And indeed, one day higher, the other day lower, and Manisha is on top of oil and all the other commodity updates. Thank you so much for that. And since Manisha mentioned Donald Trump, he just put out a couple of posts on Truth Social. He's still active though at this hour of the night in the US, that the ceasefire is now active. Please do not violate it. That was one. And since Manisha also mentioned about Jerome Powell's testimony later in the night, he's just put out a post on Truth Social calling him too late and about the fact that he will be heading to the Congress today to testify as to why the Fed has not lowered interest rates just yet. But since we were on the subject of oil, we'll talk to you about the big gainers and losers from this fall that we have seen in crude oil prices, from the highs of $81 a barrel yesterday, now sub 70. Sudarshan is here with all that analysis. Sudarshan.
So we'll start with the companies which might be impacted negatively, and those companies are upstream companies, upstream oil companies they are called, and those are ONGC and Oil India. If there is a significant fall in the crude, say for example there is $1 fall, so basically $1 fall impacts annual revenue of these companies in the range of rupees 300 to 400 crore. But in contrary, fall in the crude is positive for downstream companies like OMCs, and those are IOC, BPCL and HPCL. If there is a $1 fall in the crude, it impacts these companies' EBITDA positively in the range of rupees 200 and 300 crore. Now, apart from oil companies, fall in crude also impacts positively to paint companies, because up to 50% of their input costs are linked to crude, and if there is a major fall in the crude, it basically helps their revenue and EBITDA. And last part is it helps aviation companies, because for aviation companies, ATF is the major input cost. ATF is known as aviation turbine fuel. So it's positive for Indigo, and that's the reason you are seeing a major move in these companies which are impacted positively. And companies like ONGC and Oil India are down in the trade.
Absolutely, Sudarshan. Thank you so much for that. Keeping an eye out on all these companies which get affected by crude because they use crude or crude derivatives in their raw material. Next stock that we are putting a spotlight on right now is KPIT Tech. They came out with their mid-quarter update. So it's a quarterly update for the company. Week update that came in on the business front for the company. They've said that overall, when you're looking at it, the business environment, they're still cautious about it. Given that there's so much going on in terms of geopolitical tensions, tariffs, there's no clarity as such on that front as well. The pipeline in terms of deals, that is continuing to be strong, but the conversion is much slower than expected. The demand trends in Europe, yes, that is good. But in US and Asia, that's a bit uncertain right now. Other than that, ramp-ups in terms of wins also, they are progressing, but at a slower pace. So most of the things are happening for them, but at a slower pace. So that means that obviously they're going to see some bit of an impact coming in Q1. There's not going to be any one-time gain this time that was there in Q4 FY25 and Q1 FY26. So impact on profitability. Overall, in terms of deficit also that they're going to expecting to see in other income is what the company is highlighting due to the changes in terms of overall the forex rates. Now, on the back of this, Kotak Institutional Equity has come out with a note, sell rating, target price 1,000 rupees. They've cut the FY25 to FY26 to 28 earnings by 3 to 4%. Even JP Morgan is maintaining their overweight rating, target price of 1,500 rupees per share. But now they believe that Q1 FY26, that could be a quarter of decline for KPIT Tech. And obviously, bounce back is only expected in Q2 FY26. So they have also cut the organic growth by 4% in FY26. And CAGR growth also is cut by around 2%. For FY26 to FY28, they were expecting 16.5% previously. Now it's at 14.5%.
On a day when the mid-cap index is up 500 points, KPIT Tech is down 5%. So an underperformer, bucking the trend in today's session, has been an underperformer over the last 12 months as well. The other sector that is not doing well other than KPIT Tech, though, is defense. Of course, profit booking coming in after all the moves that we've seen. Garden Reach is now down 6%. BEML is down 6%. Mishra Dhatu is down 5.5% as well. So defense as a pack not doing well. Take a short break. On the other side, the management of Ellen Barry Industrial Gases joins in on the other side as their IPO opens for subscription today. They get you a conversation with them on the other side. Stay tuned. Welcome back. And as the markets have started to recover, the primary market activity has started to buzz as well, as many as 3 IPOs have opened for subscription today. One of them is Ellen Barry Industrial Gases that has also opened for subscription today. It closed on the 26th. The issue size is 850 crores, price band of 380 to 400 rupees. The company being a manufacturer and supplier of industrial, medical and specialty gases. Now to discuss more on the company and the prospects, Varun Agarwal, who is the Joint Managing Director, along with Padam Kumar Agarwal, who is the Chairman and Managing Director of the company, are joining us. Gentlemen, good morning. Thank you for joining in. Varun, first question to you. Firstly, congratulations on your heading towards the Dalal Street. We'll be seeing you soon on as a public company as well. You know, first question, of course, being on the revenue mix, if you could talk about it. You are in various segments of gases, be it industrials, medicals. If you could talk to us about the revenue mix, and which is the one segment that you would want to play more or lay more emphasis on going forward?
So thank you so much for having us on the show. The revenue mix is primarily driven by our core industrial gases business. That's about 95% of the revenue, and about 5% comes from project engineering services. Within the 95% of industrial gases business, most of the revenue comes from the three core gases, which are oxygen, nitrogen, and argon. Healthcare accounts for about 10% of our overall revenue, and healthcare typically includes oxygen. Going forward, we would like this revenue mix to be driven by the core gases business with a greater emphasis on argon revenue, since that tends to have a higher EBITDA margin.
Okay, that's interesting there. Mr. Padam, good morning. This is Vinny joining in the conversation as well. First, also, where are we currently seeing the end-use demand increasing, or where do you think the drive is coming in as of now in today's scenario?
The traditional businesses, the traditional consumers like steel and pharma would continue to have higher demands. And at the same time, we see new demands coming in from the new age industries like solar and electronics, semiconductors, and likewise.
Do you see, Mr. Agrawal, do you see that the new businesses that you're talking about, especially the solar business, considering the emphasis on renewable energy that the country has been putting on, would this become a significant part of your business, say, over the next 3 to 5 years, or would you consider being on the traditional side of the business itself?
We would like to be in both segments. The traditional part is still very strong, and it will continue to remain strong given the growth rate of the country. And steel and pharma being very basic and primary industries, the new applications which are coming in would call for requirement of high value gases, and that is where we would expect improved margins.
Okay, that's why you're expecting improved margins going forward. Varun, let's just talk a bit more in terms of overall the capacity utilization that's currently that you'll have at your different plants and your key plants, and how much of a headroom do you think over there is there for growth in terms for the company?
So our historic capacity, say about a year ago, was about 600 tons per day, which is currently fully utilized. In the last financial year, we've set up 2 new plants, which has now taken our capacity from 600 tons per day to about 1370, so 1370 tons per day. So that's more than doubling of our capacity. And going forward, we have plans to set up 3 more plants, and we would expect our capacity to be about 21 to 2200 tons per day, say about a year from now. So there is a lot of headroom in terms of the new capacities coming in, and we are ramping up the capacity utilization as we speak, which will lead to strong growth both in terms of our revenue, bottom line, as well as margins.
Varun, any other differentiator or a standout aspect for your company would be that how do you differentiate when it comes to competition? There are other companies who are into similar businesses as you are, be it Linde or be it Inox Air Products. What is one aspect that will differentiate you from competition and make you stand out when it comes to being in similar business lines?
So look, our key differentiator is that we are a 100% Desi company. So we are competing with multinationals. I think most of the industries that you see, they have a combination of Indian companies as well as multinational companies. We have our advantages in terms of, having strong customer connect, being very agile, being quick to act to situations, able to build up our capacities a lot faster. And of course, our competitors are sort of global giant companies, so they have their own advantages. I think there's a place in the market for both of us.
So Padam, I just want to understand one thing right now. When I'm looking at the financials, while FY22, the profits were somewhere around at 672 crores, then it went to 281 in FY23, and now in FY24, the year end was at around 453 crores. Now, given that obviously there's going to be debt repayment that is going to be happening with this IPO as well, and you all are setting up another plant as well, right? Air separation unit, which you all are setting up for around 100 crores. I want to understand the outlook for profitability, and in the past years, what was the reason for this, increase and then decrease in terms of profitability?
The spike you see was mainly due to the effect of COVID. There was an additional demand for medical gases, and the values were also relatively high. So, and subsequently when COVID was over, so there was a correction, sort of. And further, last year, we have added fresh capacities. And as we will also plug in new capacities this year, so the graph will continue to remain upward. There was only a correction in FY23, and that was largely because of the correction coming in from the diminishing effect of normalized situation after COVID.
Clubbing two questions into one due to paucity of time, gentlemen. First one being that how much is the current capacity utilization across units? What is the scope for growth here? And part two of my question is the utilization of your proceeds. A lot of it is going towards retirement of debt, and you're also using some of those towards adding new capacities. Is that the only capacity addition program that is on the anvil currently, or there are more in the pipeline over the course of the year?
So, as I mentioned, our historic capacity is fully utilized. We've recently set up 2 plants. Those plants are currently ramping up in terms of capacity utilization very rapidly. We will need more capacity, and some of the proceeds, part of the fresh issue is being used to set up 1 new capacity. Apart from that, we have 2 more capacities which we are planning to add. So as I said, the capacity ramp up will be like 600 tons, going up to 1370 tons, and then going up further to about 2,200 tons per day.
Okay, gentlemen, thank you so much for joining with us on the show today, and good luck with your IPO. Hope to see you all more often now on the channel as well after you'll make your debut on the T Street. So thank you so much for that. But on that note, we're going to actually slip into a very short break. After the break, we'll return and we will discuss market technicals with Midday Thakkar and his top bets. Welcome back to Trading Hour on CNBC TV18, and our Nifty today obviously managing to hold on to very strong gains in today's trading session. But let's understand the market technicals with Mitesh Thakkar. As of now, also Nifty at the day's highest point, almost around that mark, 25,260. Mitesh, good morning and a good day surely panning out for the Indian markets and global markets as well. But what are you looking at in terms of levels for the Nifty and the Bank Nifty now, and in terms of your top bets that you're looking at as well?
So to begin with, good morning. To begin with, I think, I was looking at 25 to 20 to 50 as the supply pivot. I think that's been clear. Now, getting past that means that the index has got a fair chance of heading towards 25, 450 to 25, 500, and then we'll take it from there. The trades on the positive side, if somebody wants to buy Nifty now, while this may not be the best entry point, but yet I think it offers a good trade if you keep a stop below 25, 185. So you have about 85 points of risk, and 25, 455 is your target. That's on the index. And on the stock side, I have buy on Chambal Fertilizers, the stock just below level of 556 for targets of 580. And the other one which I like is Colgate Palmolive, which I would buy the stock below levels of 2416 to 24.
Mitesh, thank you for sparing time joining us today. Views on the index and on specific stocks as well. Interestingly, UBS had also come out with a note on Colgate a couple of days ago with a buy recommendation and a 3,000 rupee price target as well. Take a short break. On the other side, more on the markets with Venkatesh Balasubramaniam from JM Financial Institutional Securities. On the other side, stay tuned. Welcome back, and currently at the highest point of the day now, 300 points higher on the Nifty, 1,000, almost 1,000 now on the Sensex. And Venkatesh Balasubramaniam from JM Financial Institutional Securities is joining in to take this conversation forward. Venkatesh, good morning. Thank you for joining in. Just reading your note where you mentioned that the EPS downgrade cycle is still not over, and we have almost recovered around about 3,000 odd points from the lows that we had made during the tariff drama. What do you expect from the first quarter of this financial year? We'll just start reporting numbers in a few days from now. Is this going to be a quarter similar to what the third and fourth quarter have been of the previous financial year, or do we see some green shoots of earnings recovery start to show up now, considering that we'll be having a low base of last year?
Okay. See, our analysis suggests that the earnings, decline cycle has not kind of ended. Even in the month of May, we saw something like around 1.5% to 2% kind of EPS cuts on the Nifty by consensus. As we start first quarter, I wouldn't be very, very optimistic because you will definitely not see great growth from the banks. Banks form a very big chunk of the index. So with the interest rate cuts, you could definitely see a NIM compression in the current quarter. Not that it is not part of consensus expectations. I think most people have already factored that in. We are expecting weaker numbers from even the auto sector. So I don't think it is too early to look for green shoots at this point. This time is our view. And anyway, for the current year, I think consensus expectation and even the JM Financial expectation is that EPS growth will be in the low double digit kind of level, maybe 10% to 12% growth for the full year of FY26. So still early times to look for green shoots. We personally believe the second half will be better for EPS growth than the first half.
Okay. H2 for EPS growth will be better than the first half, and you're saying autos is not something exciting, as well as banks. You're not expecting them to do well in Q1, obviously, given so much has happened from their front. Venkatesh, good morning. This is Vinny joining in the conversation as well. But then where do we find value, right? At such a point of time, what should you be looking at in terms from the market point of view? Should it be more large cap? Should it be more mid and small cap? What are you all looking out for?
Okay. Now, there was a brief period, maybe 1.5 months back, where there was a definite trade available, which was large caps were preferable to small caps and mid caps. But we personally believe that opportunity is long gone now after the rally in the large caps. If you look at headline valuations, you will perhaps feel large caps are cheaper. Large caps are trading at maybe 22 times FY26. Mid caps are trading almost like 29 times and small caps are at 25 times. But interestingly, the EPS growth profile, if you look at consensus numbers, are very, very different. So for large cap, expectation is around maybe 10% growth over the next 3 years. For mid caps, the expectation is almost like 20% plus growth over the next 3 years. For small caps, it's 15%. So if you adjust for growth and you look at something like a PEG multiple, you will realize that actually mid caps are much more cheaper than large caps. So this prefer large cap trade is largely over. Incrementally, it is about, you should not bother about the market capitalization of the stock. If there is growth visibility, you should go for that stock and not really bother about what is the market capitalization per se. Now, interestingly, we said for the first quarter, banks' numbers might not be that great, but we still would suggest investors that they should be overweight banks because, the weaker numbers are largely in consensus expectations. But if you broadly look at across the board, all the sectors in this, in India, if you look at the Nifty per se, banks is one sector where valuations are very, very reasonable. Private sector banks are trading at in line with the historical mean. Public sector banks are trading one standard deviation below. Most of the other sectors in India are trading at one standard deviation above mean. So valuations do not make sense. So that is why we have in our model portfolio, we're running almost like 120 bips overweight on banks. Incidentally, we have an overweight even on insurance because insurance valuations have also started looking very reasonable. And even for AMCs, we are running a small overweight. NBFCs and AMCs, we are running a small overweight.
You know, Venkatesh, there has been plenty of chatter regarding the oil prices and all the developments that have happened. Crude almost down now 15% from the peak that it made yesterday. Now, where do your preferences lie within this oil and gas basket? Or are you even preferring this basket to begin with, whether it be the upstream explorers, the ONGCs and the Oil Indias, or the downstream refiners, the oil marketing companies, or even the city gas distribution players or the IGLs and the MGLs?
So we have a complete avoid on oil and gas, but surprisingly, we have an overweight on oil and gas because we have an overweight on Reliance Industries, and we are playing Reliance Industries for the telecom business, not for the oil and gas business. Yes, even in Reliance, we believe petchem margins have kind of bottomed out, but overall, we are not too constructive on oil and gas as a sector. We like Reliance Industries for the telecom business, and for that, because we believe over the next 12 to 18 months, there will be rate hikes in telecom. And beyond that, we also believe that if we see a Geo IPO over the next 12 to 18 months, the sector could re-rate. So we like telecom as a sector. We like Reliance hence, and as a consequence, we can't help it, but we have gone overweight on oil and gas because of the telecom business of Reliance. And we are also positive on Bharti, so we are overweight on the telecom sector as well.
Okay, so telecom is also something that you like. You're more overweight on Reliance's telecom side of the business, but obviously it comes as a parcel. And Bharti Airtel is also what you've mentioned. But Venkatesh, thank you so much for joining in with us this morning on CNBC TV18 and giving us your views in terms of individual stocks, sectors, and what are you watching out for on the fundamental front. So that was Venkatesh joining in with us from JM Financials on his views on the market. But on that note, we're actually going to slip into a very short break. And after the break, we'll be joined by the management of Visual Projects, joining us to discuss their latest order win and their business outlook going forward.
Welcome back. Now, Bajaj Projects recently secured an ultra mega power transmission order from Power Grid. Now, this is an EPC contract for power transmission lines and substation bay extension works. To discuss this and more, we are now being joined by Mr. Rajesh Ganesh, who is the Managing Director and CEO of the company. Mr. Ganesh, good morning. Thank you so much for joining in. If you could tell us more about this Power Grid order and what is the timeline by which you are supposed to execute it? What are the kind of margins that you are accruing from this order? More details on this, please.
Yeah, well, good morning to both of you, and thank you very much for having me here. Well, this is one of the two ultra mega orders that we have won for this quarter. This one is a roughly about 137 kilometer, 400 kV double circuit line that goes between Mahan and Rewa in Madhya Pradesh. So it's got two packages. One is the transmission line in itself, and the other one is a bay extension work that we are going to be doing at the Rewa substation. So this is one. The second order that that I want to talk about is something that we announced earlier in the quarter, which is sort of a 127 kilometer line, but much heavier, 765 kV line that we won again from Power Grid. But this one goes between Kurnool 4 to Kurnool 3, which is part of a larger sort of TBCB package. And we're doing two of them. But this one also involves design and engineering alongside with the routine activities of supply erection and commissioning. So both of these, we are going to be, obviously the client is going to be Power Grid for both of these.
Absolutely. Rajesh, good morning. This is Vinny also in the joining in the conversation. You spoke about two interesting projects coming in during this quarter as well. FY25 is what I'm looking at right now. I have the number coming in for the order book. That's today around 2,984 crore. Right. How do you see this moving up overall for FY26 or the first half of the year as well? If you could talk to us about that. And in terms of margins, how will they start shaping up? These two orders, what does it mean in terms for your margins of the company? Because year-on-year basis, when I'm looking at it for Q4 FY25, good improvement in terms of margins. So I just want to understand in FY26, what are we expecting?
Okay, certainly. I'll take them one after another. Yeah. We'll talk about maybe we'll sort of talk about the order book first, and then we'll go to the margins thereon. So, well, if we look at, as you've got on your screen, if you look at the end of the financial year, sort of last financial year, we were a shade bit north of 2,900 crores, bit less than 3,000 crores. Now, with these two orders coming in this quarter and a few other small orders coming in, we'd be hovering sort of close to or in and around 4,000 crores in terms of order book. Now, in terms of margins, there's a concerted effort that's going on to improve the margins. If you, as you sort of already know, we are a relative sort of newcomer here. Even though we have this Bajaj sort of brand over us, we still fairly new as compared to other well-entrenched players. So we have a bit of work to do in terms of, reducing our sort of COGS margin, COGS expenditure rather, and also our interest cost. But those are some of the things that we are looking to sort of do to increase our margins. Definitely would be better than what you've seen in the past.
Better by how much? What is it that we're expecting? 100 basis point? What are we watching out for in FY26 then?
Well, our focus, Vinny, largely has been on quality of the unexecuted order book, really, not so much on the quantity of it. For me, the way I define quality is really executability and profitability. Those are the two ways I'm looking at. So both of these are really needed in order for us to pick projects. So we're going to be fairly selective in the way we pick our orders. The focus is not to drive a lot of top line. It's to look at working on sustainable and sort of profitable projects as we go along. So So that's really the focus. So we will see margins go up, but then margins going up, as you would appreciate, is a factor of several things.
True.
You see which are playing out in front of us now. So we'll have to wait and see. But we're quite positive that the margins will be better than what it was in the past.
Two-part question, sir. And what are the kind of... So since you mentioned you would be selective in your orders and choosing the kind of orders you bid for. So what are you anticipating in terms of order inflow this year, since you have already won 2 ultra mega orders in this quarter itself? So what are the kind of order inflows you're anticipating, 1? And 2, since you mentioned about execution and there are a lot of other things that you need to work on to improve margins, what are the execution targets that you have set internally for you as a company? Because there have been a lot of these managements who have come to us and they've mentioned that execution has been delayed for various reasons whatsoever, be it manpower shortage and so on and so forth. So what are the execution targets here and the expected order inflow?
Yeah, so I'll take the execution sort of targets/challenges first, and then we'll talk about the order inflow. So, well, I mean, they're right. I think we face, in my opinion, we face 3 major challenges in execution, which are, and it applies to sort of everybody in the industry really, which are a little bit out of our scope. One is the availability of front to do the work, you see. So the way the contracts are structured is that supply goes as per the schedule, but erection and stringing and commissioning happens really, that depends on the availability of the front. So to a large extent, even though ROW is not really within our scope, we are dependent a lot on our customers and our clients to provide the fronts on time. So that we can, go ahead and finish this work quickly. I think the second challenge that we're facing is availability of skilled manpower. See, what's happened is that a lot of work has come over a short window of time, and as a result of that, it's put a bit of pressure on a sort of limited pool of skilled manpower, particularly in the area of erection and stringing. And much needs to be done in that area, given the outlook for this sector is also quite positive going forward. And the third challenge is really around equipments, P&T, power transmission and distribution, equipments that are sort of to be made available, and those are challenges out there. Now, these are the major challenges, to be quite honest. And then it's around sort of working alongside with your clients with a sort of a spirit of partnership in order to sort of get this done. But then the focus is always on, at least our focus is always on execution. We want to get the job done on time and move out. Now, coming to the sort of other point on, was it order book? Could you repeat that question?
The estimated order inflow, Mr. Ganesh. What are you expecting this year?
Right, the estimated. I mean, it's a bit difficult to give an answer for that, to be honest, because as I said, our focus is going to be largely on the quality of the order book as opposed to the quantity. I mean, once we reach a certain amount of minimum efficient scale, which is needed in this business, and after that, it's really about focusing more on sustainability, focusing more on profitability. So I wouldn't wager a number here, but our effort would be to pick projects more selectively.
I'll rephrase that question then. If you can't give us a number, have you bid for projects? If you have bid for, if you could give us a number, one-word answer, number for the projects that you have bid for and the projects that you are currently L1 for.
Right. So bidding is a continuous process. You see, I mean, if you look at if you look at a number, we'd probably be looking at bidding for upwards of 1,000 to 2,000 crores. But again, it all depends on the quality of the of the bids and sort of our ability to execute it and profitability. These two aspects.
Okay, Mr. Ganesh, thank you so much for joining in with us on the show and explaining us the outlook for the company going forward. What are we watching out for in terms of order inflows as well as in terms of the margins of the company. But on that note, we're going to slip into a very short break. We'll get you more updates on the market on the other side.
If there was a unanimous decision to choose the color of the day, it was green. 315 points higher on the Nifty, almost 1,000 higher on the Sensex now. The broader markets continuing to rebound, almost 700 points higher on the Midcap Index. And we call time on this edition of Trading Hour. Vinny and I take your leave. Thank you so much for watching. Halftime report on the other side.
Stocks gain on hopes of a durable truce between Iran and Israel. Metals, auto and financials are the prominent gainers today.
KPIT Tech points to slow deal conversions, delays in project ramp-ups, uncertain demand trends and adverse forex movements. In its mid-quarter update, this spooks the street, the stock times.
Crude drops 8% overnight to revert levels to before the pre-Israel-Iran war broke out. Fears over the Strait of Hormuz being closed, dissipating also helps cool prices.
US President Donald Trump says an agreement between Iran and Israel has been reached on a total ceasefire, calling the conflict the 12-day war. However, Iran has not offered any confirmation of a truce.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me is Vivek Iyer. You're watching us live from the CNBC-TV18 Motilal Oswal studio. And if you're a bull, what a good afternoon you have for yourself. A 300-point rally on the Nifty, a 4-digit point rally on the Sensex, over 1,000 points. Midcaps doing well and Nifty Bank doing better as well. And what more do you want when the Telecom Minister, important comments coming in at the bottom of your screen as well, which says that the government's job is to provide as many avenues, for Vodafone Idea. But more importantly, it is not good enough to have a duopoly. Must have competition in every sector, as India is the only country with 4 telecom companies. All of that has Vodafone Idea's shares up as well, up nearly 5.8%. So important comments coming in from the Telecom Minister Jyotiraditya Scindia. We will try and get in Ashmit, who is sending these lines from this conversation as well, because, up until now, there hasn't been any sort of reprieve coming in on Vodafone Idea when it comes to the AGR dues, and that was what took the stock lower from its earlier highs as well. But that's about Vodafone Idea, one in the many 2,100 stocks which are actually in the green today. So Vivek, all green screen, just like your shirt.
Absolutely nothing to complain about. The war ends, crude oil dips. All of the worries that we started Monday morning with have actually dissipated on a Tuesday morning. Mid-morning, we are having a screen absolutely green. All of those stocks that had seen significant selling pressure, post what was essentially the 12-day war, as Donald Trump calls it, names like the OMCs, all of them had seen correction. Today, the entire pack is doing very well. So HPCL, BPCL, IOCL, all of these stocks doing quite well. But we'll now move on to a very important story. In fact, sources tell CNBC-TV18 that the government is likely to take a call on rare earth manufacturing scheme in the next 10 to 15 days. Parikshit, our colleague, joins in with more details.
The Ministry of Heavy Industries and the Department of Atomic Energy are soon going to roll out a scheme for manufacturing rare earth magnets in the country, and this could be done in the next 10 to 15 days. The approximate outlay of the scheme would be around 1,000 crore rupees, and the government will aim to incentivize manufacturing of rare earth magnets in the country at globally competitive prices. Under the scheme, India Rare Earth Limited, which is a PSU in the mining of rare earth, will be asked to provide raw materials to the industry, and they will be providing 500 tons of raw materials of rare earth to companies which qualify under this scheme. And the government hopes to manufacture or incentivize manufacturing of at least 1,500 ton of rare earth magnets on an annual basis. 5 to 6 OEMs have shown interest in the assembly and manufacturing of rare earth magnets in the country, and stakeholder consultations have been completed. Interministerial consultations have also taken place. The government is also looking to allow OEMs which are not able to access the Chinese supply chain for rare earth magnets to import full assemblies, that is full components, instead of just rare earth magnets. And if need be, the tweaks to the domestic value addition criteria under PLI scheme may also be considered.
All right, we take that point. Parikshit, thanks a lot for that. Meanwhile, a bunch of stocks which are spiking right now include the likes of Ultratech Cement. All the cement stocks actually are doing well this afternoon. They've picked some pace. And then you have some of these, ARCs, etc. as well. Edelweiss Financials, Pidilite is the other one, which, remember, crude oil prices declining helps for their raw material further as well. And then you have some of these names like Abbott. So gains are sprinkled across a bunch of sectors and across a lot of stocks. So we'll do the best thing. Take a short break, come back, get you some more trading ideas on this show. We do have a guest joining us. Sachidanand, taker of Trade Bulls, joins in to give us trading strategies and stock ideas after this short break. Welcome back. Let's pull out the intraday chart of Bajaj Consumer. That stock has been buzzing since morning, and this afternoon now it's moving even further. It's up close to 18% with a fair amount of volumes on that stock. An underperforming FMCG stock. The reason why the stock is buzzing is because the company's just announced to the exchanges that they've had a change in management. For FMCG companies, remember, management changes are important inflection points. For Bajaj Consumer, Jaideep Nandi, who had earlier joined from Asian Paints, now has put in his papers on account of term completion. And on his in his place, Mr. Naveen Pandey has been appointed as the managing director of the company. Naveen Pandey has experience with Asian Paints, has experience with PepsiCo, has experience with Marico, as well as the last 2 years he was with Unibic, the biscuits maker. So let's see how this comes about at a time when consumer sentiment is weak, but then again the stock has underperformed a fair bit as well. So the street is betting on the management change to do well for Bajaj Consumer. 18% higher on that stock on appointment of the new MD. The other thing that we're looking at right now, the market setup, when it comes to the F&O moves, if you look at it, it's a big solid rally that we're seeing. 1,000 points on the Sensex, 330 points on the Nifty. At any given point in time, if you bought today, you would be sitting on money. That's the kind of trend day that we've seen. And it's backed by strong market advance decline ratio as well. So all the frontline indices doing well. 2,100 stocks in the green for just under 450 in the red. And these two lines have not come close to each other through the day. It looks like a parallel train track. That's a positive. And along with all of this, we've seen a decline in the India VIX, which was anyway around 14, has now come below 14. So that is telling you that there is a fair amount of put writing that is taking place as well. More on that in just a bit. It's the high beta sectors which have bounced back. So metals are doing well, up around 4.5% for SAIL, between 3%, 2.5 to 3% for Tata Steel and JSW Steel. Base metals doing well as well. And with the market moving higher, 25,300 conquered on the Nifty, the base is moving higher as well. 25,200 put writers fairly active for a premium of 69 rupees, and the 25,250 put writers equally active as well. The premium out there is around 84 rupees, telling you that the support for the Nifty has moved higher to around 25,150 to 25,200 itself. On the way up, the 25,300 call writers are something that I'll be watching out for, because the premium here is 140 rupees. So if the Nifty sustains above 25,400, then these call writers will have to cover their positions, just the way the current 25,200, 25,300 call writers are covering their positions. 25,400 call writers are also fairly active at 85 rupees. So 25,500, can we make an attempt towards that, towards this expiry, is something that the street is betting on. The only fly in the ointment, with the kind of exuberance that we've seen here, the put call ratio has moved towards 1.2. Typically, it can stay around these levels, but usually between 1.2 and 1.25, we see some moderation. So has today's move, meant that over the next couple of days, we will see consolidation, or will this continue or not? Put call ratio will be the important barometer to watch out for. 3 stocks I'm watching out for: Aditya Birla Fashion Retail, Titagarh Rail Systems. Both of them exited F&O ban yesterday. They may re-enter F&O ban today with the kind of open interest jump that we've seen. And Biocon, which is in F&O ban, 1 day ahead of expiry, perhaps will exit F&O ban. So those are a bunch of stocks that I'm watching out for today.
Thank you so much, Mangalam, for taking us through the internals as far as F&O is concerned. Nifty currently hovering around the 25,300 mark, like you mentioned. 25,500 is where bulls will hope that this particular expiry the Nifty can move towards. But it's a very good time to get in Sachidanand Uttekar from Trade Bulls. Thank you so much for joining us, Sachidanand. First up, you just heard Mangalam. Where do you see the trend as far as the Nifty is concerned, Nifty as well as Bank Nifty? What's your call over there?
Good afternoon, Vivek. Good afternoon, Mangalam. Clearly, when we look at the trend has remained bullish throughout these 7 weeks of consolidation. Now, if you look at the Nifty, the potential for today, looks clearly bright for a rally to extend towards 25,425. We are of the opinion that eventually the market could see a swing towards 25,555 during this particular series itself. So I think it's a very healthy consolidation breakout that we have observed. Even if you look at Nifty Bank, the hurdle at 57,000 is expected to be surpassed. Eventually, we see this index also scaling towards 57,700. So on both the indices, the bias remains positive. From a momentum perspective, for the Nifty, I think 25,130 would be a very important support. Until unless we trend above this particular level, the possibility of a quick move towards 25,555 or an extended move towards 25,630 remains bright. So keeping a stop loss at 25,130, we still recommend building long positions when it comes to Nifty. For the bank Nifty, if you look at the contraction, the support at 56,630 is very critical. The gap up opening has been very strong. So I think keeping a stop loss there on a closing basis will be healthy, and we may see an extended rally towards 57,710.
All right. And individual stocks, Sachi, are you betting on the long side right now, or are you taking any contra short positions as well?
Well, we have been on the long side throughout this phase of consolidation as well. Nowhere we have seen any distortion of trend. So if you look at the Nifty Bank, I think the contribution will be significant. And if you look at the structure of Kotak Mahindra Bank, despite of market volatility, this particular stock continued to display a higher top, higher bottom sequence. Even right now, the kind of breakout that we have observed is a inverse head and shoulder formation breakout at 2180. Even if you look at the options data, 2200 call writers were very adamant. And with today's breakout in place, we see further unwinding of positions. So we are expecting that this momentum will continue towards 2305, eventually towards 2360. And that's why we are recommending building long positions in Kotak Mahindra Bank even at this juncture. The stop loss for the trade can be placed at 2195 on closing basis. The other stock which we have recommended to our clients is ABB Limited. Now, even here, if you look at the overall sequence for the last 3 trading sessions, the stock managed to sustain above its 50-day exponential moving average support, which is placed somewhere close to around 58.50. We have seen a reversal candlestick formation in yesterday's trading session, and the opening has been very significant. There are fresh long positions which have been added. So we are expecting that the rally may extend towards its 50-week exponential moving average, which is placed at 6160. The second target would be 6240, and hence we are recommending building fresh long positions in ABB. Even at this juncture, one can chase momentum with a stop loss at 6010.
Thank you so much, Sachidanand, for joining us, giving us both your view on the markets as well as your individual trading ideas. Well, a couple of stocks, that come to mind, given the fact overall it's a very green screen, but 2 stocks, both of them oil explorers, seeing and coming in for a bit of profit booking as oil takes a bit of a nosedive. ONGC, this particular stock down over 3% today. And the other stock that's taken it on the chin today is Oil India. So both ONGC as well as Oil India are 2 stocks that are under a bit of pressure today. Well, it's now time for a quick break. On the other side, Manisha Gupta joins in with Ashwin Selvaraj, Chief Strategy and Digital Transformation Officer at Roundtable on sustainable palm oil. Stay tuned. Welcome back to Halftime Report. Well, some time ago, Communications Minister Jyotiraditya Scindia bats against telecom duopoly, saying competition in every sector is a must. Let's listen to excerpts from that particular conversation.
Today we have fiber, we have broadband, we have Wi-Fi, we have mobile, and soon enough, we will also have satellite. Our job is to provide as many avenues as possible, and within each vertical as well, provide intense competition. It's not good enough having a duopoly or one carrier or two carriers. You must have competition in every sector. India today is probably the only country in the world with 4 telcos.
There's a word coming in on telecom companies by Jyotiraditya Scindia, and these comments have actually, infused some life into the stock of Vodafone Idea, something that we spoke about earlier in the show as well, and now we heard straight from the mouth of Jyotiraditya Scindia. But let's move on and cover commodities. Manisha joins in, and with her is Ashwin Selvaraj. Manisha.
Well, thank you so much for that. And Ashwin is going to talk a very important topic with us. Ashwin, thank you so much for joining in. Ashwin joins us from RSPO, by the way. And Ashwin, more and more markets and more countries and more sectors are now talking about the European Union deforestation agreement that comes into effect from 1st of January 2026, unless there is another extension, really. But how would you look at the overall compliance that we see coming in from various countries?
First of all, thank you so much for having us, Manisha. It's a fantastic opportunity. The European Union deforestation regulation is coming into effect, as you said, end of the year. And the regulations apply across several commodities, including coffee, cocoa, palm oil, wood, cattle, and others. If you look at the compliance readiness, I think the palm sector is is actually a better placed compared to a lot of the other commodities, because there's been a lot of awareness and work being done in the palm oil sector over the years on deforestation. So the level, and as an organization, we've also been working with a lot of the producers in Malaysia, Indonesia, and Latin America and Africa to address the issues around deforestation, which has built up the level of readiness of a lot of these players to be compliant to the European Union deforestation regulations. One of the key elements of the EUDR is the requirement on capturing the geolocation of the farm where the palm oil is produced. And traceability systems have evolved across many geographies, and we've also been providing traceability services to our members globally. Mm-hmm. And the information is more or less available across many geographies. And if you look at India in particular, the Indian palm oil production is actually much better placed than most of the other palm producing regions, primarily because our market is highly regulated. We are converting agricultural lands. The risk is low. And the penetration of digital technology in India is quite high. So you see a lot of the farm plots are already mapped, and the mills who work with the farmers to process the fruits already have this information. So we are actually at a much better level of compliance for EUDR.
I also wanted to understand, Ashwin, I mean, there's one part that is about farmers, and as you said, the tech penetration is quite strong, better regulation, and geolocation sharing is also something that many sectors now seem to be doing that. But when it comes to companies, how has that number been? Do you see them compliant ready as well? And the other point really is about products, snacks, etc., where you have all of these usage of many of these products. Is that back-end and front-end compliance also in place?
Sure. I mean, if you look at the production of palm oil globally, almost 25% of the global production is certified according to the RSPO standards. And the deforestation and the capture of geolocation is already inbuilt into our standards. So in terms of compliance readiness of the production side, definitely I think it's quite high. And if you look at the downstream, almost 10 million tons of palm oil is actually bought under certification globally across different markets. And many companies downstream have also built their own traceability mechanisms to capture this kind of information. So if you look at the products and the scope of EUDR, the snacks and the namkeen and all of that, I mean, those are not in scope for the EUDR. So what is applicable is really, what is in scope is really crude palm oil, refined palm oil, fractions, and some oleochemical derivatives. So I think the readiness of the industry, downstream industry, is also quite high, because if you look at the European market, they buy anywhere between 2 to 3 million tons of palm, if you exclude biofuels. And a significant portion of that palm oil is already bought according to the RSPO certified EU deforestation-free supply chains. So the information is there. So what needs to happen in the downstream industry is to actually compile this information and share it with the competent authorities in the European market. So the digital systems, the traceability systems, the readiness of the downstream market in Europe is quite high.
You said the Indian market's numbers also seem quite on the higher side. The compliance readiness here also is quite positive. I mean, we have huge, big companies, listed companies here as well. Would you say that they are all, one, buying certified palm, and the other is, are they absolutely compliant when it also comes to exporting palm-based products to European Union?
Yeah. So if you look at the certification part, I mean, it's important to understand that certification is a tool to establish compliance. So by being certified doesn't mean necessarily you're compliant to UDR. It makes you compliant and it gives you the information that the UDR systems require. So if you're coming in, looking at the Indian downstream industry, a lot of them are the listed companies are reporting into the BRSR regulations. So there's also already a lot of awareness about ESG. And a lot of these companies are already procuring certified raw materials. So if you look at the imports that's coming into India, I think about close to about 400,000 metric tons of palm oil that's bought into India is coming in as RSPO certified. We think this is just based on voluntary declarations, and we think the number is slightly higher than that. So the Indian industry is also pretty much ready in terms of compliance. And if you look at the exports, the export of palm-based materials is going out of India. So I think on an annual basis, based on a study we did, anywhere around $200 million is the worth of exports that we see going out of India, 200,000. And this is only expected to increase or double in the next 3 to 5 years, is based on our prediction. So currently what we see is that the products that we are exporting is not directly in scope of EUDR, because I said a lot of the finished goods are not in scope. But a little bit of the oleochemicals that are being exported, I think the companies are already working on compiling that information. And we are also working with a lot of our members to help them capture this information from the origin. So we've built a whole traceability platform that facilitates the availability of this information to export companies that are looking at exporting palm-based products out of India.
Okay, thank you so much, Ashwin, for joining us, and thank you so much, Manisha, for joining us and giving us a sense of what exactly is transpiring as far as the world of commodities is concerned. Well, we'll now slip into a short break. Once we get back, we will get chatting with Vikrant Shotria, Managing Director and Corporate Vice President, Novo Nordisk, to discuss the upcoming launch that the company is planning.
Welcome back. Let's look at a bunch of names that are doing well. We have Hunasa, which has spiked in trade. It's been an underperformer, so some bit of purchase seen out there. And a lot of these, we have quick service restaurants picking pace as well. Westlife Food, for instance, has now spiked to the high point. And this morning we spoke about how, because of the Iran-Israel truce, all the rice companies are seeing some purchase. Look at LT Foods, now up 8%. And we have KRBL as well, fairly well bid in today's trading session, up around 7.5%. So a bunch of stocks seeing a lot of bidding and relief rally as well. But let's talk about Novo Nordisk. That's launched Wegovy. It's GLP-1 therapy, which is based on semaglutide in India for the treatment of obesity. So this is the one that everyone has been waiting for, with 40% plus Indians classified as overweight. This is Indian adults that I'm talking about. The country's GLP-1 weight loss market is projected to exceed $350 million by 2030. This launch actually marks a significant milestone in Indian healthcare. So Indians, Novo Nordisk's semaglutide drug Wegovy is here. In fact, Ekta caught up with Vikram Shroritya, who's the Managing Director and Corporate Vice President of Novo Nordisk India, and spoke about, most importantly, the pricing structure plans and a lot more. Listen in.
What we have done is we have tried having a smart pricing, or you can call it a smart pricing band. So to start with 0.25, we have actually priced it at rupees 17,345. When you come to 0.5, now there is no increase in the price. We have kept it at 17,345. For 1 milligram, again, it's the same price, and they are packed differently. Then it comes to the 1.7 milligram, it is 24,218, and 2.4 milligram is priced at 26,015. So the first three initial stents are actually priced at the same level, so that when the patient initiate, they can actually do the titration upwards without pinching on their pocket.
Okay. But do you think that you need to get more competitive when it comes to pricing, especially because we do have that patent cliff which is looming in March 2026? We are going to see competition, generic competition, come into the Indian market just in the span of less than a year.
I think what we have priced is, we have priced it for innovation at this point of a time, and it is rightly priced for India. And if you really see many of the countries, across the world, we have really priced it at a level where we have kept the same pricing for all the three stents. When we will have the generic competition coming in, I think we might have to see and evaluate a scenario, what should be the accessibility point and what is the competitive, pricing which is going to be there in the market.
Okay, all right. But how do you plan to challenge the kind of competition that we will probably see in March 2026? Considering how price sensitive a market India is, we are going to see a lot of genericization probably of these weight loss drugs of this particular molecule.
And I think, we really respect the Indian industry. I think they have a game to play in terms of the healthcare space, and they are really doing the justice. Now, when it comes to the time when they launch their molecule, this is something, it's a natural course of any medication that they go under the expiry of the patent. So this is not something new. And just to let you know that we have been offering human insulin and insulins in India. They are one of the largest categories out of patent, and there have been many, many players across India who have actually launched and who are offering their products in the insulin market. But still, we have 1 out of 2 patients who are on insulin, they actually take Novo Nordisk insulin. Those are peptides, and semaglutide is also a peptide in injectable form. So I think they will have their play. They might also serve the need of the Indian patients, but we also believe that being first in the market and with our credibility, our trust over a period of time, we would be able to lead the obesity fight in India.
Is Wegovy going to be imported into the Indian market, or is there any kind of local manufacturing?
Yeah. You are absolutely. No,
so there's no local manufacturing
right
now?
We are going to import No, right now we don't have plans for any local manufacturing. We have actually invested more than $20 billion in terms of APIs as well as fill and finish. And I think we have economy of scale to really produce for the world. And we will be currently importing it from headquarters.
Any plans in terms of a distribution tie-up, at least with Indian pharmaceutical companies? The reason I ask is that they have more feet on the ground. It becomes probably a little more cost-effective for MNCs such as yours to probably tie up with an Indian company, at least for distribution. Anything on the cards?
I think while some of the players talk about the collaboration now, we have had collaborations for more than 3 decades for manufacturing as well as for distribution, which is with Abbott distribution. Now, this is something which we know, but we also know at this point of a time that we are one of the strongest player when it comes to metabolic diseases. And we have really done the justice when it comes to insulin, when we have launched the oral semaglutide. So at this point of a time, we will be launching ourselves. But should there be a need in future, I think there is never say no, and we will evaluate the scenario and see if there is a chance to join the partnership.
Have you spoken to any Indian pharmaceutical companies as yet?
Not as of now.
Why not Ozempic?
Yeah, in India, we have already launched oral semaglutide. And when we see the Indian diabetes care market, predominantly 3 out of 4 patients take oral treatment. And that is the reason in 2022, we launched oral semaglutide, and which has been accepted very well by the Indian patient population and also by the doctors. Now, for obesity, we really have the pleasure of launching injectable semaglutide in 5 strengths. That's 0.25, 0.5, 1 milligram, 1.7 milligram, and 2.4 milligram. This addresses the real need for the obese population. As you just now said, the adult population, 40% are actually overweight or obese. This amounts to more than 250 million people. So this is really a milestone movement for us to bring the access of this innovative products to arrest obesity in India.
Okay, but oral semaglutide, which is basically Rybelsus, the drug which is already being sold by Novo Nordisk in India for type 2 diabetes, the efficacy is supposed to be less than the injection. Data indicates that it's around 3 to 5% versus the injection, which is much greater, which goes into early teens as well. So give us an indication on why exactly wouldn't you launch the injection, which has more efficacy for type 2 diabetes then?
No, I think we have seen the efficacy of oral semaglutide as much as injectable in type 2 diabetes. Whereas for obesity, it goes from 0.25 to 2.4 milligram, much more higher titration for the weight loss, wherein 20% weight loss is seen in 1 in 3 individuals who have actually taken this medication. Now, having said this, we are also testing it out, the oral semaglutide in higher strengths also for the obesity. So when it comes to the lower strength, I think both the injectable and oral are efficacious.
Right, well, thanks a lot for that, Ekta, with that conversation. Wegovy finally coming to India. Vivek, there are a lot of companies which have made their inroads towards getting into the semaglutide market in India, starting 6 months from now to about 12 months, etc. What a trend this has been, right? Have you, you know of a lot of people who are in this bandwagon?
I know of a lot of people who are interested. A lot of them are waiting for generic companies to come in because this, I think, will still be quite expensive. And I think a lot of people are also waiting for effects to be seen or any side effects in case wait and watch for a couple of people to take it and then maybe jump onto the bandwagon.
I should ask you, you don't look like one. Will you ever be interested or tempted?
Maybe later in the future, but hopefully hope to stay fit and slim.
Hope to stay fit and slim. All right. So that's about, Wegovy coming into India and launching a lot of semaglutide. I'll be very interested to know, what happens to the FMCG companies, because I spoke to Varun Berry. He said that once semaglutide comes to India, the kind of people who are taking it, their diet requirements will change. For that, these guys will have to come out with those products as well. Of course, it's a very small market, but a market which has a lot of affordability as well. So from a value standpoint, will be extremely interesting to target and look at. But we'll take that short break, and as we do that, some good news for you viewers. It is the CNBC-TV18 all-new app which we're launching, which is basically the India's business news leader right at your fingertips, which gives you access to all the news, the breaking news, all the in-depth analysis, and all the articles from the financial world coming to you right at your fingertips, at your discretion. All you got to do is download the app either from the Apple Store or the Google Play Store, or just scan that QR code right up for you on the screen.
Welcome back to Halftime Report. Very interestingly, in the last half hour, what we've actually seen is a bit of correction. The Nifty Bank, all cooling off a little bit from the day's highest point. In fact, the Nifty now hovering around the 25,200 mark. A slight correction is what we've seen. But a very interesting analysis is what our colleague Sudarshan has for us. Post the ceasefire, there's been a significant unwinding of the positions that were taken, especially as far as the crude oil sensitives were concerned. Sudarshan joins in with that analytical impact.
So from yesterday's high of $81 per barrel that Brent crude had hit, now it's trading below $69 per barrel, a fall of almost $12 per barrel from yesterday's high. Now it has an impact on some of the companies. For example, upstream oil companies like ONGC and oil, that means Oil India, it impacts negatively. So if there is a fall of $1 per barrel in the crude, it impacts in the range of rupees 300 to 400 crore in its annual revenue. But in contrary, it has a positive impact on downstream oil companies like OMCs, and those are BPCL, IOC and HPCL. In the scenario of a $1 fall in crude, it impacts positively in the range of rupees 200 to 300 crore to annual EBITDA of these companies. Also, fall in crude is positive for paint companies because up to 50% of input cost of these paint companies are linked to crude. So if there is a fall in crude, fall in raw material costs basically impacts positively to margin of these companies. Also, at the end, it's positive for airline companies because aviation fuel, that is ATF, aviation turbine fuel, is one of the major input costs of these companies. That's the reason you are seeing a divergent move while ONGC and Oil India are down in trade and OMCs, paint companies and airline companies are trading higher.
All right, we take that point. Sudarshan, thanks a lot for that. Just keep an eye on Reliance. That's the one that has moved off highs significantly, currently contributing to the downtick that we're seeing on the Nifty from today's high itself. With that, what we'll do is take a short break, but remember to tune into the all-new CNBC TV18 Prime, which brings you insights from policymakers, business leaders, economists, all of them shaping both the India and the world's future from an India standpoint. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, gives you unparalleled insights. You can tune into CNBC TV18 Prime at 12 noon for Global Reset, at 1 p.m. for the Big C, which puts all the lens or the spotlight on the commodities space, and at 8:30 p.m. for the Global Lens. So that's a lineup of shows on CNBC TV18 Prime in the all-new avatar.
Welcome back to Halftime Report. While just 5 minutes back, we told you about how the market had seen a bit of moderation. It's once again picked up pace, and Nifty once again has gone back about the 25,260 levels. What's aiding the market move higher? In the last half hour of the session, we've actually seen the pharma names do quite well. So some of the pharma heavy rates, look at names like Sun Pharma, look at names like Dr. Reddy. Both of these stocks now trading near the day's highest points. Remember, for the entire pharma pack and quite a few of the export-oriented sectors, July 9th is an important date, which is when you will get some clarity as far as tariffs are concerned. What's also seen a bit of a comeback today is the entire two-wheeler pack. Last couple of trading sessions, they were under a bit of pressure on imposition of the ABS norms. But today, look at names like TVS Motors, Bajaj Auto, as well as Eicher Motor. All of these names doing quite well. In fact, all of them trading near or at the day's highest points. But Mangalam, one stock that you've been tracking is Page Industries. Goldman Sachs has initiated coverage, or what is it that they have to say?
Well, there are a couple of things that Goldman Sachs likes about Page Industries. One, that their analysis suggests, and this is the analysis of the other listed companies and their inventory levels over the last few years, tells you that maybe now inventory levels are moderating. And as a result of which, the growth forward for Page Industries looks good in their core innerwear segment. And they've initiated coverage on the stock. They have an outperform rating, a buy rating rather, target price of nearly 52,000 rupees. Why? Because of inventory levels normalizing in the industry, they believe that for the next 5 years, Page Industries' revenues can actually compound at over 12.2%. Compare that to the last 5 years, it's compounded at almost 8%. So it's a near 4 percentage points increase in compounded revenue for Page Industries. So the next few years look better than them, better than the last few years for them. The second part is that innerwear is one part. Outerwear is likely to grow a lot faster. And apart from them launching new products, consistent recovery in growth, the other driver for outerwear will be them increasing their share of exclusive brand outlets. Remember, the management has said that over the next 3 years, they will add nearly 200 to 250 exclusive brand outlets every year. And remember, exclusive brand outlets have a higher share of revenue coming in from outerwear, which is a higher value product and a higher margin product as well. So those are factors that could be growth drivers for Page Industries. That explains why the stock is up by about 2%. The important part, however, is that the market too seems to have recovered. From the time when we started the previous segment where the Nifty was closer to 25,185, that dip has quickly been bought into, and we're back around that 25,200 mark. The reason why the market fell was Reliance, and the reason why the market has recovered is Reliance as well. So pull up the intraday chart of Reliance. You would see an up move, thereafter a dip, and from there dip, a bit of a recovery for that stock as well. Still away from its high of today, but has seen a recovery from the lows. With that, what we'll do is wrap up on this edition of Halftime Report with all the indices in a bright shade of green. You stay tuned to CNBC TV18. Business Lunch comes up next.
Stocks gain on hopes of a durable truce between Iran and Israel. Metals and autos, as well as financials, are prominent gainers. KPIT Tech points to slower deal conversions, delays in projects, ramp-ups, uncertainty, as well as in demand trends being uncertain, adverse impact of forex movements in its mid-quarter update, spooking the street and the stock dives. Crude drops 8% overnight to revert to its levels before the Israel-Iran war broke out. Fears over the Strait of Hormuz being closed dissipating also helps cool off in terms of prices. US President Donald Trump says an agreement between Iran and Israel has been reached on a total ceasefire, calling the conflict the 12-day war. However, Iran has not offered any confirmation of a truce. Novo Nordisk has launched its weight loss drug Wegovy in India with a pricing starting at just over 17,000 rupees per month. Its India MD says that one of the 3 patients saw 20% weight loss with Wegovy. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. The markets cooled off from the day's highest point, but nonetheless managing to hold on to 25,200, 250 levels, about 200 levels as of now is what the Nifty is trading at. So gains of almost 1% is what we're seeing coming in for the Nifty as well as the Sensex. Broader end of the market too is doing well in today's trading session. So look at the broader end of the market as well. That's also managing to hold on to gains of around 1% as well. So the Nifty mid-cap as well as the small cap managing to hold on to gains of more than 1% as of now, almost near the day's highest point is what we're seeing. PSU banks, that's trending as well. So Nifty PSU bank is among the top sectoral gainer. Most of the sectors are trading in the green. Advance decline ratio today in the favor of advances versus decline. So obviously the trend is positive today, and we've seen that, we are seeing this strong up move continuing in the market today, and around the 25,200 levels is what the Nifty is trading at. But moving on, let's get started with the show, coming in terms of the important updates on the West Asia front. Now, after hours after this, Iran had launched missiles at the US base in Qatar, President Donald Trump announced a ceasefire between Iran as well as Israel. Watch this next report to get you more updates on this front.
Explosions were heard across Doha on Monday as Iran launched missiles at a U.S. airbase in Qatar's capital. The attack was retaliation for U.S. airstrikes on Iranian nuclear sites over the weekend, when it joined Israel's air war against Tehran. But just hours later, U.S. President Donald Trump announced on his Truth Social platform a, quote, complete and total ceasefire between Israel and Iran. He congratulated the two countries on having the stamina, courage, and intelligence to end what he called the 12-day war. Trump had said Iran gave the United States notice prior to the missile attack in Doha, which he said made it possible for no lives to be lost. Early on Monday, Israel bombed a political prison in Tehran in a renewed demonstration of its willingness to strike not only military and nuclear targets, but key pillars in Iran's ruling system. The Trump administration maintains its aim is to solely destroy Iran's nuclear program, not to open a wider war. But in a social media post on Sunday, Trump spoke of toppling the hardline clerical rulers, who have been Washington's main foes in the Middle East since Iran's 1979 Islamic Revolution.
And meanwhile, a few hours after announcing the ceasefire, Trump once again took Truth Social to talk more about the deal. He said, and I quote, Israel and Iran came to me almost simultaneously and said, peace. I knew the time was now. The world and the Middle East are the real winners. Both nations will see tremendous love, peace and prosperity in their future. But hostilities continued until the last minute, with Iran launching a number of missiles which hit a residential tower in Israel and one of Israel's city. Now, this attack killed at least 3 civilians. Meanwhile, in a dramatic turn of events, after initially denying Trump's ceasefire claims, Iranian foreign minister had said and took Twitter to mark a U-turn, saying, and I quote, the military operations of our powerful armed forces to punish Israel for its aggression continued until the very last minute at 4 a.m. Together with all Iranians, I thank our brave armed forces who have remained ready to defend our dear country until their last drop of blood and who responded to any attack by the enemy until the very last minute. End of quote. Soon after Iran acknowledged the ceasefire, Donald Trump took to Twitter yet again, saying that ceasefire is now in effect. Please do not violate. And in the latest, Israel Prime Minister Benjamin Netanyahu has also acknowledged the ceasefire while we continue to monitor the developments. Netanyahu has said that Israel has achieved its goal of removing Iranian nuclear and ballistic missile threat. Additionally, he extends gratitude to the U.S. president and he acknowledged U.S. support to achieving their goal in Iran. Now let's shift focus to the latest updates on crude amid the ongoing tensions, and Manisha is joining in with us to give us more updates on this one. Manisha, over to you. What's the latest on crude?
Well, it's been a very, very volatile crude oil prices. Yesterday, it was in a matter of 30 minutes that you saw the crude oil prices decline by 11%, only to settle 7% on the lower side. In the Asian markets, though, right now, we're trading 3 to 4% on the weaker side yet again. Well, the one thing that did take the crude prices higher was geopolitical tensions. That risk premium seems to be coming off. And with that, the crude oil prices are now exactly where they were before the Iran-Israel escalation started. Also, Trump announcing a ceasefire agreement between the two countries, and then Tehran and Israel also reiterating that has led to prices coming off. A lot of experts tell us that there is still $5 to $7 of a premium built in case of prices. Once that also goes, you perhaps will see the crude prices coming way down to around $57, $58 a barrel. The pressure has just about continued also because of the fact that Iran's retaliatory attack on Qatar US base led to no casualties, not major damage as well. And then the oil market has perhaps avoided its worst case scenario with no closure on Strait of Hormuz. The US President Trump also suggesting that the crude oil prices should not go higher, has been telling that to various countries, to traders as well, also has kept a lid on case of crude there. And that's exactly what the banks and brokerages have been talking about, that if there is a de-escalation, you could be looking at crude prices coming off even further on the lower side. Mizuho Group, for one, says that de-escalation can bring the prices down to 65. That's exactly where we're trading right now. Trading.com also talks about a trading range between 65 to 85 for the rest of this year. You have Bank of America talking about 75 as an average, but they also say that $60 to $80 a barrel is where the crude prices can trade, not in this year, but until 2030 as well. And then Citi has said that if there is a nuclear deal between US and Iran, then you could perhaps be looking at the crude prices coming all the way down to $55 a barrel too.
Thank you so much for that, Manisha. But as we slip into the break, remember that to tune in to CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, that's on Commodities, and Global Lens at 8:30 p.m. Welcome back to Business Lunch on CNBC-TV18. Now shifting focus, the shares of Vodafone Idea trade over 6% higher as Communication Minister Jyotiraditya Scindia has spoken out against the duopoly in the telecom sector as the company struggles to continue. Listen in to what he had to say.
Today we have fiber, we have broadband, we have Wi-Fi, we have mobile, and soon enough we will also have satellite. Our job is to provide as many avenues as possible, and within each vertical as well, provide intense competition. It's not good enough having a duopoly or one carrier or two carriers. You must have competition in every sector. India today is probably the only country in the world with 4 telcos.
Switching gears from telecom to rare earth magnets. Now, sources tell CNBC-TV18 that government is likely to take a call on a rare earth magnet manufacturing scheme in the next 10 to 15 days. What is the latest update on this one? We have Parikshit joining in with us to give us more details on this. Afternoon, Parikshit.
The Ministry of Heavy Industries and the Department of Atomic Energy are soon going to roll out a scheme for manufacturing rare earth magnets in the country, and this could be done in the next 10 to 15 days. The approximate outlay of the scheme would be around 1,000 crore rupees, and the government will aim to incentivize manufacturing of rare earth magnets in the country at globally competitive prices. Under the scheme, India Rare Earth Limited, which is a PSU in the mining of rare earth, will be asked to provide raw materials to the industry, and they will be providing 500 tons of raw materials of rare earth to companies which qualify under this scheme, and the government hopes to manufacture or incentivize manufacturing of at least 1,500 ton of rare earth magnets on an annual basis. 5 to 6 OEMs have shown interest in the assembly and manufacturing of rare earth magnets in the country, and stakeholder consultations have been completed. Interministerial consultations have also taken place. The government is also looking to allow OEMs which are not able to access the Chinese supply chain for rare earth magnets to import full assemblies, that is full components, instead of just rare earth magnets. And if need be, the tweaks to the domestic value addition criteria under PLI scheme may also be considered.
Okay, thanks for this update, Parikshit. But do stay on, because the Ministry of Heavy Industries has launched an application portal for scheme for promotion of manufacturing electric cars in India. Can you share more details on this front?
The Ministry of Heavy Industries has formally launched the portal for the scheme for promotion of manufacturing electric cars in India. This is going to be open for a 4-month period, and the government is hopeful that there will be a lot of interest from global OEMs. Now, as per this scheme, eligible applicants will have to commit to investing 4,150 crores in manufacturing electric cars in India, and they must start manufacturing operations within 3 years of applying for this scheme, and they must achieve a 25% domestic value addition, and by the 5th year of operations, they must have a 50% domestic value addition. They will be able to import 8,000 electric cars into India at 15% duty, as opposed to 100% duty that exists currently. The government believes that there are European OEMs, Korean OEMs who are interested in this scheme and will apply. So let's see what the response is like. Tesla has not shown interest in manufacturing in India. They're looking to set up sales operations. This is what government sources also indicating. The government will be writing to all OEMs to invite them to apply for this scheme, and they're writing to different embassies as well. But we're told that countries which share a land border with India, those countries and companies in those jurisdictions will not be invited. So, for example, Chinese OEMs will not be invited to apply for this scheme.
Now, Tesla has shown interest in setting up showrooms in India so far, says the Minister of Heavy Industries, H.D. Kumaraswamy. He also talks about application deadline for the scheme and more. Listen in.
Application through portal, how they have to submit. This portal will be open up to, I think, 4 months.
Yes, sir.
Up to October. 21st October. This 4 months, we are giving time to who are interested to enter in the portal. We have given the 4 months time. Tesla issue, only up till now, their interest is only to open the showroom. They wanted to sell their car in India. That is the issue. Other than that, actually, there is no further development about Tesla. Already this scheme, what are all the facilities they will get? We already announced. Everybody knows it. Already 4 or 5 our stakeholders, they have a discussion with our ministry. Whatever we committed regarding tariff, we will actually implement those commitments.
And shifting gears to the pharma side, now Danish pharma giant Novo Nordisk has launched its blockbuster obesity drug Wegovy in India. The company has launched the drug in 5 strengths with treatment prices starting at about 17,000 rupees a month to 26,000 rupees a month. Let's also hear out what the management had to tell us earlier on in the day about the drug and the outlook.
Is Wegovy going to be imported into the Indian market, or is there any kind of local manufacturing?
Yeah. You are absolutely.
No, so there's no local manufacturing right now?
We are going to import and No, right now we don't have plans for any local manufacturing. We have actually invested more than $20 billion in terms of APIs as well as fill and finish. And I think we have economy of scale to really produce for the world. And we will be currently importing it from headquarters. I think, while some of the players talk about the collaboration now, we have had collaborations for more than 3 decades for manufacturing as well as for distribution, which is with Abbott distribution. Now, this is something which we know, but we also know at this point of a time that we are one of the strongest player when it comes to metabolic diseases. And we have really done the justice when it comes to insulin, when we have launched the oral semaglutide. So at this point of a time, we will be launching ourselves. But should there be a need in future, I think there is never say no, and we will evaluate the scenario and see if there is a chance to join the partnership.
Okay, on that note, we're actually going to slip into a short break now. Don't go anywhere. We'll be back with more news and updates after the break. Welcome back to Business Lunch on CNBC TV18. Now bringing you the latest on the US-India free trade agreement front. Government sources say that both the countries are keen on signing an interim deal before July 9th, but not desperate. Abhimanyu is joining in with us to bring us more details on this one.
Intense negotiations are continuing between India and the United States for a bilateral trade agreement between both the countries. Both the countries are looking for an interim deal before the 9th of July. Now, that is when the pause on the imposition of reciprocal tariffs is slated to end, and both the countries remain keen on sealing an interim deal before that date. However, a government official has pointed out that the American side remains insistent on lower duty and higher access for American dairy and agricultural produce, as well as the genetically modified crops from the US into the Indian market, something which India has been resisting. It remains to be seen what exactly is going to be the arrangement which will be eventually worked out between both the sides, even as the government official pointed out that in case both the sides do not reach an agreement and the tariffs revert to the pre-April levels, then India will still enjoy a relative advantage with respect to other manufacturing economies, other economies which are exporting the same products to the United States, since India would be facing a lesser reciprocal tariff compared to several other economies. So clearly both the sides continue to remain in negotiations, but they are yet to be finalized as far as an interim deal is concerned.
Thank you so much for that. But let's move on. And the Fed Chair Jerome Powell will testify before the House of Financial Services Committee later tonight. And US President Donald Trump once again has lashed out at the Fed Chairman for not lowering rates. Trump on Truth Social called the Fed Chairman too late, Powell, and said that the rates should be at least 2-3 points lower, which would save the United States over $800 billion a year. He also said that he hoped that the Congress would work this dumb, hard-headed person over, as the US would pay for his incompetence for many years. And with that, we're absolutely out of time on this edition of Business Lunch on CNBC TV18. We've seen a bit of a fall coming in the markets. 25,100, just holding on to that mark right now is what the Nifty is doing. But don't go anywhere. Midcap Radar is up next.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Thoria and with me is Vivek Iyer. Well, a very good afternoon to you, Vivek. The sentiment right now is starkly different than what we had started off the week with. It's a green-looking screen, nothing to complain. Of course, there's some bit of, sort of decline from the day's highest point, but nevertheless, we're still holding in the green.
That's right. Good afternoon, Vamakshi. So cooling off a little bit from the day's highest point, expected given the fact that we are in expiry week. The Nifty cooled off a little over 150 points from the day's highest point. But otherwise, all of the indices continue to trade in the green. But we have quite a lot lined up on the show. It's an action-packed show. Let's start off with the top headlines. Stocks gain on hopes of a durable truce between Iran and Israel. PSU banks and metals are prominent gainers. Midcaps gain at par.
Defense stocks fall on profit booking following US President Donald Trump's announcement of a ceasefire between Israel and Iran. The stocks had run up significantly in the wake of geopolitical tensions.
Crude drops 8% overnight to revert to levels before the Israel-Iran war broke out. Fears over the Strait of Hormuz being closed, dissipating, also helps cool prices.
KPIT Tech points to slower deal conversions, delays in project ramp-ups, uncertain demand trends and adverse forex movements in its mid-quarter update. Spooking the street, the stock dives.
IPO Infra surges over 14% in trade after winning new projects worth over 300 crores in the domestic market. The company has also announced two major acquisitions in the renewable energy sector.
Well, the Nifty is holding comfortably above the 25,100 mark. We're seeing some bit of cool off from the day's highest point. Even though despite that, both the Nifty as well as the Sensex are doing quite well in the trading session today. The advanced decline ratio will also come up for you on the screens. So far in the day, it had been a parallel line with the, the advances much more in a number as compared to the declines. That gap seems to be narrowing slightly, but nevertheless, it's still quite broad with around 1,900 stocks advancing for almost 600 stocks declining. The mid-cap end of the market resultantly is reflecting that, up almost 0.7%. What's doing well in today's trading session is the PSU pack. All of the PSU banks are up in trade today. There are no top losers out here. Apart from that, when we look at what's not doing too well is the Nifty Media. We're seeing some profit booking on Z Entertainment. But like I said before, it's a lot of action happening in the mid-cap space. And to take us through that, we now have Hormaz, who has walked across through the wall, and he will tell us, what are the stocks that are moving around in trade. Good afternoon, Hormaz.
Good afternoon, Ramakshi. And there's no reason to complain whatsoever, even if though we are slightly off the highs of the day, especially in the broader markets. There are plenty of gainers. We start off with that. A new appointment of a managing director has sent Bajaj Consumer shares 20% higher. JM Financial has been the top gainer through the day on the Nifty 500 all through the day. Delivery is at the highest point of the day, 4% higher on that stock as well. In some of the other rebounding stocks are the rice names. They were bashed yesterday. They're seeing a very healthy rebound today. LT Foods has recovered almost everything that it lost yesterday. Chamanlal Setia too doing well. KRBL is at the highest point of the day. So good going for all of these rice names, a beneficiary of the ceasefire that has taken place between Israel and Iran. The newsmakers in today's session, IPO Infra, after that order win worth 300 crores is up 13%. Aztec Life recently approved a rights issue just a few minutes ago. It's a 12% higher on that stock. The fall in oil prices has hurt Oil India, 5% lower there, and the subdued management commentary from KPIT Tech has taken the stock to the day's low, 6% lower on that stock. Doing well on the volumes front. Poonawalla FinCorp, another high on this stock today. Titagarh out of the band, so doing well. JNK Bank among the PSU lenders doing well, and HBL Engineering gaining on high volumes. And as you mentioned, the one stock index not doing well is the defense space. Garden Reach is now down 9% after some profit booking from higher levels. BEML is down 7, Apollo Micro is down 6, Midani is down 6. So almost all of these defense stocks are bleeding in today's trading session. A lot of significant profit booking seen after the moves that we have seen over the last month and a half. Back to you guys.
Thank you so much, Hormaz, for taking us through the list of stocks that are doing or making all the moves in the broader end of the markets. Clearly, the defense pack seeing a bit of profit booking. But it's a good time to welcome Srikanth Chauhan of Kotak Securities for a technical check on the market. Good afternoon, Srikanth. Thank you so much for joining us. Well, the volatility is quite high. Nifty is cooled off quite significantly from the day's highest point. How are you looking at the markets at the current levels?
Good afternoon, Vivek. Good afternoon, everyone.
Yeah, I think, the markets are still like finding difficulties to sustain at higher levels, and it is completely depending upon the news flow, which is highly uncertain. So till the markets are not closing about 25,300, I'm of the view that the markets is going to spend time between the range. Also, it depends definitely upon the news flow, but based on technicals, I think in case if there is any correction, the way right now we are witnessing from the highs, close to 24,900, 950, the market is having excellent support in terms of averages. So close to those levels, we should look for taking some contra bets in the market, but with a tight stop loss at 24,700. Now from here onward, 24,700 is going to act as major trend deciding level. And in case if we see the market is dropping below that, then yes, we can see further more weakness. Otherwise, now the range has shifted from 24,500 to 24,700, and broader range should be 24,700 to 25,300.
Well, thanks for that, Shrikant. Vamakshi here. So are you looking at booking profits at the current levels? If not, what are the stocks that you would like to buy even at these levels?
No, Vamakshi, I think, now the market has again corrected back to 25,000 levels, and a lot of traders, in fact, those who are like trading with a very short-term view, they are trying to take contra trade around its important support levels. At higher levels, we saw some profit booking around 25,200, 25,250, and now again the market is correcting. So at these levels, we should look for taking some contra bets of going long in certain stocks, but at higher levels, certainly till the market is not closing above 25,300, we should be careful. But at these levels, we like BHEL, which is currently trading around some 262, 261. There the stock has formed classic reversal formation. It's a continuation formation that I can say based on its technical formation. And I'm of the view that now the stock is heading for again 285, 290 in next few days. So it's a buy at current levels around 260 with a stop loss at 250 and with a target of 290. The other stock which we like is Eternal, Zomato, which is currently trading around 257, 258. There also the formation is very clearly showing a lot of strength in terms of rising top, rising bottom. And based on its technical formation, I'm expecting stock to move towards 275, 280. We can keep a stop loss at 247 for the same.
Thank you so much, Shrikant, for joining us, giving us your view on the markets as well as your individual trading bets. Well, before we slip into a short break, it's a good time to remind you to tune into the all-new CNBC TV 18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV 18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV 18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m.
Welcome back. You're watching Midcap Radar on CNBC-TV18. Let's shift our focus to the housing sector. Knight Frank India has released their affordability index. The report says that interest rate cuts have boosted affordability in the first half of 2025. While Ahmedabad, Pune and Kolkata are the most affordable markets, Mumbai is the least affordable city. To discuss this and more, we now have Ghulam Zia, who is the Senior Executive Director at Knight Frank India, who is joining us now. Good afternoon to you, Mr. Zia. Historically, when affordability has improved, what has been the impact on housing sales as well as the inventory levels? If you can just outline that, and is the current scenario any different as compared to what you've seen in the past?
Well, to start with, the inventory levels have been, varying for last, if I talk about last 3 odd years, ever since the market has turned, and the sector has started performing much better for last 2-3 years, and then because of a velocity of sales improving, the new inventories that have been launched are not really keeping pace. So overall, while there was a concern of huge inventory, but whatever said and done, the inventories have been lapped up, have been selling very fast. So the velocity of sales have shot up more than the increase in new supplies that is hitting in. So overall, the environment out there is such that barring 1 or 2 cities, like for example, Bengaluru would be perhaps behaving slightly differently, and so is the case of NCR. But the rest of the markets have been pretty similar, where the inventories have not come as much to go alongside the velocity of sales. So net, what we are looking at is, again, even the fact of price rise also has been too phenomenal, both in Bengaluru and NCR. So these are 2 cities where even affordability is impacted because of that. But at the macro level, the inventory levels are not really keeping pace with the velocity of sales.
Okay, Ghulam, thank you so much for joining us. So what you're essentially telling us is that the current pace at which inventory is getting developed, you're saying that it's getting snapped up. So home buyers are actually snapping up homes faster than they can be built. Well, there's another very interesting point that you made in your report, especially when it comes to the affordability level. And you've mentioned that for Mumbai, it has gone above the 50 mark, indicating that homes in Mumbai are quite unaffordable. So especially if you could put the spotlight when it comes to the urban areas, what are the trends that you're witnessing over here? And has there been a significant drop in interest as far as home buying is concerned?
Sure. So 2 aspects here. Let me start with the affordability itself, the way we are tracking. We are doing it for last about 15 odd years. We started tracking it from 2010. And since we're focusing on Mumbai, your focus was, how unaffordable is Mumbai market. Those days, talking about 2010, the index was at 93, 94. And that has come below 50 for the first time as we are marking right now. And that is where affordability is coming in, like in spite of most of us believing that Mumbai is the most unaffordable market, but the index has been changing and it has come down from 98 to 48, 93 to 48, which means affordability for Mumbai has actually improved a lot. And for the first time, it has gone below 50 mark on the index. And on the other side, if I talk about other markets, like for example, Delhi, while Delhi still is at 28%, much more affordable than Mumbai, but then that's the only market where affordability has actually worsened. It used to be about 25 or 26 mark till about a couple of months back. It has gone up to 28%. 28 on the index. So if you look at the rest of the cities also, while as you rightly said, 2 or 3 cities are always very, very affordable, like Ahmedabad, Kolkata, and even Hyderabad for that matter, while the prices have shot up a lot in Hyderabad, still the affordability levels are much, much respectable. However, Mumbai is one market which has breached all that. For last 15 odd years, it has been continuously falling in terms of affordability. Well, the reason is simple. Now coming to interest rate that you spoke about in the second part of your question, interest rates do have a huge impact, because when we talk about this index, affordability is a part of how much do you have in terms of wealth and your ability to raise EMIs every month. So the EMI, the value that you can set aside for EMI has improved a lot with the interest rates coming down. So while we are talking about 100 bips of a cut from the RBI side, while it may not have completely populated down to all home loan seekers, but that 100 bips correction has had a huge impact. And that impact is where, today if I'm talking about Mumbai going down by 2 percentage points, 200 bips, within a matter of about a month and a half or 2, the reason is simple, because a home loan becoming cheaper and affordable, direct impact on the affordability. So overall, this is the scenario. While the NCR is the only market where affordability has actually worsened, the rest of all the markets, affordability is improving.
Well, Ghulam, your report also mentions that affordability is at the best levels that we've seen since the pandemic. So, in terms of the supply side, let's talk about that because, of course, demand is doing quite well, like you pointed out. So, from the supply side, is the mix now expected to change because it is actually the lower end of the consumer which benefits from lower interest rates? So, will the mix of launches that comes from developers now lean more towards the mid-income, the affordable segment, because all of these lower-end segments were impacted?
Well, first to start, let me just put the things in perspective. First of all, the upper end of the market that we always talk about is very significantly visible in Mumbai and Delhi a lot, and to a certain extent even in Bangalore. However, the mid to lower end of the market is somewhere impacted because not many developers are catering to that, as we have been noticing. Most of the known and listed players have exited the affordable segment per se, which is the lowermost segment of it. But the mid-end segment has always been thriving and doing well. While super luxury is the only one where most of the press captures, the per square foot rates, etc., are spoken about a lot. But the mid to upper end is the market where most of the developers are present and bringing in lots of inventory in that segment. However, the lower segment, as you're talking about, which is more prone to any impact or dynamics of interest rates, is that sector where none of the listed players or known developers catering to or bringing in any inventory. And that has had a severe impact at the bottom end of the market where affordability matters a lot. You're very right when you said that this is a segment where interest rates really matters. But in that segment, none of the known developers are catering to the requirements, and that is a big issue. There's a big risk that we're facing because of Pradhan Mantri Awas Yojana 2.0, which was kicked in in about October 2024. After that, huge interest has generated in the lower end, and with the home loan interest rates coming down, overall a double whammy where the bottom end of the market is actually expected to come in hordes. But for want of any proper inventory, we are feeling that it will have a significant impact with prices shooting up in that segment, and that's a big risk that we're facing right now.
Well, very, very interesting insights there, Ghulam. Thank you so much for joining us, giving us a view of how affordability is panning out, especially as far as the residential real estate market is concerned. Well, we'll now slip into a short break, but before we do that, some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Let's pull up the chart for Nifty. The intraday chart will show you that since 1 p.m. the index has seen significant pressure. For now, the index is off nearly 250 points from the day's highest point. The mid-cap end of the market is also seeing some bit of selling pressure creep up as well. The intraday chart will come up for you. There you see around a 300-point cool-off from the day's highest point, and some stocks that are actually taking it to the chin includes PB Fintech. The stock has seen a fall of almost 2% from the day's highest point. It was trading in the green at the start of the session, but it is now trading close to the day's lowest point. The next stock that we're also keeping an eye out for is BSC. The stock too, started off in the green, is fairly in the green for now, but has seen a fair bit of cool-off from the day's highest point. But there is one stock that is standing out, and that is IPO Infra. In our special segment, Midcap Spotlight, Vivek will focus on this company. And, Vivek, why is this stock up and away in trade today in an otherwise, sort of wobbly market?
Well, thank you so much for that, Vamakshi. First up, let's understand what IPO Infra does. Well, largely similar to what a Wartech Wabag does, but much smaller in terms of scale, size, scope, but very similar. Water desalination, water filtration is what the company essentially does. Company has said that in FY26 so far, they've won 3 orders, and this is from 3 separate municipal corporations. The total value of all of these 3 orders is slightly in excess of 300 crore. So what is the scope of the order? The company will do both EPC as well as do O&M, which is operation and maintenance, for 15 years. So the 3 regions from where the company has received these orders are Ambikapur, Rajnandgaon, as well as Korba. And in all of these places, the company will give various specifications, but all of them will pertain to various millions of liters per day that they will have to filter and give to the municipal corporation. Along with that, the company has also announced 2 interesting acquisitions, and this is in the renewable energy space. First up, the company is going to acquire Vento Power Infra Private Limited. This is a small 40 megawatt solar power project. It's in Odisha. Company has received this particular project from PTC India Financial Services, and this particular project already has a PPA in place. It's for 4.1 rupees per unit, and this particular tariff is for a period of close to 18 years. Along with that, they've also received a 29 megawatt solar power project in Maharashtra, and again over here, if you look at the tariff-based revenue, 0.88 rupees per unit for the next 25 years. So 2 interesting renewable energy acquisitions where the PPAs are already in place. Remember, at the end of FY25, the company had an order book in excess of 1,100 crore for the projects, and O&M order book of over 800 crore. IPO Infra doing very well today. Strong volumes. That stock at one point of time was up over 14%. Continues to trade with gains of over 12%. But with that, and with the news that the markets continue to be quite sluggish, especially in the last hour, you're actually seen most of the markets cool off a little bit from the day's highest point, continue to remain in green territory, but have cooled off quite significantly. But with that, it's all the time we have on this edition of Midcap Radar, Mutual Fund Corner, when we return.
Hello, good afternoon. You've tuned into MF Corner on CNBC-TV18. I'm Vinny Motiwala. Thank you so much for tuning in as always. Now today what we're going to be doing is we're going to be taking all those mutual fund related queries that you all have sent us. Given that there's so much uncertainty happening around your portfolio, how are you all looking at that? What are the changes maybe that you all need to make? We have our experts joining in with us to help you all with just that. We have Prableen Bajpai, founder of FinFix Research and Analytics, joining in with us, as well as Nirav R. Krukera, head of research at Wisdom, to answer all your mutual fund related queries. Prableen as well as Nirav, good afternoon and thank you so much for joining in with us. Let's just get started with the queries for today. The first query for today we have is coming from Gautam, writing to us from Mumbai. He wants to know the best way to buy silver and copper in mutual funds. Prableen, that interest for commodity side has really picked up pace now. What is your view coming in on this one, and how should they be looking at investing here through mutual funds?
Definitely mutual funds is one of the best ways if you want to take exposure to any of the precious metals. But sadly, Vinny, at this point, we only have two available options, which is gold and silver. In fact, till 2021, there was no silver ETF as well. Only in last of 2021, SEBI approved silver ETF, and 2022 January, we saw ICICI came up with the first product, which was the ETF NFO, which came up. So if Gautam is looking to invest, of course, a silver ETF or FOF, if he wants to do an SIP, is, I think, one of the seamless and best ways to take exposure. Over the last 3 years, silver has delivered roughly 19.5% returns. In the last 1 year, about 17.5. In last 6 months, of course, it's gone up by 20%. So like you said, Vinny, that the interest has definitely gone up, but I would say that silver should be taken as a more tactical call rather than part of the core portfolio. Probably gold is more suited for that. But for gold and silver, both which are currently available for investors, I think they must be wary of the recency bias because of the great movement which we've seen in these metals. And currently copper is not available. And just to give word of caution that during this period, since the first ETF was launched, silver ETF in itself or the FOF, they've seen a fall of roughly 28% was one of the falls, which was March to September 2022. Likewise, 16% fall in 2024. It's gone through. So even in this short time period, 3.5 years period, there have been falls. So whosoever is investing, I would say that taking exposure in tranches through an SIP model would be most ideal.
Okay. Thanks for the view coming in there. Let's move on to the next query. We have Shanmukh, who's writing to us from Hyderabad. He has invested in Axis Long-Term Equity Tax Saver ELSS scheme and Aditya Birla Sun Life ELSS scheme as well. He wants to know if he should continue the SIP or switch to systematic withdrawal plan. Nirav, what's your view coming in here, right? Given that, if you're now attempting for the new regimes or the change in taxes that you're seeing, how much sense does it make to still continue with this ELSS plan for them? And what should they continue this SIP or maybe just move to a systematic withdrawal plan?
So it's a common dilemma that most investors have been speaking to us about. And the beauty about ELSS is that the benefits are three-faceted. The most commonly known dimension is the tax-saving dimension, which may not be applicable to those choosing the new tax regime. However, there are two more benefits of investing in an ELSS fund. Of course, the funds that Shanmukh has picked are pretty decent funds. They have a good track record and it has been able to perform consistently, even on a risk-adjusted basis, right? So the other two benefits that I was speaking about, and which builds the case for Shanmukh to continue his SIPs. One is the discipline it enforces. So if you're a long-term investor, but you're not really sure about your own discipline and commitment to investing, the 3-year lock-in holds you in really good stead. And the SIP ensures that every tranche or every investment stays for at least 3 years. So that way you experience some part of the compounding effect. So that's the second dimension. The third important dimension of ELSS funds is that the lock-in also gives the fund manager the visibility for how long does he have the funds for, right? So this, in fact, enables the fund manager to deploy and invest much more effectively without bothering about holding on to some cash to manage redemption flows, right? So the certainty of timeline for which the fund is available and available to be deployed ensures that it is put to much more effective use than most other open-ended mandates.
Okay, probably in your view, coming in on here, both these funds that they are holding as well, Access long-term ELSS as well as Aditya Birla Sun Life also tax saver ELSS scheme. What are your thoughts here? SIP or switch to SWP?
So definitely, Winnie, that equity exposure is so important as part of your long-term portfolio. So if these are the only holdings he has, and even if he's looking to withdraw or move out, he must start something in equities. Within the category, Axis and ABSL have not been amongst the toppers. They've been okay in terms of their performance on rolling return basis as well as SIP returns. If we see amongst 5 and 7 years, they are in the sort of lower end of the curve where the returns aren't that great. But if if this was a choice over and above a fixed income product, he was still smart to take exposure to ELSS because, of course, with equity taxation, the benefits that it's giving, he's still better off. But if he's looking to continue in ELSS, I feel that there are better options available given the highest and the lowest returns on 5 and 7 year return basis. Also, I would say that the schemes don't look great even on rolling return basis. So he can choose if he's really needing the tax savers in his portfolio. Otherwise, he should move out and have regular open-ended equity funds for his long-term equity portfolio.
Okay, thanks for the view there. Let's move on to the next query. We have Ronak, who's writing to us from Jaipur. He says that he's currently invested in mutual funds and has accumulated close to 21 lakh rupees, and this is via SIPs. Now, most of his SIP tenure are coming to an end, and he wants to continue investing. He's saying that his main objective is to create wealth with no near-term need of any cash and can invest till his retirement. So he's looking to invest 1 lakh rupees on a monthly basis. How should they go about this? Nirav, firstly, your view.
Yeah, so so I'm assuming you already have a core portfolio, right? And for the investable surplus, a generally good way to go about it is to split the investment into a core and a satellite strategy. This gives you a lot of clarity in terms of how do you want to manage both sections of your investment. So one, you have a primary corpus. Now within this 1 lakh, you can sort of create a core portfolio of around 60 to 70 odd percent, wherein you take exposure with a much more longer term view with flexible mandate funds, right? You can choose very good funds belonging to the flexi cap category, to the multi cap category. There are focused funds, value contra funds, right? So a combination of these funds in the core part of the portfolio would be a very good idea. And on the satellite part, you may want to take some amount of satellite bets. Like for instance, you can add in some amount of gold into your portfolio over a longer period. Gold has been known to add an effective hedge. It is a low correlation asset to equities. You must have some of that. If you have certain aspirations for yourself or for your family, wherein there are dollar-linked expenditures coming in, you can utilize the satellite portfolio to take exposure to global and foreign stocks. You can take slightly more aggressive bets where you may need to be more attentive into mid and small cap funds, wherein it is a much more highly aggressive bet. You need to be very selective with the funds, but the compounding effect would be much more stronger over here, right? So this is a primary approach you can take for your incremental 1 lakh rupee investment. That should hold you in good stead.
Absolutely. I think, they do have that core portfolio in place as well. Probably, they have some of these names like Axis Tax Saver, Kotak Emerging Equity Fund, there's a Flexi Cap Fund, they have Tata Digital India Fund as well they've invested in. So what are your thoughts coming in and what should the viewer do now?
Just a bit on his goal, Vinny. First, he's 32 and he's saying that he has a portfolio of 21 lakhs and looking to invest 1 lakh a month. So if he continues with that, and let's say he would retire at 55, then he would be able to create 17.5 crores with that, assuming only 12% ex-IRR. And if we are looking at a 60-year retirement age, let's say, which is a 28-year horizon for him, then he can create about 32 lakhs, which can be great. And if he and his wife together are able to do a bit of a step up, then they can create a very good portfolio, a good corpus for themselves for their retirement. Coming to the funds, he again has two tax savers. Of course, Quant has performed well. Axis, I think, can definitely move out. So can Quant if it is not required for tax saving purposes. He can have clarity in terms of, like Nirav mentioned, what should be the core and what should be the satellite. I would also suggest, since he has a 20-ish year horizon, I think some passives should be added. So I would recommend adding a large cap passive fund, which is the Nifty 50 equal weight strategy. Gold, I would agree, should be added to the portfolio. I think sectorals can be skipped at this point, especially something like digital fund, which is a very small theme that he's taken exposure to. And I think if one of them has actively managed mid-cap, then probably a passively managed mid-cap can be there in the other portfolio. And I think both of them can have one flexi cap each.
Okay, that's a view coming in there. But on that note, we are going to actually sip into a very short break, viewers. Don't go anywhere. We still have a whole host of queries that you all have sent us, and we'll be doing just that and answering all of that after the break. Welcome back to MF Corner on CNBC-TV18. Today we're solving all those mutual fund queries that you all have sent us, and to do just that, Prableen Bajpai as well as Nirav Karkera are here with us. Let's move on to the next query. We have Sailesh Singh, who's writing to us from Ahmedabad. He has been investing in a couple of funds through SIP, and one of them is a Mirai Asset Large Fund, Large and Mid-Cap Fund. And since the performance of the fund has dropped in the last couple of years, he has stopped his investment and is planning to redeem the investment redeem and invest it in another fund. His current gain is around 4.5 lakh in this fund, and if he redeems the entire corpus, he will be charged that LTCG, that is there of 12.5%. So he wants to know how is it advisable to redeem the entire, is it advisable to redeem this entire corpus and pay LTCG or stagger the redemption over the next couple of years? Nirav, your view.
So one thing for sure, the fund has been, hitting a speed bump in terms of performance. Of course, the past 1 or 2 years has not been looking really great for the fund. So having said that, one thing to understand is every fund goes through cycles, right? The fund has a longer track record. It is definitely facing a few problems, but it is important to see if the speed bumps are due to fundamental changes in strategy. I feel the much bigger point to address here is, twofold. One is the taxation bit, and second is if he should move out of the fund as he's moving closer to retirement, right? So number one, talking on the tax bit, definitely 1.25 lakhs per annum is exempt. These qualify for LTCG, I'm assuming. So one, it definitely makes sense to stagger the withdrawal, if possible, through a couple of years so that the capital gain incidence is as minimal as possible. Two, the more important point is not choosing between this fund and another large and mid-cap fund, but the fact that as you close towards retirement, you must slowly and gradually de-risk into non-equity assets or lower equity exposure assets, like possibly hybrid funds or a combination of debt funds, arbitrage funds, right? So the decision needs to be made at these two levels. So probably a staggered redemption to lower tax incidence and a subsequent reinvestment into lower equity exposure funds should hold you in good stead.
Okay. The next query for today is coming from Nag, who's writing to us from Hyderabad. He is planning to hold his mutual funds for 15 years and is expecting around 2.5 crore rupees for 15 years. He started investing in weekly SIPs from Jan 2025 and stopped it in April 2025. He's spoken about some of the funds he's holding as well. PPFS Flexi Cap, HDFC Flexi Cap, Nippon Large Cap is there, Motilal Oswal Mid Cap, and some of the other names are there. So he's asking if you could review the portfolio and suggest what levels could they add more small and mid-cap funds, and could you also suggest if he can add any more mutual funds in the portfolio to reach that goal that they have of 2.5 crore rupees. Prabhneen.
Yeah. So Vinny, to reach this goal of 2.5 crores in 15 years, if you're assuming 12% returns, firstly, what is the SIP required? That would be roughly 50,000 a month. So he hasn't mentioned what is he doing currently, but 50,000 is what is required on a monthly basis for his goal. Then, he's saying that he has stopped his SIP, which is just about 4 months after his starting. So the very idea of an SIP, I mean, it's the principle, the premise it's based on is rupee cost averaging. So that you don't need to time the market, you don't need to see the levels where and at what levels you're investing. Having said that, of course, if we feel that, let's say, mid or small caps have run up a lot, you can definitely reduce your exposure via SIPs, probably increase your exposure in large cap SIPs. But at the same time, you continue with that monthly investment or probably whatever weekly he's doing. So if he's trying to time it, Vinny, it kind of defeats the very idea of doing an SIP. So I would firstly urge him to continue with his investments in a manner. He's got a 15-year horizon. There will be periods when large caps are overvalued, periods where mid and small caps are overvalued. So I think you should just continue with his investments in a planned manner. And just to give an example, over the last 10 years, if we see the mid-cap index alone gave us like the 20th till 20th June kind of period, if we see 2015 till now, it delivered 20.01% returns, XIR or SIP returns. And Vinny, during this period, the mid-cap index has fallen, in absolute terms by 44%, by 21%. Again, it has been fall since September 2024 till April. It fell by around 21% almost. So there have been so many periods where there have been these huge falls and then markets recover. So I think the very idea of trying to time can be futile. And what he should do is move in a with a set portfolio and in a disciplined manner. And definitely he should reduce his small caps from 3. If he wants to keep probably 2, although 1 is good enough. and remaining funds look good for him.
Okay, thank you so much for helping with that. Next query for today, we have Balaji is writing to us from Tamil Nadu. He's invested 24,998 rupees in SBI Quant Fund regular plan, growth plan. And he says that the performance has not improved in the last few months. Wants to know if it's a good fund or should he exit. What should they be doing with this, Nirav, now?
So at the very outset, SBI Quant Fund is a part of, the quantitative strategy. There are very limited funds out there in the industry that follow a pure quant model. And SBI Quant Fund is one of those. It is the performance, the lackluster performance is not isolated to SBI Quant Fund. In fact, all the funds in the category have been really struggling to perform. I feel there is a longer journey before quant models really start performing. But that's a story for another day. Up immediately for Balaji, the idea is to, perhaps try and reallocate to much more effective categories, possibly ones that operate with a much more flexible mandate. There are very good flexi-cap funds available. There are very good multi-cap funds available. Some of the names in flexi-cap that you may want to explore include the likes of Parag Parikh flexi-cap or DSP flexi-cap fund. In fact, there are a few focused funds also. Now, considering you invested in a quant fund, you might be looking for slightly more aggressive strategies. So a 361 focus fund could be a good bet even there, right? So it does seem like a good idea to move out of quant funds because the models are also susceptible to underperformance during, singular and narrow rallies in markets.
Okay. Next query for today coming from Sumit, who's saying that he wants to know if it's advisable to make an investment in balance advantage funds for a period of 4 years, next 4 years, and also if yes, which fund should he look at right now? Prableen?
Definitely, Vinny. I think balanced advantage funds, and I'll also add multi-asset allocation funds, they can be quite ideal for an investment horizon of 4 to 5 years. And it's kind of the best of both worlds thing where they're trying to protect the downside while giving you decent returns when the market rallies. So in the September to April fall, when Nifty fell by about 15.5%, some of the good multi-asset and balanced advantage funds were able to contain the fall by just about 4%, 5%. Some of them fell by about 8%. And of course, there have been more, but then you have to look for the ones which are which we have been able to protect the downside over different falls. White Oak, multi-asset, Parag Parikh, dynamic asset allocation, in fact, were like slightly in positive. ICICI multi-asset, SBI, HDFC, Nippon, I think some of the good fund houses from where he can look at these funds. So he should consider both balanced advantage and multi-asset and have expectations of around Nifty 50 returns over this time period.
Okay. Nirav, I know this is a long query, but one short query that is coming. Best small cap fund to invest in for 10 years because we're absolutely out of time and the viewer really wants the answer.
So I'll directly move to the best fund. So, we have our own FISDM ratings. As per that, Edelweiss small cap and Bandhan small cap stack up across most parameters.
Okay. Thank you so much for that. Thank you so much, Prableen, as well as Nirav. There were a whole host of queries that are still left. But thank you so much, viewers, for sending us your queries as well. Keep sending them us. We'll take it once in a while as well. And thank you so much, Nirav, as well as Prableen, for joining in with us. But with that, we are out of time on this edition. Don't go anywhere. Up next, your closing bell.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Taiwanese index is trading with gains of close to 2%. The Hang Seng trading with gains of 1.5%.
Donald Trump has said that a complete and total ceasefire between Israel and Iran will go into force.
The Nifty 25,222 is the resistance level. 25,170. Nifty Bank is up about 0.8% as well, I think.
25,200, we're managing to hold on to that, so it's a good take up again. And broader and also doing well like yesterday.
July 9th is a tariff deadline. That is something that the markets will watch out for.
The domestic value addition criteria under PLI scheme may also be considered.
Our job is to provide as many avenues as possible.
15% duty as opposed to 100% duty that exists currently.
Well, the Nifty is holding comfortably above the 25,100 mark.
Good afternoon. Welcome to the last hour. What's been a very, very interesting trading session. We started with a bang. The markets have cooled down a little bit, but green is still very much the color. And can the bulls hold on to the day or not? We'll have the answer in the next 1 hour. This is Closing Bell. I'm Surabhi Upadhyay, and as always with me, Nigel D'Souza. Hi, Nigel.
And we're coming to you live from the CNBC-TV18 Motilal Oswal studio as well. Well, Surabhi, it's been a good trading session, till the last, I think, 90 minutes or so. And from there on, you've seen the markets give up some part of those gains, which is a little bit disappointing. The hope is in the next 60 minutes, there is some kind of a fight back. And hopefully, in fact, we can end with better than what the screen is indicating right now. The Nifty Bank actually has come off considerably. I think that 56,350, 56,400 mark, it's crucial that we close above those levels.
No, absolutely. Take your point. The thing is that a lot of the global markets are still trading with, a great amount of enthusiasm. Look at European indices right now. The German market almost 2% higher. The French market over 1% and a quarter. Most of Europe stock 600 also over 1% higher. US futures are still up and about. They're pointing towards a solid start, 1% higher. So compared to this, global feel good that we have, and oil prices, let's just pull up oil again. Brent continues to be below $70 a barrel. So the global backdrop is still okay, which is why, you can argue that the fact that we've kind of fizzled out on the momentum, started with a 250-point gain and now fizzling out at the headline index level, that doesn't look too great. But it's okay. Maybe markets just digesting the gains. The mid-caps are still doing better. And the watch point going forward, by the way, I've been saying that in the morning as well, that as some of the geopolitical headlines from West Asia settle, the focus is going to get back on trade and what's happening with the trade deals, etc. And that's where I think, a couple of issues which are up for debate with respect to the India-US trade deal. But having said that, I think mid-caps are still doing quite okay. So not too bad.
Well, that's right, Surabhi. But the crisscross lines as well, if they come up for you on the screen, they've gotten a little bit closer than what they were, say, a couple of hours or so ago. So we still have the breadth of the market. That is near three stocks advancing for one stock that's declining. But that's narrowed a wee bit. How do you position yourself, though, in the final hour of trade? Mitesh Thakkar is back with us. Mitesh, what's your call? I think the call earlier this morning was buy the intraday dip. The intraday dip actually has been sharper than expected, I think so. But what's your view from here on the Nifty as well as on the Nifty Bank? Okay, all right. I think we'll get back to Mitesh in just a bit. We'll get that connection going. Is Mitesh back? All right, we'll try to reconnect with Mitesh in the next few minutes. But just quick check on the markets on a few stocks that are moving around, particularly the ones that have moved in this hour itself. GE Vernova, I think that stock, now it's up close to around 5%. It's locked, I think so. So GE Vernova, I think we should get that stock up for you in the screen. IOL Chemicals, that's another name that's moved higher. It was already up, but now it's moved a wee bit higher in the last few minutes. I think we should get that stock as well up for you on the screen. But the story of the day has been the sharp downtick that we've seen in crude oil prices. The question is, how does this crude oil price correction impact the stock market?
Sudarshan joins us to decode all of that for us. Sudarshan, tell us more.
So yesterday's high for Brent was $81 per barrel, and today it's trading below $69 per barrel. So a fall of more than almost $12 per barrel from yesterday's high. So how does it impact to our company? So basically, in layman term, it's positive for the users and negative for the companies which produce crude. So first, it's negative for upstream oil companies like ONGC and Oil India. So if there is a fall of $1 in crude price, it impacts in the range of rupees 300 to 400 crore to the annual revenue of these two companies. But in contrary, it's positive for OMCs, or say oil marketing companies like IOC, BPCL and HPCL. So a fall of $1 per barrel in the crude price impacts positively in the range of rupees 200 to 300 crore to the annual EBITDA of these OMCs. Now, apart from these oil and gas companies, fall in crude is also positive for those companies for which this crude is like input cost. For example, paint companies. For paint companies, up to 50% of their input costs are linked to crude. So if there is a fall in crude, it basically their raw material costs come down, and that has a positive impact on their margins. Lastly, fall in crude is positive for airline companies because for them, aviation turbine fuel is one of the major costs. So if there is a fall in crude, aviation turbine fuel cost also will come down. That's the reason you are seeing a divergent move in these stocks, while ONGC and Oil India are trading with cuts, and these paint companies, OMCs and airline companies are trading higher.
Okay, all right, got that. So crude indeed, the big headline of the day. Thanks very much for that, Sud. So those are, of course, the oil and gas names which are in focus. We've got Ashish Chaturmota joining us on the show this afternoon. He's, of course, from JM Financial. Ashish, great to have you on. I'm talking to you after a long time, so good to connect again on air. Let's start right there. I mean, oil and gas has been making all the headlines. Any specific, either tactical trades or any other sort of investment calls in this space, whether it's at the upstream side or the downstream side?
Hi, Subhi. Thanks for having me on this show. So, definitely falling crude prices, obviously, there are some direct beneficiaries, but also if you look at in general, it's going to be very positive for the economy, which is 80-85% dependent on crude oil imports. And obviously, this is to do a lot with the inflation. Obviously, our retail inflation has hit a six-year low, which is close to 2.82. But rising crude prices could have changed the entire dynamics of inflation. But now, since crude prices have started correcting, this is going to be a further positive for India as an economy. Definitely from a tactical bets, obviously, the aviation space looks the most promising, bet in this, because if you look at, ETF prices, if they remain down or they remain low, then obviously the profitability of most of the aviation companies becomes in a significant manner, and particularly Indigo, which has got almost 60% market share in this segment, and adding a lot of more aircrafts obviously is going to see a bigger advantage of falling crude prices. So we have seen a structural leadership position which Indigo has maintained in the Indian market. And also if you look at from a world perspective, Indigo is now the third largest company in terms of airlines by its market capitalization, because of the increased profitability, low cost which it has maintained over a long period of time. And now crude oil correction will be a big positive. So yes, Indigo looks very, very interesting. From a technical perspective also, if you look at, the stock has been continuously making a higher structure and has been in a structural trend. So looks like it is going to move towards 6,000, 6,200 zone. As a disclosure, we may continue to hold this stock in our portfolio Apex PMS strategy as well.
All right. Hi, Ashish. So InterGlobe is a stock that you like. What about hotels? Anything you like out there?
Yes, definitely, Nigel. So we think that, ITC Hotels is a stock which looks very promising, because if you look at, this company is also trying to do a lot of asset light, model, and obviously 90% of the incremental capacity which ITC Hotels is bringing, it's on the asset light basis, which will ultimately lead to a 450-500 basis point jump in the margin profile of ITC Hotels. And if you look at from a valuation perspective, it is trading at 25 to 30% discount to its peers like Indian Hotels. So I think this discount is going to get narrower, and this will ultimately lead to a re-rating in ITC Hotels because of because of the valuation gap, and obviously because of the jump in margin expansion, which this company is going to witness because of asset-light business model. So we are expecting this stock to be somewhere close to 260, 270 is our broader target, which we have for ITC hotels, and we continue to hold this stock in our portfolios as well.
Got it. Okay, all right. Interglobe and ITC hotels. Ashish likes both of them. Let's focus on a couple of other names, essentials that is. We have Page Industries and Nykaa. They're in focus. We have brokerage notes that are coming in there. Mangalam joins us to tell us about both these two names. Mangalam, tell us more.
Well, one makes you look good from the outside, one makes you feel good from the inside. That's what we said about Nykaa and Page Industries, right? So Nykaa is in focus because CLSA has initiated coverage. They have an outperform rating, a target price of 229 rupees. They say that the beauty market is good, and in that, Nykaa's market share is actually quite compelling. And add to that, they have potential to grow in high teens over the next 5 years as well. The only fly in the ointment is Nykaa Fashion, which has not grown as fast, and they believe that, the differentiation here is very little given the crowded space and Nykaa's late entry out there. But they believe that the beauty business can continue to, support the growth of this business so long as fashion drags limited. So you have growth and profitability for the beauty business, which will be key drivers, which would lead their EBITDA expansion by almost 310 basis points over the next 3 years. The other risk that they put on the table is slower than expected growth and faster scale-up of competition. Nykaa is lower in today's trading session because if you look at the last few days, the stock has been buzzing around. So maybe some bit of profit taking that's taking place out there. Page Industries, on the other hand, Goldman Sachs likes the company. They say that it's a buy and a target price of 52,000 rupees because they've done their analysis across all the listed players, and they believe that, the listed innerwear players have seen their inventory levels come down. So industry level inventory is normalized, which implies the next 5 years hold better growth prospects than the previous 5 years. For Page Industries, they expect about 12.2% CAGR in revenue. For perspective, the last 5 years, it grew at around 8%. So that's growth. And not just innerwear, you have outerwear doing well as well, which they believe will see consistent recovery and growth. And one of the drivers for outerwear segment will be the company adding nearly 200 to 250, exclusive brand outlets every year for the next 3 years. And it is in exclusive brand outlets where outerwear sells more than innerwear. And outerwear, of course, has a higher value and higher margins as well. So these factors working for Page Industries.
I don't think I could have ever drawn that connect between Page and Nykaa in that creative way.
I never said, what is what. I just said one makes you look good, one makes you feel good. You make
the inside and the outside. Very well put. I mean, absolute full credit to you, Mangalam.
Mangalam, I'm maintaining silence.
I'll keep quiet too.
All right. But Mangalam, all eyes on the test match as well. You think we have enough in the fuel tank? Bumrah is going to be leading the way. Can we knock the 10 wickets out?
For us to knock the 10 wickets out, you have to have some support coming in from Siraj and Prashid Krishna as well, and maybe a couple of spinners getting a few wickets in, because Bumrah, all the heavy lifting that he's doing, his back is strong, but you want it to be supported by all the other muscles as well. So that's Bumrah leads from the front, but others have to support.
And I think we're teasing them with that target, right? It could look gettable if they go for it. Maybe, in fact, they'll make a mistake. And I know from all the years we've been working together, we're both optimists on Team India.
Always.
So let's hope by tomorrow we're celebrating this victory.
Let's hope that.
Thanks a lot for that, Mangalam. Ashish, you heard what Mangalam had to say with regard to feeling good, looking good, etc. But what's your view on both these two stocks, Page Industries and Nykaa? Do you like either of them? Would you stay away from them? What's your take?
Nigel, we are staying away from both these names. The reason being, if you look at Page Industries, it has been it used to be all-time favorite for the institutional money. But if you look at the current data, clearly at 60 trailing PE multiple, this stock looks little expensive for the kind of growth which it is witnessing. So if you look at the top line growth, it's in the range of 8%. The profitability growth is hardly 10 to 11% for last 3-year CAGR. So with this kind of growth, if you give a very high PE multiple in an environment where a lot of competitive intensity is coming in, it looks a little difficult, for us to get a clarity about what kind of PE multiple re-rating or EPS expansion is going to take place. So we would like to stay away from the name at this point of time. So Page Industries is an avoid. As far as Nykaa is concerned, I think in the new age businesses, we are more comfortable with players like, Eternal or even Swiggy, where at least we know that, the burn on the dark stores has been coming down. In this quarter, we have seen a significant drop in the dark store additions. So this will ultimately lead to strong EBITDA margin and margin expansion. At least profitability is visible in next 3 to 4 quarters. So my sense is, if you want to really play the new age businesses, then I think players like Eternal and Swiggy looks more interesting.
Okay, so Eternal and Swiggy when it comes to new age businesses. Got that, Ashish. By the way, speaking of some more stocks in news today, let's pull up KPIT Tech. Now, KPIT Tech has been sounding cautious on its business. It did a mid-quarter update. And that update is not too promising. Stocks down 6%. Basically, they're saying that deal closures are taking time. Ramp-ups are also getting delayed. So not sounding too impressive. And therefore, the street has taken a cautious view on it. I don't know if you caught this or not, Ashish. Any interest in KPIT Tech? Anything else? I mean, overall also gives a view on IT if you're advising a buy on anything.
So overall, discretionary IT spending is in a trouble zone, Surabhi, because if you look at the global macro environment is still not very conducive. We are not sure about the global growth. Obviously, this will put a lot of pressure on the corporate spending, particularly on the discretionary IT spending. So this will make sure that IT as a sector might underperform. There would be outliers, maybe stocks like OFSS, which is a proxy to the cloud transformation, could be a good play, or maybe a player like Persistent or Coforge, which are playing heavily on the BFSI segment. So at least these BFSI is a segment which is doing very well. So maybe these are the players which might do better than the peers. But overall, IT as a sector looks a little nervous, and particularly the ER&D players, because we have not seen meaningful guidance coming from the OEMs across the globe. So I think maybe it will take some time. So at least in the medium term, we are not very hopeful about ER&D stocks seeing recovery, and particularly stocks like KPIT, Tata Elxsi, they might continue to remain in a range.
Got it. All right. I wanted your view actually on the telecom space because Vodafone Idea, that stock is higher in today's trading session. This after Communication Minister Jyoti Aditya Scindia had spoken out against duopoly in the telecom sector as the company's struggles continue. Let's listen in to what he had to say, and then we go to Ashish for his view.
Today we have fiber, we have broadband, we have Wi-Fi, we have mobile, and soon enough we will also have satellite. Our job is to provide as many avenues as possible, and within each vertical as well, provide intense competition. It's not good enough having a duopoly or one carrier or two carriers. You must have competition in every sector. India today is probably the only country in the world with 4 telcos.
Ashish, what do you factor in? The minister clearly says doesn't want a duopoly, so that would be good, some hope actually for Vodafone shareholders as well. What do you think? You have, the appetite enough, risk reward with Vodafone at around this 7 rupees odd, or will you stick to the large names, Bharti Airtel, Reliance Industries? Your take.
So Nigel, definitely we would stick to the quality names where the proven track record is there, and we know that the incremental journey is we are going to witness almost the ARPUs going up. So this will ultimately benefit not just Reliance or Bharti, even including the entire sector. But it's not about just ARPUs; it is about the market share gain due to different services which one is going to launch. And obviously, we believe that both Reliance and Bharti are in a position to have this kind of leadership position in not just the telecom, but also into the other services. And that's the reason we believe that we would like to be overweight on stocks like Bharti Airtel, where at least we have a very clear focus about ARPUs going up, and there's a market share gain which is continuously happening. So our top pick in the space would be Bharti Airtel. But yes, this is not just today. We have been witnessing this trend where we don't want to have just two players, and that's the reason a lot of support being given to Vodafone, and even there's a lot of focus on BSNL to revamp BSNL. But eventually it's about the market share gain, and that's where we believe Bharti will take the lead.
Okay. All right. So that's a view on telecom stocks. Ashish, you give us some ideas when we've been throwing a lot of stocks and newsmakers at you, but it's an interesting market. I mean, even today, as I look at it, we started with such a flourish. It was the perfect day, but the index is not able to punch through the 25,200 kind of zone. What's the sense overall on the market? And, give us some ideas, because midcaps are still doing okay.
So, Subhi, we are still very positive about market. Yes, we have seen some kind of intraday dip coming into the market, but eventually, we have to witness that, in the last 3-4 months, despite in India-Pakistan war, Iran-Israel or crude prices going up. Despite all this, we have not seen nervousness in the Indian markets. And also, if you look at the stability which rupee is providing, it gives a clear signal that markets are in a very strong hands, and we continue to have a positive view. Now, as far as sectors and individual bets are concerned, we believe that the entire financialization of savings as a theme would do very well. Since if the interest rates are going to come down, a lot of money is going to get into the financialization of savings, and we believe there are direct and indirect proxy to play this. So KFin Technologies is one play which we currently like because of its a kind of very strong leadership position. So KFin Technologies is something where we believe that a good 20-25% upside could not be ruled out from current levels. So this is one stock within the capital markets theme. MCX is one theme which we really like because we believe that hedging and gold, silver, these are going to be in a very strong uptrend. So there is going to be a lot of trading volume activity which is going to happen at this commodity boost. So I think MCX will continue to do well, and now electricity derivatives are being introduced in MCX. So this is again a good, I would say, optionality for MCX to get re-rated. This is one space we like. Individually, we like CDMO as an opportunity because we believe that if the overall pharma space is going to grow at 7-8%, then CDMO has a potential to grow at 17-18%. And within that, Laurus Labs is one stock which looks very promising, where a lot of capex has been done in the last 3-4 years. And I think going forward, we are going to see this asset turnover going to improve for a company like Laurus Labs. Technically, this is a 3-year consolidation breakout which is happening. So all this clearly indicates there is a decent upside which could be seen in stocks like Laurus Labs.
Got it. Okay. All right. Thanks a lot, Ashish, for joining in and filling us in with your take on all the stocks we discussed. Looking forward to having a chat with you rather soon. Tata Motors JLR, that's in focus because on Bloomberg, reports suggest that JLR will hike prices in a calibrated manner post the US tariff impact. So that's some news flow that's coming in there. For the time being, stock more or less unmoved. It's sitting with a gain of close to around 0.5% or thereabouts. Keep an eye out on the bottom of your screen. Let's slip into a short break. We'll be back. Deepak Shenoy from Capital Mind will be joining in to give us his view on the markets and stocks and themes that he likes. Welcome back. Well, the Nifty actually is just holding on to those gains of 60, 70 points. Very, very meager gains in comparison to what we saw earlier today. A few stocks have come off the top. Eternal, that's had a good run of late. That's come in for some profit taking. I think we should pull up a couple of more names. You pull up Nestle. That as well has seen some kind of profit taking in the last few minutes. I think the intraday chart will come up for you. And tech seems to be a little bit nervous post Accenture's commentary with regard to the next year. So I think HCL Tech is another one that's moved a little bit lower. The tech index itself had bounced back today, but that as well has come in for some profit taking. But the IPO market is buzzing. Now we have Mumbai real estate player Kalpataru that's eyeing D Street. Ria joins in to tell us the money they're raising, why they're raising it, and how the peers as well stacked up. Ria, take it away.
Well, yes, Nigel, the issue for Kalpataru Limited opens today. As you said, they're a real estate developer based in Mumbai, largely present in the MMR market as well as key micro markets across MMR and some other regions, including Noida and Bangalore as well. Now, in terms of what the money is going to be used for, they're going to raise rupees 1,590 crores. This is via 100% fresh issue, and out of this, rupees 1,193 crores will be used for debt repayment, which is expected to result in interest cost savings of about rupees 100 to 120 crores. Now, so far, the company has raised 708 crores from 9 marquee investors at the upper end of the price band, which is rupees 414 crores. And some of the investors include GIC Singapore as well as Bain Capital. Now, taking a look at the operational performance of the company, as of the end of the December quarter of FY25, the pre-sales stand at about rupees 2,727 crores. Collections also about rupees 2,620 odd crores. In terms of the pipeline for the ongoing and the forthcoming projects, they have 25 projects with an area of around 25 million square feet. In terms of valuations, the chart will come up for you on the screen. Kalpataru falls in the higher end compared to its peers, trading at a price to book value of 5.67 times.
Okay, so valuations right up there. That's the important one. Thanks, Ria, for the perspective. We did catch up with the management of Kalpataru as they're coming to the market, try to figure out, how much of that interest cost saving the company will make and what their immediate plans are with respect to expansion. Take a look.
The net debt in the books as of December, which is the reported accounts in the financials, is around 11,000 crores. When the debt is utilized for the underlying projects which are throwing cash flows, which we typically call it as ongoing projects, which we have 2.5 crore square feet, out of which we will be actually delivering around 1 crore square feet, 11 projects in FY26 and FY27 together.
All right, that's Kalpataru, another key, very well-known brand, of course, for those of us who live in Mumbai MMR, coming to the market. Deepak Shenoy, founder of Capital Mind, is with us. Deepak, great to have you on. Thank you so much for joining in. So I'm going to start right there. Real estate, it's a hot market. Prices are still high. Most developers we speak to, whether it's Bengaluru, whether it's Mumbai, everyone sounds very optimistic. What do you think of the sector? I don't know if you have any individual thoughts on Kalpataru, but just give us your overall view.
Surabhi, no individual thoughts on the stocks, but I think overall, see, in the past, there's been this big problem of, real estate seems to make money, but none of the real estate companies seem to be able to generate a profit. And they've been not so great in terms of asset allocation even allocation metrics for their own cash, because when they generate the profits, they go and plow it into land that's possibly usable only 8 or 9 years later. So the long cycle of where cash flows are stuck for a long time. So it doesn't necessarily compound your ROE meaningfully over a period of time. So your overall thing is also that because of the new Ind AS standards, they don't really report, their cash flows are completely different from reported accounts. So in that sense, there should be a fairly large difference between what you see on the balance sheets and the profit and loss statements versus what actually happens in cash flow, and therefore a lot of it is on conversations with the management or their conference calls and so on. So to that extent, it's much more difficult to analyze the sector now with the accounting changes. And traditionally, it's been a bad asset allocator from a cash flow perspective. So we've not been majorly keen on a large amount of this this part of the sector, but I think going forward there will be pockets, especially in non-tier 1 cities, non-tier 1, maybe not even non-tier, in tier 3 and below cities, where the upgrade requirement starts to come in as money starts to flow across the sector. So maybe the players in those areas will start to see some kind of a movement back, as long as they're trustworthy management. And that's where the interest might lie going forward. However, real estate is overpriced in India by a very large extent. So to the extent that it was an investable asset, I think a large amount of your returns happen primarily on gains from increasing prices. And we've had about a 4 or 5 year increasing cycle since COVID. But before that, we had an 8 or 9 period of times when prices were stagnant. If we get into a stage when prices start going negative or it just stagnate for a while, the tier 1, tier 2 cities are definitely going to see a slowdown in terms of demand, especially investing demand. But that's why I think the smaller players in smaller cities or players in smaller cities will be more attractive.
Okay, so real estate players perhaps in smaller cities would be the ones to look at. At least that's the way you're looking at it. Got that. Give us a minute. Deepak, will come back to you, and we want to get the ramifications of this for the Indian auto space. Now, this is a story, and this is a story that our colleague Parikshit is picking up, that, of course, we know that India wants, the auto industry to make in India, especially when it comes to EVs. And there seems to be a new scheme that's being floated. But it appears that the Chinese in particular may not entirely be welcome. I think I've oversimplified it perhaps, but let's go across to Parikshit, who's picking up these details. Parikshit, what's the latest on this? What's happening?
Well, the government today has formally opened up the application portal for the scheme for promotion of manufacturing electric cars in India. Now, this was a scheme that had been launched over a year ago with much fanfare, especially for companies like Tesla. Now, Tesla is not looking to manufacture in India, but the government believes there is interest from at least 4 to 5 Korean and European OEMs. But there will also be some guidelines as far as who can apply. While the government is inviting all OEMs and all nations drawing their attention to the scheme, they're saying that countries which have a land border with India, they have not been sent invites for this scheme. And this includes China. So in a way, the government is following Press Note 3, which had said that investments from countries bordering India or having a land border in India will not come into India automatically, and they will have to go through government approval. We've been seeing over the past few years how Chinese investments have slowed down. They are only approved on a case-by-case cases. There is no automatic approval. So therefore, the government following that policy is saying that we're not inviting countries which have a land border, and this includes China as well. But overall, the guidelines remain the same. 8,000 CBUs per year at a reduced duty of 15% compared to 100% currently. And you have to make an investment commitment of 4,150 crores over a 5-year period.
Parikshit, just a quick follow-up. Does this in any way impact BYD's current operations in India? They're already making in India, right? And we see all these BYD cars on the road. So any takeaway or implications there?
Well, as of now, BYD is importing some of the high-end cars into India. They have very small, limited assembly operations that are taking place currently. Are they going to expand their operations after this? What's going to be the outlook? That remains to be seen. But we have seen BYD cars picking up a lot in the fleet segment especially. But going by the guidelines that have been set out by the government and the kind of tone and tenor of the press conference today, it seems that Chinese will not be allowed to apply for this scheme over the next 4 months. You will have US car makers who will be invited, European car makers, Korean, Japanese, but we will not possibly see any applications from Chinese OEMs. But that also means they can come in through JV routes. So from tomorrow, just for example, like MG Motor. MG Motor has a joint venture with JSW Group. That was cleared by Competition Commission of India, but they've not been given approval for foreign direct investment because China is, again, a country bordering India. and Chinese investments are not allowed through the automatic route. So that FDI application is pending. So it's quite possible that China and BYD companies and other Chinese companies may want to enter India through the JV route, but their applications will be scrutinized by the government, and it's not very clear whether they will be approved either.
All right. Okay. Important story, Parikshit. Thank you very much for explaining that to us. Now let's discuss this with Deepak. Deepak, implications for the listed companies. I mean, it's clearly M&M, which has been the poster child when it comes to auto stocks that have done well. But with the Chinese being kind of being given a gentle pushback, and Tesla anyway doesn't want to make it in India. I mean, implications for the auto space. What do you like? What would you buy? Avoid? What's the approach?
So I think, Subi, this is I think it was 2020 odd when we created that press note 3 with not allow Chinese investments into India anyways. So they can, for instance, they can make their cars and sell them to India. They can't manufacture in India because they can't invest in equity in an Indian company. Could do a joint venture, government to own equity. I think at some level the government should allow us minority stake, but it's not clear that the government wants to allow it. Having said that, I think the problem is they have the best technology right now, and they also have a large amount of these rare earths which are used to make motors for these cars, sensors as well. And then I think you have dependence on understanding how to manufacture it, especially if you look at their cars. So we're not going to get that technology transfer. Even if we allowed them, they would be very low, because they've done this to the US, where these companies came to them, gave them their technology, said, make it for us. They learned from them, and then they built their own cars. They're not going to come to India. Well, now the Indians are going to learn from the Chinese and then make their own cars. They're demonstrating this in every industry where we have GVs. They do not like any technology to be transferred to India. So to the extent, not allowing them is not a bad idea, because if you're not going to benefit from the technology transfer, why bother anyways? It may help in some other countries, other manufacturers in Europe, perhaps Japan and that, to help them set up EV-based manufacturing plants in India. The idea would be that Indian residents and citizens should be able to get the technology transfer so we can develop our own cars in the future, and not be to not be completely dependent on another country, especially where there are political motives to stop doing that technology transfer. And then if tomorrow you're dependent on their cars and they've become a massive part of your transportation, that they could stop because of politics. I think it's fair that India is going down this route. I don't think it's beneficial for companies. They will not be able to do JVs right now with Chinese companies, but I think they will be JVs with other countries to set up plans.
Okay. Slightly scratchy line with Deepak today, so we'll make it a shorter chat. Deepak, thanks very much for joining in. We'll have a longer conversation more on the markets next time we catch up. But for now, we'll take a very quick break. Come back on the other side, and of course, the top trading calls for the last half hour coming up with Mitesh.
Welcome back. Well, let's get Mitesh Thakkar back on the show. Mitesh, what are your buy or sell calls that you have today? It's actually been a bit of a disappointing trading session going by where we started off. Your take?
So, Nigel, that's right. Time and again, the Nifty is trying to break, make a fresh high, and then the momentum doesn't support it, and the index kind of comes down. So, I think the good thing is that it's not turning negative, but I think it's not a very positive sign that you are facing supply at higher levels despite good news and the global market is doing well. But for the time being, I think I'll go with the BTST on Kotak Bank, keep a stop below 22.09, look for a target of 22.50 for tomorrow. And take one STBT, that's on Lupin, with a stop at around 1937.5 for target of 19.15.
Okay. All right. Got that, Mitesh. Thanks very much for that. So, yeah, indeed, losing that momentum as we're entering the last leg of trade. We were just discussing KPIT Tech with our guests earlier on the show. The stock continues to be under pressure. It's been down 5-6% right through the trading session. This following a weak business update. Let's go across to Vinny to just revise what exactly the company is telling investors now. Vinny?
Hi, afternoon. So yes, a weak business update is what the company has given. This is a mid-quarter update. Business environment they're highlighting is uncertain given the geopolitical tensions as well as tariffs. There's no certainty on that front. Deal pipelines, that continues to be strong. But the problem comes in why? Because there's a conversion delay or slowdown in terms of conversion that is there. Other than that, ramp up in terms of wins, that is there again. But the way it's progressing in terms of how the pace at which it should progress is slower than expected. Other than that, demand trends from Europe is good, but the problem comes in US as well as Asia. Again, there's some bit of an uncertainty here in terms of demand trends. So all these are some of these factors that are causing a bit of a problem for KPIT Tech, and that is why Q1 in terms of profitability, the company also said that there wouldn't be any one-time gain, so that would be an impact. Other than that, there is going to be some bit of a problem coming in foreign exchange rates. There's a lot of fluctuation and volatility in forex rate that will cause some bit of a problem for other income as well. On the back of this, Kotak Institutional Equities has cut their FY26 to 28 estimate of earnings by 3 to 4%, sell rating target price of 1,000 rupees. Now, JP Morgan also is maintaining their overweight rating. Target price is 1,500 rupees per share. But they too have cut their organic growth by 4% for FY26 and also cut the FY26 to FY28 CAGR growth by 2% to 14.5% is now the expectation coming in here. So clearly, even analysts are not too happy with this update that is coming here.
Got it. All right. Thanks a lot for that, Vinny. Well, the deadline to submit bids for Jayaprakash Associates, that ends today. Banks are expected a handful of candidates to take over the insolvent company. We have Ritu who's joining us to fill us in with details on that front. Ritu?
Well, yes, the deadline to submit bids for Jayaprakash Associates under the bankruptcy process ends today, and this one is being watched very closely. There is a massive amount of debt that is at stake, and while the deadline has already been extended before, banks are now hoping that at least a few serious bidders will step up. We had reported earlier that as many as 25 entities had submitted expressions of interest to acquire JP Associates under IBC, and the list includes some big corporate names like Adani Enterprises, Dalmia Cement, Jindal India Power, Oberoi Realty, Patanjali Ayurveda, Torrent Power and Vedanta, just to name a few. And apart from corporates, a number of financial players and asset reconstruction companies had also shown interest. So names like Autham Investment, Oak Tree, JC Flowers ARC, Kotak Alternate Asset Managers and so on. Now the window to submit the final bids closes tonight, and the bids are expected to be opened by the lenders in their meeting tomorrow. Now Jayaprakash Associates, as you know, is the flagship company of the JP Group. It has presence across real estate, hospitality, cement, engineering, construction and others, and it was among the list of companies that was identified by RBI to be sent to the Insolvency and Bankruptcy Court back in 2017, and after a long winded process, it was formally admitted to the Bankruptcy Court just last year. The company is facing claims of more than 57,000 crore rupees, and now all eyes are going to be on how this bidding war plays out, especially with such high-profile names in the mix.
Okay. All right, Ritu, thanks very much for that. Well, let's move on and get you some global perspective now. This is coming in from our colleague Prashant, who spoke with Richard Redoglia, CEO of Matrix Global, about the downside in oil prices. Richard says this is the biggest global reset in energy that he has seen in recent times. Take a look.
This is a global reset.
This could be one of the largest global resets I think I've seen in a very, very long time, at least in my life in the energy markets, because if it's possible to bring Iran into the fold, if it's even possible, I'm not sure if it is or not, but if you could bring a theocratic government and have it become peaceful, that's a sea change, right? That means less military spending. That means more trade. It probably means more positive economic activity. I'd mentioned, you and I talked just briefly, Syria has been recognized by the U.S. government. Trump has recognized Syria. And I just saw a thing on another station, and it had a person walking around Syria, and all through Syria were signs of Syrians thanking Donald Trump. Now, if someone said to me 2 years or 6 months ago that there are going to be signs in Syria thanking Donald Trump, remember Syria was a backer of Iran, you would have thought you're crazy. But when you change the dynamics that we've experienced here, I think it's something that your title of your show is exactly right. This could be a major global reset.
A major global reset in the times that we're living in. You can catch more of that interview on CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian business, giving you unparalleled insights. You can tune in to Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and 8:30 p.m. for Global Lens. Okay, with that, let's move on to another important story. This one's coming in from the pharma sector. Danish pharma giant Novo Nordisk has launched its blockbuster obesity drug Wegovy in India. The company has launched the drug in 5 strengths, with treatment prices starting at about 17,000 rupees a month, going all the way up to 26,000 rupees per month. Let's hear out what the management had to tell us about this important launch.
Is Wegovy going to be imported into the Indian market, or is there any kind of local manufacturing?
Yeah. You are absolutely. No,
so there's no local manufacturing right now?
We are going to import and No, right now we don't have plans for any local manufacturing. We have actually invested more than $20 billion in terms of APIs as well as fill and finish. And I think we have economy of scale to really produce for the world. And we will be currently importing it from headquarters. I think, while some of the players talk about the collaboration now, we have had collaborations for more than 3 decades for manufacturing as well as for distribution, which is with Abbott distribution. Now, this is something which we know, but we also know at this point of a time that we are one of the strongest player when it comes to metabolic diseases. And we have really done the justice when it comes to insulin, when we have launched the oral semaglutide. So at this point of a time, we will be launching ourselves. But should there be a need in future, I think there is never say no, and we will evaluate the scenario and see if there is a chance to join the partnership.
Okay, all right. Well, time to slip into a short break then. When you come back, we'll have Jay Bal of Catch the Chaos who will be joining in to help us out with how he sees the markets panning out. Don't go anywhere. Welcome back. As promised, Jay Bala of Cash the Chaos joins us on the show. Hi, Jay. Good afternoon. Good to see you. Who's going to win the test today?
Bulls.
Huh?
The Bulls.
All right, let's talk about the markets then. I believe that that you're calling a near-term bottom, and you believe that that price correction is mostly done. We're going to head higher from here.
That's right, Nigel. See, the market's low on Friday the 13th. It is probably ominous for the bears. I already highlighted the possibility last week, and it looks like with today's high of about 25,300 and change, the markets have registered a low at 24,750 and change. So I think the markets are, like I pointed out 2 weeks ago, there's a good possibility that the market could accelerate higher and to record highs by the end of July or maybe earlier. I would have been happier had the market were able to hold on to the gains somewhere around about 25,200 and 25,300. Around that range, if the close had been there, it would have been far more convincing. But no damage done. That would have eliminated the other possibility of the markets going one more time to the slightly below the June low. In either case, the markets are still headed higher from a 6 to 12 months perspective. As I've been pointing out, I still maintain 29,000 on the Nifty from a 6 to 12 months perspective.
29,000, what a big change, right, Jay? I recall a few, maybe 12 months ago, you were talking about 21,000, which we almost got there. And then from now, you've changed that stance. 6 to 12 months, we could be at 29,000. The bulls will be, buying the pedas and hoping to give it to you, because otherwise they were quite annoyed to hear you being very bearish. Got that. But that's what's showing you on the charts. And also with regard to India and England, we got the bulls are going to be winning this contest that's going on. Bulls beat the bears, but India beats England today?
Yeah, I hope so.
Okay, got it. All right. Let's focus on the Nifty Bank. That's going to be the one that needs to drive higher, right? To take the Nifty higher. Where is that index headed? And also SBI, it's gone through a big time correction, actually. Your take?
Yeah, the problem bracket has been, the lack of firepower from SBI. And if SBI manages to take out 835, then that will give an impetus for the banking sector, because ICICI and HDFC Bank have done their jobs. But interestingly, from the PSU space, Bank of Baroda and Punjab National Bank are looking interesting more than SBI. SBI's structure from the April-March low isn't that encouraging. So that's the reason I'm waiting for 835 to get crossed. But these are not heavyweights like SBI. So yeah, we need SBI for the banking index to perform well. The resistance comes at about 58,500, 58,900. For that, definitely, SBI shouldn't fall, and maybe a little bit of help from HDFC Bank will be welcome.
Okay, so that's a take on the financials. Jay, hi. So since you're retaining your bullish perspective, 6 to 12 months, 29,000 Nifty, what else apart from financials? I mean, what else is looking good? Reliance was showing a little bit of promise, a couple of days back. Today it's a little down. But where else should we be looking in the large cap space, at least?
Yeah, you have to maintain focus on capital goods, autos, and probably real estate. They are doing quite well. If you look at the price structure for these three sectors, if they were to cross the June high, I think the high was on the 14th or 16th of June. I think that once that's crossed, the markets will automatically rally much higher, and these are bound to rally quite well. But the problem pocket has been IT sector. IT sector, needs. It can be interpreted both ways. It's a bit ambivalent. I want TCS to cross 3550. If that manages to do it, I think most of the or even the little bit of niggling worries that have for the markets, those will disappear. And so, so when you to a pointed question of large caps, I think capital goods, real estate will continue to do well, and cement space also likely to do well. And I have two calls today, one from the mid-cap space, one is Cummins, again from the capital goods space. It's had a nice pullback, stop loss at about 29.72, and I'm expecting it to reach 52-week highs past 4,100. And Hindustan Copper is a short-term call. It should not print 230, not closing basis. It should not print 230. As long as it manages to do that, there's a short-term bump up potential for about 305.
Okay.
Got it. All right, Jay, I wanted your call on gold as well as crude. Both those two assets are quite interesting. Crude didn't run away the way it should have, or the way the market would have thought it would, post this geopolitical issue that played out. Where do you see that one headed now that it's cooled off so much? And gold actually hasn't rebounded in that sort of a manner. Some were calling for 3,500 sooner rather than later. That didn't happen. But is the structure still positive?
No, I've been calling for silver to outperform gold in the short term, and that's done. I think even that has come to an end. 37.5 was my price objective, and on London fixing of silver. I came very close to it. I think the decline from there is looking like start of a reversal for silver, and outperformance is probably done. And if gold were to drop below 32.45 on the London fixing, I'm anticipating both gold and silver to correct quite sharply. Silver to about $28, gold to about $2,700. But that will be a medium-term buying opportunity. But the short to medium term, we're likely to see the precious metals head lower. When it comes to crude, fundamentals were calling for $120 if the Strait of Hormuz were closed. But I called an aggressive short call on both the crude varieties last week, and it's dropped 10% from yesterday's high. So it's a bull trap, and I'm anticipating Brent to go back towards $55 that it registered in April, and then it will probably begin a major uptrend that lasts about 1 to 2 years.
Okay, all right. Good talking as always, Jay. Thanks so much for joining in and giving us that perspective. Well, we're down to the last 2 minutes of trade, so let's quickly look at the final rates that are coming in. There's been a bit of a pullback on the Nifty. So since we're complaining so much about it being a bit of a damn squib day, maybe the index decided to oblige us because we've got at least 100 on the board. Nigel's been looking out for all the centuries in the test match. So, well, you've got 100.
I don't want to see any centuries today.
As of now, yeah, you don't want to see this time around.
Yeah, I want to see wickets go.
Absolutely. But what we have is 100 points on the Nifty. So let's talk about the winners first. The leaders of the up move today: Jio Finance, Shriram Finance. There's Adani Ports that's managed a 3% up move. Banks have done pretty okay, actually. The Bank Nifty has outperformed the Nifty with a gain of almost 0.8%. Kotak Mahindra Bank, HDFC Bank, Axis Bank, even SBI, all of them contributing on the way up. L&T is the one stock from the large cap space that's contributed on the upside as well. And then you have, in between, some of the metal names, Hindalco, JSW Steel, because it's a global risk on. Some of the metal stocks did well as well. On the flip side, with a 10% drop in crude oil prices, ONGC is down 3%. Cool off in a lot of the IT names. They could not sustain their mojo. So HCL Tech, Tech Mahindra, Infosys. The IT stocks pretty much sold off, explained how the Nifty cooled off as well. But Nigel, not too bad for mid-caps today.
Well, there were some stocks that were absolutely on fire. You pull up Bajaj Consumer, the stock was up 20%. The street is sensing some kind of development out there. Invero Infra, that was up close to 11%. JM Financial, up 7.5% in today's trading session. From the Lloyd group of companies, you had Lloyd Enterprises, a stock we don't talk about very often, but now it's more than $1 billion in terms of market cap. That one, in fact, was up close to around 7.5%. And, post what happened with Lloyd Metal, the street seems to be turning its attention to the other smaller Lloyd Group companies like Lloyd Enterprises, as well as, the other smaller one as well, Lloyd Engineering, I think so. Well, a few more stocks that did well, the OMCs, HPCL, SAIL, Sagility, all of them moved higher on very, very large volumes in trade today. So that was the market for you. A good start to trade, we couldn't build on, and maybe a bit of a disappointing close, though the Nifty goes home with a gain of around 100 points. The Nifty Bank, though, quite rock solid, up close to around 400 points. But the big money was made in the broader markets as the number of stocks advancing were way more than the number of stocks that were declining. We'll wrap up on this edition of Closing Bell. Stay with us, though. Markets Forward comes up next. Market closes in the green but off highs amidst the ongoing Israel-Iran conflict. The Sensex falls 900 points from the day's high. Meanwhile, the Nifty hits levels above 25,300 intraday for the first time in 2025.
Crude drops overnight to revert to levels before the Israel-Iran war broke out. Fears over Strait of Hormuz being closed dissipating also helps cool prices. Crude sensitives react to fall in oil prices.
KPIT Tech points to a slower deal convergence, delays in project ramp-ups, uncertain demand trends, and adverse forex movements. In its mid-quarter update, spooking the street, the stock corrects more than 5%. Hello and welcome to Markets Forward, your go-to show where we get you up to speed with regard to today's trading action and we set you up for tomorrow. I'm Nigel and with me is Mangalam. Hey Mangalam.
Hi Nigel, you know what a day it was. We started off with a near 300-point uptake and thereafter we quickly gave up those gains.
Well, that's right, and we have got you covered for the next 20 minutes or so. We'll get you all the big news, the key developments on Dalal Street as well, some top corporate voices and the events to track as well. First up, though, in terms of trading action, Mangalam, it was a good start. We woke up to good news and no one wants a war, right? And there was clear signs of de-escalation. And that's why in the markets at the high point of the day, we were up more than 350 points. But as that intraday chart is telling you, it lost its way midway and we couldn't conquer the 25,250 odd mark on a closing basis. So a good trading session, but it could have actually been better if the end was better. In terms of the broader market action, though, out there, there's still pretty much bullishness because the advanced decline ratio comes up for you on the screen. We had more than 2 stocks that were advancing for 1 stock that was declining. So that's telling you your portfolio as well will still be feeling quite good. Midcap index up 0.7%. Mangalam, but otherwise plenty of action. Plenty of action that took place. You know, the advanced decline tells you the story. But for me, the important part is in the expiry week, the high of today and the low of today will become an important barometer to watch out for. Because we saw buying at the lower levels today, 25,000 now becomes an important level of support for the frontline index. The high on the Nifty today, 25,318, is something that we'll watch out for. Because prior to that, the high was 25,222. We've made a higher high for 2025. Let's see whether this sustains or not. At higher levels, we saw a decline in the likes of Nifty IT because of global worries. Once again, Reliance because of oil falling as well, and the stock had outperformed. Bharti Airtel, if Vodafone idea sustains, then does Bharti's market share or strength get under question? Perhaps not, but then again, there is something that the street is taking note of from that stock. But there was a sector that stood out for me on the way down at a time when all the broader markets did well, or all the defense stocks, because, Carpentry Shipbuilders, BEML, Paras Defense, Hindustan Aeronautics, all of them had seen a big jump during wartime. Now the street is believing that there is truce, there is peace. Perhaps, there is time for them to take those profits that they had made in the last 10, 12 days. What happens from here on? One will be watching out for these stocks as the barometer of where the world is going from here. Well, that's right. Let's first quickly take you through all what we have lined up for you on the show today. We start off with the top movers and shakers with Hormuz. He will shed light on all the top oil stocks, defense stocks, as well as the newsmakers. Also on the show, oil price slumped amid the ongoing Israel-Iran tensions, while KPIT Technologies made headlines in the tech space after releasing a weak FY26 business update. Last but not the least, we'll delve into the key market events to watch out for tomorrow's trading session. All right, so what happens to the Strait of Hormuz is something that we will watch out for tomorrow. But until now, first, let's go straight to Hormuz, who joins in to tell us about the movers and shakers of today. Hormuz.
Carrying on with the buzzword of the day, that was oil, which of course passes through the Strait of Hormuz. The oil prices falling had an impact on both the upstream and the downstream names. More than the downstream names reacting positively to it, it was the upstream names reacting negatively to it was the bigger reaction. Oil India down 5.5%, ONGC down 3%, negative reaction coming in for Chennai Petro as well. Some of the other newsmakers beyond the oil names were, of course, Bajaj Consumer management change right at the top, a 20% move. Enviro Infra of the order win, Aztec for the rights issue. Rice stocks saw a rebound today led by LT Foods and of course, as you just mentioned, KPIT Tech in that week update, a 6% cut on that stock as well. And you mentioned defense as well. It's almost a law of gravity, right? What goes up comes down, and that's what happened with these names. Cuts of anywhere between 5 to 9% across the board and not just select names. Almost every defense stock fell in today's session. What didn't fall though were stocks stocks that ended at a 52-week high in today's trading session, despite this choppy market that we had towards the close of trade. India Glycols was at a 52-week high, as was L&T Finance. Another high for Poonawalla FinCorp as well, so that continues to move from strength to strength. And lastly, some of the other movers in today's trading session were the ones that did well on the volumes front. It's Swan Energy. JM Financial was the top gainer in the broader markets today. Titagarh, out of the FNO band, did well today on very strong volumes. Back to you guys.
Okay, all right. Thanks a lot, Hormuz, for joining in, staying open and giving us that update. Well, let's go across to our guests, Jay Bala of CashTheChaos.com and Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital. Hi, gentlemen. Thanks a lot for joining in. Jay, first, quickly, let's get the levels out of the way. A good start to trade, but as we said, we couldn't, breach the upper levels. Tell us the resistance, and since you're positive on the index, tell us where would you nullify that? What's the support level you're looking at? Next 12 months, where are we headed?
Yeah, the Nifty's resistance has come exactly at today's high. I projected this last week to 25,300, 23,600 was the level. Today's high was about 25,350 and change. So not surprising that the market turned from there, but surprising that it turned so much. But the supports, as long as Nifty can maintain 24,750, which I think it will do very comfortably, we are headed for 52-week highs, possibly by end of July. And from a 6 to 12 months perspective, I'm anticipating 29,000 for the Nifty. So I think the Friday the 13th low that we saw in June, I think that's going to hold. And I don't think the markets are at risk of breaking that.
All right, you're more optimistic on the market, but Sudeep, I'll come to you with all the oil-related plays out here. But before that, let's talk about the oil prices, which have seen a correction following the announcement of the ceasefire agreement between Iran and Israel. Manisha joins in with the details first. Manisha.
Well, thank you for that. I'll start with the price action first, where we saw 7% of a decline in the overnight market. And then Asia, Europe today also saw yet another 3 to 4% of a crack coming in for the prices. So with this now, we are down by 14% from yesterday's highs. And also we are trading right at 2-week lows at the level where we were before the Israel-Iran conflict started there. I want to take you through 5 pointers on what has really led to a decline for crude prices. One, it clearly has been the US president announcing a ceasefire between Israel and Iran, while we still see those statements coming in on perhaps a violation here and there. But the point being that a lot has been said, and we have seen prices go in for that correction there. The second is about Iran's retaliatory strike on Qatar's US airbase. But we do understand that there were no casualties and the damage was minimal. So the market's really not counting that in. The third point is that the most critical Strait of Hormuz as of now will not be closed. That clearly was an extreme action that the street was looking at. With that also out of the way, at least for now, we're looking that also coming off in sense of premium in prices. The fourth point is about OPEC and allies, which have yet again reiterated that they are looking to increase production all the way until the month of November. And within all of this conflict, there comes my fifth point, and this one comes in from IEA, which said that they're holding 1.2 billion barrels of crude as an emergency fund and can deploy it into the markets if need be. So all of this really assured the market and is the reason you've seen that premium come off from the crude prices.
Thanks a lot for that, Manisha. Well, on the back of this decline that Manisha is talking about in crude oil prices, there were a lot of stocks that were moving around. Sudarshan joins us to help us out with that list. Sir?
So we don't know if there is a ceasefire, no ceasefire between Israel or Iran, but one thing is for sure, there was a big fall in the crude from yesterday's high of $81 per barrel. There's a fall of almost $12 per barrel, and now Brent crude is trading below $70 per barrel. Now it has an impact, positive as well as negative, on some of the companies. So first, talking about the negative impact, it impacts negatively to upstream oil companies, or say crude producers like ONGC and Oil India. For example, if there is a fall of $1 per barrel in crude, it impacts annual revenue in the range of rupees 300 to 400 crore for these companies. Now, talking about oil marketing companies, or say downstream oil companies like IOC, BPCL and HPCL, if there is a fall of $1 per barrel, it has a positive impact in the range of rupees 200 to 300 crore to the annual EBITDA of these companies. Now, apart from oil companies, there is a positive impact on some of the companies for which crude is an input cost. For example, paint companies, up to 50% of their input costs are linked to crude. So if there is a fall in crude, raw material costs come down and it has a positive impact on their margins. Last is airline companies. For them, input cost is majorly aviation turbine fuel. Now, if there is a fall in crude, aviation turbine fuel costs come down and it has a positive impact on the earnings of airline companies. So that's the reason there was a divergent move in stocks today. While ONGC and Oil India were lower, all these paint companies, airline companies and OMCs were trading higher.
Take that point, Sudarshan. We don't know whether the ceasefire is for sure concrete and is this permanent for now or not. But what we know is crude prices are lower. But whether it flares up again or not, whether crude prices increase higher from here on or not, could there still be a play in these related plays? Let's go across to Sudeep Bandyopadhyay for the same. Sudeep, both upstream and downstream companies, along with some of these crude users, the end usage of the industry, at least in the paint space, is currently questioned because demand isn't growing as strong and then there is competition. But for someone like, Interglobe Aviation, where the tailwinds are so big, irrespective of crude prices, people are going to fly. That explains why that stock continues to be well bid. So in light of that, how would you view crude users and some of these upstream companies?
As far as upstream companies are concerned, I think one needs to be a little careful because obviously, the oil prices coming down isn't good news for them, and there will be pressure on their revenue, as was being explained by Sudarshan just now. So I think I'll stay away from the upstream companies. Of course, oil marketing companies do benefit when the prices come down. And, beyond the war, I think what the OPEC has been doing and has been trying to do is to increase supply. And they're talking about keeping the increased level of supply in place at least till November of the current financial year. I think that's very good news as far as oil prices are concerned. They are going to remain within a range and will not flare up, and that's definitely good news for oil marketing companies as well as the users of crude oil. As far as the ATF prices are concerned, obviously Indigo does benefit significantly as roughly around 50% of the cost of operation for the airline company goes to for ATF, and this definitely is excellent news for Indigo, where all the other factors, as you rightly pointed out, are in place for incremental demand and profitability in turn. So I think ATF prices remaining in a range and coming down is definitely good news for Interglobe Aviation. Paint companies, yes, I completely agree with you. Beyond the oil prices, there is intense competition, and that is going to remain there for the foreseeable future. Under the circumstances, I think there is pressure on pricing, and I won't, be a buyer in paint companies or recommend a buy. Not that they are not good companies, but the fact is, too many things are moving in that space at this stage.
Got it. Okay, all right. Well, let's focus on the next stock then. We have KPIT Tech that tumbled in trade after the company released its mid-quarter business update. They added that the business environment continues to remain uncertain due to geopolitical tensions. Vinny joins us to fill us in with what all the management has highlighted, and that's what spooked the street. Vinny.
Hi, absolutely. So business environment being weak and uncertain is a big issue. Then other than that, deal pipelines. It's a strong pipeline that they have, but the conversions is at a very slow pace. The ramp up in terms of wins, that is also progressing well, but that is also at a slower pace. Other than that, demand trends in Europe is the only region where they're seeing good trends. US and Asia, a bit uncertain on that front as well. There's uncertainty around tariff fronts. So these are issues which are impacting the overall performance of the company, is what KPIT is highlighting. Other than that, they are also saying that their other income is expected to be lower because during this quarter, we've seen a sharp fluctuation in terms of forex rates as well. Q1, they are expecting that, they'll not see any one-time gains this time like we saw in Q4 FY25. So obviously, in terms when you look at the profit, maybe we will see a reduction coming in on that front. Now, obviously, on the back of this, Kotak Institutional Equities saying that, they've cut their FY26 to FY28 estimate by around 3 to 4% for their earnings. Even JP Morgan has cut the organic growth by 4% in FY26. And for FY26 to 28 estimate that they have of a CAGR growth, that also now they're expecting it to be lower at around 14.5% versus 16.5%, and they expect recovery coming in for KPIT Tech only from Q2 FY26 and onwards. So bit of that subdued performance is what one could watch out for in Q1 from the company.
Right, 6% lower on KPIT Tech. Jay, your thoughts on two things. One, crude. Where is the trajectory of crude, given the volatility that we are seeing? Is the chart telling you where it's likely to go? And second, on tech stocks as well. They have been underperforming. At some point, do they see support?
Yeah, let's take crude first. Crude had pointed out for a double bottom potential that for the both the varieties rally somewhere about 78 to 80, and that's done that. And I pointed out last week that crude is likely to drop from that and go back to retest the April lows it registered, and that's probably in motion now. We could see a short-term bump up to about 71 to 73, depending on which variety of crude you're looking at. But I think it's likely to go back to the April lows and revisit those levels. When it comes to tech stocks, I've been bullish on the markets, but very cautious on the tech names. KPIT had a great potential today. If it had closed above 1460, that would have triggered a massive buy signal for it. But it's still, it's not, despite its sharp fall of 6% today, I don't think it's got that much of damage, but it's a disappointment for the stock. When it comes to tech space, I'm more bullish on the mid-cap space rather than the small-cap space. But even there, I'm exercising a lot of caution. But if you have to be there, it has to be Tech Mahindra, Persistent, and Coforge. The rest of the names are just middling around. So I would rather be allocating much lower to the tech space for the moment. I'll wait for the sector leader TCS to close about 35.50 before I get aggressively bullish on the IT names.
Okay, all right. Well, let's focus on Vodafone Idea. Those shares, they rallied in trade as Communications Minister Jyoti Aditya Scindia spoke against a duopoly in the telecom space. Adds, it's not good enough to have two carriers and India needs more competition in every sector. Let's hear out that bite.
Today we have fiber, we have broadband, we have Wi-Fi, we have mobile, and soon enough, we will also have satellite. Our job is to provide as many avenues as possible, and within each vertical as well, provide intense competition. It's not good enough having a duopoly or one carrier or two carriers. You must have competition in every sector. India today is probably the only country in the world with 4 telcos.
All right, quickly, Sudeep, your views on the telecom space. Do you think you stick with the leader, or you look at some ancillary plays like Bharti Hexacom or Indus Towers, or you take a punt on Vodafone Idea? Quickly.
No, not really going with Vodafone Idea. I think there have been too many uncertainties around it. Yes, today's statement by the minister is encouraging from Vodafone Idea point of view, but I think it's still too many uncertainties around it. So if I have to play, I'll continue with Bharti Airtel. Even Bharti Hexacom is okay, but I won't venture beyond that.
All right, gentlemen, thank you so much for joining in and giving us your perspective on the market, a whole host of sectors and stocks as well. With that, we'll take a short break, come back, get your top corporate voices along with key market events to watch out for on the other side. Watching us here on Markets Forward, where we've told you a lot about stocks, a lot of individual sectors, and the way the markets did today and how you have to prepare for tomorrow. Let's go across to the key corporate voices that we had on this channel today. First up, Narayana Health. The management feels Amazon's foray into diagnostics in partnership with Orange Health is actually a positive move because they believe this will offer tech-enabled solutions to customers and doesn't see Amazon as a threat to existing players like Narayana Health. In fact, they've also committed 400 crore rupees over the next few years, 4 years to be specific, to integrated healthcare business.
Well, next up is Kalpataru. The management was on CNBC-TV18 earlier today on day one of their issue subscription. The management aims to trim its net debt from around 11,000 crore rupees to around 8,000 crore rupees. That's not all. It aims to deliver 1 crore square feet across FY26 and FY27. They added that they have around 50 million square feet of ongoing, upcoming and planned projects. While Hyderabad is a growing market, Kalpataru remains focused on MMR region.
All right, and we also had the management of Ellenbury Industrial Gases on CNBC-TV18. This IPO too opened for subscription today. The management says portion of the IPO proceeds is being used to add more capacity. Since there is a major headroom available for new capacities, it's in fact eyeing to increase its total capacity to about 2,200 tons per day from 1,370 tons per day.
Well, time to wrap up. But before we do that, Upasana is standing by. She's going to give us the key events we need to track for tomorrow's session. Upasana, over to you.
Well, first up, let us look at the key global economic cues that we'll be closely looking out for tomorrow. First up, let's look at US markets. New home sales data for the month of May, even crude oil inventories data will be out tomorrow. It is also important to know that the Fed meeting is scheduled for tomorrow to take up the proposal to ease up capital requirement for big banks. Now, let us look at the key stocks that will be in focus on the back of corporate action. Stocks like Canfin Homes, Seat, Signature Global, and even Valiant Organics will be in focus as board meeting for all these companies is scheduled on the back of fundraising. Even Union Bank will be in focus as board will consider capital raising plans for the bank for FY25 and FY26. Now let us look at the key other events. Now when it comes to IPO, mind you that HDB Financial Services and Sambhav Steel Tubes IPO opens for subscription tomorrow. Now coming to the important AGMs, tomorrow marks as the 36th AGM of Tata Elxsi. We'll be watching out for that as well. And even NVIDIA annual meet is scheduled for tomorrow. And lastly, launch of Axiom 4 mission is scheduled to be held tomorrow. So all in all, looks like quite an eventful day tomorrow.
An eventful day indeed. Thanks a lot for that, Upasana. And you trust CNBC TV18 to get you up to speed with all those events that take place tomorrow. With that, we wrap up on this edition of Markets Forward. Stay tuned. We'll be back with more news and updates.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Israel's defense minister accuses Iran of violating the ceasefire orders, intense strikes on Tehran. Iranian officials deny claims of any violation. All of this just 3 hours after President Trump claimed to have brokered a truce to end the 12-day conflict. Crude oil prices trimmed losses after claims of ceasefire violations by Iran, but oil prices still down over 10%, moving back to levels seen before the latest flare-up in the Middle East. Stock markets rebound across the world. The Wall Street rally loses steam in the last hour as the Sensex and the Nifty end with minor gains coming off their intraday highs. India is keen but not desperate to sign the US trade deal before the 9th July tariff deadline. Sources say negotiations are stuck on agri, dairy and genetically modified crops. Finance Minister Nirmala Sitharaman says a deal with the US is close, adding that India's effective tariff rate is far lower than what is being perceived. India keeps Chinese automobile makers out of the new scheme to promote electric car manufacturing. The government invites other global car makers to apply for incentives to make in India within 4 months.
It's not good enough having a duopoly or one carrier or two carriers. You must have competition in every sector.
The telecom sector needs more competition, says Union Minister Jyotiraditya Scindia. The statement comes at a time when Vodafone Idea is seeking relief from the government on outstanding dues worth over 80,000 crore rupees. Pharma major Novo Nordisk launches its weight loss drug Wegovy in India. Prices start at more than 17,000 rupees for a 1-month course. The Navi Mumbai airport, run by Adani, will charge a user's development fee of 620 rupees for domestic passengers. This is 3 times higher than compared to the fee at the Mumbai airport. International passengers will pay 1,225 rupees, which is 2 times more than the current Mumbai airport. Software major Salesforce unveils a significant update to its AI agent platform, promises more visibility and control for businesses who rely on AI-driven automation. The top story this evening, a tenuous truce in the Middle East just 3 hours after President Trump claimed to have brokered a deal between Israel and Iran. Israel's defense minister has accused Tehran of launching new missiles in violation of the ceasefire. Now, Israel said a fresh barrage of missiles were launched from Iran and sparked air raid sirens across the country. Minister Israel Katz ordered the country's defense forces to respond to Iran's violation with intense strikes in the heart of Tehran. However, Iran denies Israel's claims. According to Reuters, Iranian officials have denied firing any missiles at Israel. Hopes that the ceasefire will hold, sparking a sharp drop in oil prices and a relief rally across global stock markets. In fact, Trump's announcement of an end to the 12-day war came after Iran retaliated against the U.S. strikes on its nuclear sites by attempting to attack U.S. military base in Qatar. Iran's missiles were intercepted over the skies of Doha, and the U.S. officials reported no casualties. President Trump told NBC News, and I quote, "The ceasefire is unlimited and it's going to go on forever. I don't believe that there will ever be shooting at each other again." Well, that is the latest there as far as the Iran-Israel ceasefire is concerned. Crude oil prices, meanwhile, trimming losses after Israel's claims that Iran had violated the ceasefire. However, oil prices are down 10% and they're on course to levels seen before the latest flare-up in the Middle East. Manisha is standing by with more details. Manisha, there was a lot of fear, a lot of concern on what the Iran-Israel conflict could mean as far as crude oil prices are concerned, and today down 10%.
Well, thank you for that. I'll start with the price action first, where we saw 7% of a decline in the overnight market. And then Asia, Europe today also saw yet another 3 to 4% of a crack coming in for the prices. So with this now, we are down by 14% from yesterday's highs. And also we are trading right at 2-week lows at the level where we were before the Israel-Iran conflict started there. I want to take you through 5 pointers on what has really led to a decline for crude prices. One, it clearly has been the U.S. president announcing a ceasefire between Israel and Iran. While we still see those statements coming in on perhaps a violation here and there, but the point being that a lot has been said and we have seen prices go in for that correction there. The second is about Iran's retaliatory strike on Qatar's U.S. airbase, but we do understand that there were no casualties and the damage was minimal, so the market's really not counting that in. The third point is that the most critical Strait of Hormuz as of now will not be closed. That clearly was an extreme action that the street was looking at. With that also out of the the way, at least for now, we're looking that also coming off in sense of premium in prices. The fourth point is about OPEC and allies, which have yet again reiterated that they are looking to increase production all the way until the month of November. And within all of this conflict, there comes my fifth point, and this one comes in from IEA, which said that they're holding 1.2 billion barrels of crude as an emergency fund and can deploy it into the markets if need be. So all of this really assured the market and is the reason you've seen that premium come off from the crude prices.
Well, that is right. Crude prices coming off very sharply. Manisha, many thanks. And stock markets also staging a rebound across the world, but the gains were limited in India. The Sensex and the Nifty closed marginally in the green as the rally lost steam in the last hour of trade. The Sensex fell 900 points from the intraday high. 82,055 is where it closed. A flat close for the Sensex there. The Nifty closing in the green, up by about 72 points, closing above 25,300 intraday for the first time in 2025. That was the story as far as the Nifty was concerned. So we'll be standing by now to take us through the market action. The mid-caps, of course, outperformed again, up by about 400 points. So it'll be a relief across global markets on the back of the truce and, of course, the expectation that this could perhaps be the worst and it could be behind us.
Well, a day that will be described as disappointing given what a solid global backdrop we started with that ceasefire being announced and global markets absolutely raging and ripping higher. But what started off as a 250-point gain finally fizzled out. The Nifty did manage a little bit of green, but just could not hold on to the morning momentum at all. Relatively speaking, mid-caps were better. The mid-cap index at least had a gain of almost 0.7%. The advance decline ratio was also positive. More than 2 stocks advancing for every one that was declining. So that was a silver lining. But the fact is that the index, the Nifty itself, is unable to punch through the recent trading range. The top of that range comes in around 25,200. And that's now turning into a bit of a resistance because the market is not able to take it out on the way up. Let's talk about the gainers then. On the Nifty, Jio Finance, Adani Ports, Shriram Finance, Grasim, Tata Steel. These were stocks on the way up. The banking part of the market actually did much better. Bank Nifty was outperforming the Nifty, and you had gainers in the form of Kotak Mahindra Bank, SBI, HDFC Bank. On the losing side, ONGC, Power Grid, ONGC for obvious reason because of the collapse in oil prices overnight. Trent lost some ground, NTPC was lower, and giants like Lever and Reliance, they did not really fight for the bulls today. They were flat to slightly negative. Let's talk about IT. Now, this is where things turn. IT stocks opened the morning with a flourish, but by the time we closed out, they were all either flat or slightly negative. Names like Tech Mahindra, Infosys, all of the, the fuzz or the fizz really fizzling out, I should say. Now let's come to mid-caps. That was a silver lining today. The gainers included names like GE, Vernova, T&D, Kajaria Ceramics, Smart, 5-6% move coming in towards the close. Some of the financial names like JM Finance, Edelweiss up 4-5% as well. And the rice makers, LT Food and KRBL, were up and about as well. Remember, some of the Middle East markets are very big exporting markets for these rice companies. KPIT Tech has issued a mid-quarter warning of sorts, basically putting out a mid-quarter update highlighting some business concerns. That's why that stock was down about 5%. And finally, on the flip side, defense stocks today came in for some profit taking. So names like HAL, BEL, BEML, particularly BEML, was down about 7%. But even private sector names like Data Patterns and Zentech on the lower side. So okay day for mid caps, slightly disappointing for large caps. And we'll see once the geopolitical headlines settle, then the market will go back to taking a closer look at trade and in particular that India-US bilateral trade agreement.
All right, so many thanks. In fact, that's the story we're now moving on to. India is keen but not desperate to sign the US trade deal before the 9th of July tariff deadline kicks in. Sources tell CNBC-TV18 that negotiations are stuck on agriculture, dairy and genetically modified crops. Abhimanyu standing by with more details. Abhimanyu, take us through where things are currently stuck and what the government's position is on the US-India trade deal.
Negotiations between India and the United States are still underway as both the sides are still keen on signing an interim trade deal before the 9th of July but are not desperate. That's the broad message so far from the ongoing deliberations. A government official has told CNBC-TV18 that the India-US trade deal is currently stuck due to issues pertaining to access for agri and dairy products and GM crops. While the United States is insistent on lower duties for agri and dairy produce and a broad access for the GM crops in the Indian market, India is unwilling willing to allow so. The government official further said that there will not be any compromise on India's national interests, adding that tariffs may revert to 2nd April levels if a deal is not reached by the 9th of July. Government sources have also said that earlier tariffs may also imply a competitive advantage for India vis-a-vis its competitors which export to the United States.
Abhimanyu, many thanks. In fact, Finance Minister Nirmala Sitharaman says India is close to signing a trade deal with the US and the EU. Speaking at an event organised by the Exim Bank, the Finance Minister said India's effective tariff rate is not as high as it is being perceived.
For all of us, or those of us who still believe in the commentary which was made in the US that India may be the tariff king, no, I want two things to be remembered. Given our system of things, we seek parliamentary approval for deciding on the tariff rate. You obtain from the parliament the permission to go up to a certain level. But effectively, you are at a far lower level. 7 tariff rates have been removed in this budget, reducing the total to just 8.
Well, that's the Finance Minister. Now, the government has invited global car makers, except those from China, to apply for incentives to make in India within 4 months. Government officials have said that 4 to 5 companies have shown interest. Parikshit is standing by with more on the new EV manufacturing scheme. Parikshit, so make in India, but not to the Chinese.
Definitely not. In fact, the government has started sending invitations to all nations through their embassies, telling them that if there are companies in your countries who want to apply, please ask them to do so. Please sensitize them about the scheme. They've sent letters to all global OEMs, including Tesla. But on the question of China, the government is very clear that China shares a land border with India, and there the Press Note 3 is very clear. Press Note 3 in 2020 had said that no investments from land border countries, including China, can happen through the automatic route. It has to mandatorily go through government approval. And we've seen since 2020 that very few approvals for Chinese investments have gone through. And it's on a case-by-case basis. The government is very clear that they will not allow Chinese investments automatically. Now, let's look at BYD for that matter. BYD has been proposing to set up a plant in Telangana at a cost of 85,000 crores. That cannot happen without the approval of the government. Look at MG Motor. MG Motor had applied for the PLI scheme a few years ago, but that application is pending with the government. Their FDI application has been pending with the government and has not been cleared either. Considering the kind of stand the government has taken with these Chinese car makers in the past, it is unlikely that any Chinese car maker is going to be allowed through this scheme. Now, what is going to happen? Well, any car maker who applies, they have to do so now within 4 months, and after that in October, the window closes down. They will have to give a commitment of 4,150 crores, and they will have to commit to start manufacturing in India in 5 years. Until then, till they start manufacturing, they'll be allowed to get 8,000 cars from abroad, electric cars into India, fully built cars at a reduced duty of 15% as opposed to 100% currently. So the government believes this is going to be a win-win, and somehow they believe that this will still be attractive to OEMs after the FTA concessions in the auto sector.
All right, Parikshit, appreciate you joining us. That's the latest there on the government's new EV manufacturing policy. Chinese car makers likely to be kept out. The government is expected to finalize a rare earth magnet manufacturing scheme within the next 10 to 15 days. Now, this comes after China curbed the export of these magnets, which are critical for EV manufacturing. Sources say the new initiative will have an outlay of 1,000 crore rupees and support capacity of 1,500 tons of rare earth magnets. China has relaxed the import curbs for the US and European automakers, but no word yet on export requests placed by India's EV makers. The Secretary at the Heavy Industries Ministry, Kamran Rizvi, has said India is in talks to import rare earth minerals from Japan and Vietnam. Take a look.
Are we looking at any other countries where we can source the iron except China?
So you are aware that rare earth is available in Japan, in Vietnam, and efforts are going on to bring from there.
The operations at Hyundai's Chennai plant remain unaffected despite ongoing wage negotiations with its workforce. Sources tell CNBC-TV18 the South Korean car maker is likely to reach an agreement with its recognized trade union on a long-term wage settlement soon. Telecom Minister Jyotiraditya Scindia has called for more competition in India's telecom sector. Speaking at an event, Scindia said the sector cannot afford a duopoly and there must be competition across all segments. The statement comes at a time when Vodafone Idea is seeking relief from the government on outstanding dues worth over 80,000 crore rupees. The minister also urged device and chip makers and original equipment manufacturers to help produce network and user devices at affordable cost to prevent a new digital divide. Take a look.
Today we have fiber, we have broadband, we have Wi-Fi, we have mobile, and soon enough we will also have satellite. Our job is to provide as many avenues as possible, and within each vertical as well, provide intense competition. It's not good enough having a duopoly or one carrier or two carriers. You must have competition in every sector. India today is probably the only country in the world with 4 telcos.
Well, that is the telecom minister saying more competition, the need of the hour. The deadline to submit bids for bankrupt Jayaprakash Associates ends today. There are 25 suitors, including the Adani Group, Dalmia Cement, Jindal, Oberoi, Pathanjali, among others. Ritu's here with the race for JP Associates. Ritu.
Well, yes, the deadline to submit bids for Jayaprakash Associates under the bankruptcy process ends today, and this one is being watched very closely. There is a massive amount of debt that is at stake, and while the deadline has already been extended before, banks are now hoping that at least a few serious bidders will step up. We had reported earlier that as many as 25 entities had submitted expressions of interest to acquire JP Associates under IBC, and the list includes some big corporate names like Adani Enterprises, Dalmia Cement, Jindal India Power, Oberoi Realty, Patanjali Ayurveda, Torrent Power and Vedanta, just to name a few. And apart from corporates, a number of financial players and asset reconstruction companies had also shown interest. So names like Autham Investment, Oak Tree, JC Flowers ARC, Kotak Alternate Asset Managers and so on. Now the window to submit the final bids closes tonight, and the bids are expected to be opened by the lenders in their meeting tomorrow. Now Jayaprakash Associates, as you know, is the flagship company of the JP Group. It has presence across real estate, hospitality, cement, engineering, construction and others, and it was among the list of companies that was identified by RBI to be sent to the Insolvency and Bankruptcy Court back in 2017, and after a long winded process, it was formally admitted to the Bankruptcy Court just last year. The company is facing claims of more than 57,000 crore rupees, and now all eyes are going to be on how this bidding war plays out, especially with such high-profile names in the mix.
Ritu, many thanks. Digital payments major PhonePe formally kicked off its IPO process. Sources tell CNBC-TV18 the company has hired a slate of top global and domestic banks to manage the issue. Rachna is here with more on PhonePe's journey to the Lal Street. Rachna.
While digital payments major PhonePe is dialing up its IPO plans, CNBC-TV18 has learned that the company has hired Kotak Mahindra, JP Morgan, Citigroup and Morgan Stanley to manage its upcoming public issue. Now, PhonePe is looking to raise $1.5 billion and is eyeing a valuation of up to $15 billion, making it one of the most anticipated listings in the fintech space, especially this year. According to sources, the company plans to use the IPO proceeds to scale up its financial services, invest in new verticals and pursue strategic acquisitions. PhonePe, founded in 2015, was later acquired by Flipkart as we know it. It became a part of the Walmart ecosystem after the US retail giant bought Flipkart in 2018. Now, the company was demerged from Flipkart in 2023 and shifted its base from Singapore to India, a crucial move to meet domestic listing norms. CEO Sameer Nigam, in an exclusive conversation with CNBC-TV18 in May, said that the company is now ready to embrace the transparency and accountability that comes with being a listed entity. PhonePe has raised about $850 million post the demerger in funding in 2023 at a valuation of about $12 billion. Major investors include General Atlantic, Ribbit Capital, Tiger Global, TVS Capital Funds and Walmart, which remains its majority shareholder. Meanwhile, Flipkart, Walmart's other Indian bet, is also gearing up for its IPO and has already completed its Singapore to India domicile shift, as we had reported earlier this year. Now, we will be keeping a close watch as both these IPOs move forward.
Well, both big IPOs at that. Rachna, many thanks for joining us. Up next, Pharma major Novo Nordisk launches its weight loss drug Wegovy in India. Prices start at more than 17,000 rupees for a one-month course. That and more when we return. Danish drug maker Novo Nordisk has launched its weight loss drug Wegovy in India. The drug is currently under distribution and will be available in pharmacies at the end of June. A 4-week prescription of the lowest dose of Wegovy will cost over 17,000 rupees. Consumers will have to pay around 26,000 rupees for the highest dose. This is almost twice the price of Eli Lilly's weight loss drug Mounjaro. Wegovy and Mounjaro, the only weight loss drugs available in India currently. Speaking to CNBC-TV18, Novo Nordisk India MD Vikrant Shirotia explained the possible side effects of the drug. Take a look.
When it comes to the eye, you know, the case is actually 1 by 10,000, and we have actually really not seen any causal relationship with it. It has not been reported in many of our clinical trials across, at least the STEP trial, which has happened for semaglutide. But and we have also not seen the raised calcitonin levels. But again, the patients should take it under the medical supervision if there is a risk of thyroid carcinoma. It's part of the weight loss journey. Even if suppose somebody tries to do a weight loss with diet, exercise, or any of the therapies across, muscle loss is a part of it, and we have seen this 25 to 40% muscle loss.
Well, that's Wegovy, Novo Nordisk weight loss drug that's now officially launched in India. The black box of Air India's Boeing aircraft, which crashed in Ahmedabad, is in India. Aviation Minister Ram Mohan Naidu said the black box is being examined by the Aircraft Accident Investigation Bureau. The air crash left 275 people dead, including 241 passengers and crew members. So there was speculation on whether the black box would be sent to the US, but as of now, the government maintains that the black box is being examined here in India. The Navi Mumbai airport, run by Adani, will charge a user development fee of 620 rupees for domestic passengers. This has been approved by the airport regulator. Now, this fee is 3 times higher compared to the fee at the Mumbai airport. International passengers will pay 1,225 rupees, which is 2 times more than the Mumbai airport. Madhya is standing by with more details. Madhya, why do airports charge the user development fee, and how does the UDF vary across different airports across the country?
Well, UDF, or user development fee, as you mentioned, is a charge levied by the airport operator on the passenger, which is included in the ticket. So the original practice was to charge UDF on departing passengers. But in the last few years, we've seen airport operators bring new structures for collecting UDF from passengers. But before I tell you about what the structures are, here's what Navi Mumbai Airport will charge when it starts operations, which is expected later this year. So domestic departing passengers at Navi Mumbai Airport will pay 620 rupees, while international departing passengers will pay 1225 rupees for arrivals. UDF is 270 for domestic passengers and 525 for international travellers. Navi Mumbai Airport is owned by the Adani Airports that controls 7 other airports, including Mumbai, Jaipur, Ahmedabad, Guwahati, Lucknow, Thiruvananthapuram, and Mangaluru. The other trends that started with Adani Airport controlled Mangaluru Airport to levy UDF on arriving passengers. So the GMR group that owns Delhi Airport brought in the class-based UDF for international passengers. So Mangaluru Airport is charging domestic departure UDF of 735 rupees with arrivals at 315 rupees. International departures UDF at 1120 rupees and arrivals at 480 rupees. Moving on to Delhi Airport, which brought in class-based UDF for international passengers. So economy class travellers pay 650 on departure and 275 on arrival, while business class passengers are charged 810 on departure and 345 on arrivals. Finally, at Mumbai International Airport, the UDF also varies for classes. For international passengers, economy class departure UDF is 615 rupees and arrivals at 260, whereas business class passengers pay 695 on departure and 304 on arrivals. So what airports are doing is keeping domestic UDF on the lower side and charging international passengers more depending on the class, which is economy and business, and arrival and departures. Airports claim they need higher capital to undertake development and expansion activities, and hence the higher UDF. Looking at the trend, passengers should brace for similar fees at other airports as well.
All right, Madhya, so get ready to shell out more. This is going to have to be borne by you and me as paying customers who are traveling by air. With that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC-TV18. Stay tuned. We're back in a minute with more.
You're watching Commodity Champions. I'm Manisha Gupta, and we'll talk about diamonds now, which are glittering and how. If you look at 2022, we saw prices trade at all-time highs, and the demand was stronger as well. And then it was in 2023 and 24 when we saw the prices decline and demand take a slight backseat as well. But 2025 has come back quite strong. Joining us now to take the discussion forward is Susan Jacques. She's President and CEO, GIA. I also have with me Pritesh Patel, who is Senior VP and Chief Operating Officer at the GIA. Thank you so much for joining us here on our CNBC studios. Susan, to you first, and 2025 has started on a very strong note. There's a lot of campaign happening, a lot of conversation. Natural diamonds are back in scene. How are you looking at this year?
You know, it's been a difficult few years in the German jewelry industry. 2021 was a little bit of an aberration coming out of COVID, when travel was non-existent, dining out was not what it used to be, and the jewelry industry actually had its best years ever. There was a slowdown since then, but we're seeing some signs of improvement, and we're delighted at that.
When you look at numbers, and Pritesh, this one is to you. I mean, of course, we've only seen half of this year yet, but the way it is picking up, how does the second year seem to you?
Well, I think the U.S., specifically the U.S. market, seems to be doing okay so far in the first half of the year. People are still optimistic about the second half of the year. They're continuously looking good as the markets are doing very well. So we anticipate that similar trend going into the second half of the year as well.
Susan, you are in India, and that tells us the importance of India on the map of diamonds right now, from being from cutting and polishing diamonds to a consumer, and the second largest that is. What's your sense on the demand growth here, and what are you anticipating?
You know, I think India has historically always been very culturally accepting of diamonds, and from diamonds being the primary source from the 4th century till the 16th century. But diamonds have always been a culturally important part of the jewelry of the Indian communities. And we're very excited. I mean, over 20 years, it's gone from being 2% of global demand to right now about 11%, and the second largest market in the world. And so I think the US market is still 55% of natural diamond sales occur in the US, but India has such an opportunity to continue to grow and really appreciate the beauty of jewelry.
So when you talk about 11%, Pritesh, what geographies are we looking at in India? Is it still about metros, or do you see a lot of aspirational demand also coming in from perhaps tier 2, tier 3 cities in India?
What we hear from our teams in there is that it's not only in the tier 1 cities, but tier 2 and tier 3 cities are picking up as well. You're seeing more demands specifically in the tier 2 and tier 3 cities. So I think it's all around the things. There's a pockets in southern India as well as in northern India and the western side of it as well. So it's going across all the cities.
All right, yeah, well, absolutely. There's a lot of aspiration in India, Susan, and we've seen those numbers come in. Talk to us about the year that is. You know, we've seen a couple of years of disruption because of lab-grown diamonds. Would you say that the markets kind of have settled now because there are buyers for this segment and then there are buyers for that too?
I think, you know, both will coexist. I'm a big believer that there are clients for both. For GIA, the criticality is ensuring consumer confidence. That's why we exist. Our mission is to ensure the confidence in gems and jewelry, and trying to dispel some of perhaps the consumer confusion that I think is in the marketplace today. But there is, through advanced technology, thankfully, the ability for lab-grown diamonds to be produced in gem quality today. But there is nothing like the rarity of natural diamonds and the magic of that particular treasure of Mother Nature.
And that brings us to a very, very important question. And this is about you changing the way the natural diamonds are graded and the way lab-growns are graded. What really brought to that?
You know, back in the 1950s, when GIA came up with the 4 C's of diamonds, so the color, the clarity, the cut, and the carat weight, it was because of the continuum of color and clarity that natural diamonds were found within. And what we've seen over the last couple of years in particular is laboratory-grown diamonds. 95% of them today are actually grown in very, very narrow bands, the rarest of rare. colorless and very, very high clarity VVS or flawless. If they're not grown that way, they're actually high pressure, high temperature treated to be in those categories. And so for us, it doesn't relate to the continuum of color and clarity that the scale of 4Cs was originated for.
And has the market accepted that? What are the conversations like?
I think we've had a lot of conversations, and I'll defer to Pritesh to speak to it, but a lot of conversations with our clients, with retail customers, with consumers as well, just ensuring that they understand. I think a lot of diamonds today in the marketplace, lab-grown and natural, are being sold as the same. Now, optically, chemically, physically, they are the same, but they are grown very, very differently. And I think the importance that we feel is making consumers make an educated decision based on the facts and understanding the differentiation between the two categories.
Oh, absolutely. So, Pritesh, as this comes to you, would you say that the markets have accepted that? Because, 15, 20 years ago, when I bought perhaps my first diamond, there was no certification. I do not have a certificate for that. But lately, in last decade or so, well, yes, it has picked up quite strongly in India as well. And now a change in certification.
I think market so far, since we made an announcement, it's been very positive. We have been hearing from actually both sides of the aisle all of our clients who submits for the natural grading certification as well as the laboratory grown. There's a lot of debate, but overall, if I had to say, a majority of them have accepted. Their understanding of it, how the differentiations are in the same nomenclature that was created for the natural diamond 4Cs do not apply today, especially with the technology product the laboratory grown diamonds are. And us coming up with a different nomenclature will help consumer get educated.
Clearly. Susan, when you look at overall numbers then, and I was reading a De Beers report which says that the Indian diamond demand from where it stands right now perhaps could double by 2030, 2035. Do you see that stronger demand emerging?
I think that, again, it comes to educating consumers and consumers understanding there are many ways to spend your discretionary income. And I always talk about the fact that diamond is not a need product. However, it's an emotional need, and it's bought for the most important milestones in people's lives. And I think there is a strong demand with the jewelry culture of the Indian communities for that to continue to grow. I think 50% of purchases happening in jewelry today, diamond jewelry today, are happening in people under 35 years old. And so I think as the millennials and Gen Z come of age, there's a burgeoning middle class, and there's that desirability for luxury products. And I think we will continue to see growth in it, for sure.
Just taking that piece out, Pritesh, there's a lot of wealth creation that we've seen happen in Asian markets, especially India as well. And the spend is on the higher side for luxury products, including diamonds as well. So on one side, we have the smaller pointers, and on the other side, there are these bigger stones doing well too. How do you see both of those markets, and what's your sense on growth for both?
I think there will be growth on both sides. We have seen similar things happen in other gem material like emeralds and rubies, where there's a natural product and then there's a synthetic products that come, and they both coexist. Pearl is another example of it. So I think both of them is going to coexist in the market. As the differentiation in the pricing happens, what we're going to see is that there is a clear distinction of people who is going to aspirational product that on the higher end is going to continue to grow. At the same time, the younger generation is going to, who couldn't afford to get it in, they'll be able to get affordability, and they'll be stepping into that part. And at some day, they will aspire to go into the larger natural diamond sector as well.
Susan, you're in India, and I keep pushing that point because I do understand that just so much work about natural diamonds is being done in India now because, one, it's a huge population, there's a lot of wealth being created, and there are buyers here. When it comes to campaigning, marketing, creating awareness, how are you working all of that in India?
You know, for GIA, we are an independent organization, and so our role is very different than perhaps a retailer, a manufacturer, or a miner.
Diamond Council, for that matter.
Absolutely. But working together collaboratively, I think for all of us, the consumer confidence is critical. And so how do we ensure consumer confidence in this product category and a full understanding of what people are buying so that they can make educated decisions? And that's the criticality for us as an organization.
So when you look at India, would you say that the awareness is increasing, growing, people understand the diamond?
I think there is, and I do think that you've got incredible retailers here that work really hard to make sure that they are educating consumers. I do think that you've got a lot of pure play lab-grown businesses starting up as well. In the American market, there was very strong adoption. I think one of the points that I would hope people take away is understanding in diamond-producing countries, the lives impacted by the mining and the mining companies giving back to the communities is really, really important. And Botswana is the poster child for that. When diamonds were discovered there in 1966, there were 6 kilometers of paved roads. Today, there are thousands of kilometers, and the free education, the free medical, all of that came about because of natural diamonds. And so as you buy a product, I think understanding the impact it's having on the world is an important piece to also understand.
Welcome back. You've joined us here at Commodity Champions, where we are discussing diamonds with the GIA team who's visiting us here in CNBC studios. And we're talking about diamonds and especially the Indian demand and aspirations going forward. Just coming back to India yet again, and there's this whole conversation about charges and then making charges and the whole calculation of how diamond jewelry comes to you. That's not the case really when you look at various other international markets, not in case of US where diamond jewelries are sold at an MRP, or China for that matter. Do you see India changing?
I'm not the most expert in this Indian market, but you know, if you look at the other examples of the U.S., for example, I think there will be an opportunity for people to look at the value added that gets into the jewelry of it is building on the natural diamond or laboratory grown diamond, the gold or silver or platinum that gets added into it, and people look at jewelry in many of the other markets as a store of value.
As a piece of art, perhaps.
Yes, a piece of, correct.
Not the quantity of gold or the diamond or the making charges. Or
absolutely, and it's a lot of times it's an emotional purchase. It's pass it on to generations. In the United States, it's been used as wealth, that especially the diamond jewelry gets passed on to generations, similar to what happens in India with the gold jewelry. So I think that trend will change as people's demographics change, their ability to purchase at a higher price point. Those things will change.
Susan, when overall, internationally, do you see demand now coming back? Especially US, you said, is improving. It's coming back in China. Middle East seems like another very, very strong growing market.
I think there are a lot of emerging markets for this product. I think South America, very concentrated in colored stones because that's a lot of what they mine there. I think in Africa, I think that in Asia, in India, all of these increasing middle class have the desirability, I think, for luxury products, and I think we'll see it grow. I think China has come back slower than perhaps people originally anticipated might happen after the pandemic, and so I think we are seeing signs of that today occurring, which is a very good thing. They were the second largest market for diamond jewelry. Japan is very strong as well right now. But at the retail level, I do think that, again, the mining and the manufacturing sector has been hard hit for the last couple of years. But at the retail level, they have sustained really continually good sales. And just for example, the magnificent jewels auction at Christie's this last week, record prices, and more than 30 of the items featured had GI grading reports with them. So I think that there are people buying product for all sorts of different reasons, and one of them is asset class.
Susan, there are a lot of other certifying agencies over the world as well. How would you say you stand tall amongst them all?
I think GI's independence and the fact that we're a not-for-profit organization based in Carlsbad, California, and we have a very simple mission. Our mission is to inspire confidence in gems and jewelry, and that's why we were created in 1931. It's the work that we do decade on decade, increasing technology, using innovation, instrument development, but underpinning everything we do with groundbreaking research that we fund to the tune of tens of millions of dollars a year to ensure consumer confidence, and our education to, again, educate those new leaders into the jewelry industry. Jewelry design is a very big part of what we also teaching around the world. And so I do think that, you know, that specialization of a niche market, we're a small niche market, the jewelry industry.
When it comes to India, and this is a number guesstimate that I would want, 11% penetration right now. Where do you see it by 2030?
I think it's going to continue to grow. Some estimates I see it is they're talking about doubling that number, right? And especially with the emerging upper middle class, we see there's an opportunity to grow, and especially when you look at the whole category of natural and laboratory grown. It's going to bring a lot of new customers. It actually is going to be very inspirational for a lot of people to come into the segment. So I think it has a chance to double the numbers in the next few years.
All right, that's a very, very bullish one. But Susan, since you certify so many diamonds, what is your market share here in India? And with the kind of certification that is happening here, do you see a change in the kind of diamonds that Indians are buying?
I do think that, again, it's all about educating. And I think that the retailer is the primary source for education. I was a retailer for 31 years, and I have to say I loved that ability to interact with people as they bought very special items to commemorate milestones in life. And I do think that that sales associate and the training of the sales associate to be able to help a consumer make an educated choice is really, really important and critical. I do think, though, that the market will continue to grow. I think it will evolve. I think consumer tastes and trends change with each generation. But I do think that there is nothing more magical, truly, than a natural diamond that formed 1 billion years ago. And you get to wear an item that's 1 billion years old that came to the surface of the earth through a volcano. I mean, there's no more magical item that you can actually purchase and wear than a natural diamond. But there's a very important place for lab-grown diamonds as well in the marketplace as an affordable product.
Susan, you said, right? Isn't some of those diamonds are older than stars in the universe? So what else you can buy that can have that long story?
And just coming back to that question yet again, so what really are Indians buying? Since you're certifying those diamonds, what would you say Indians understand their diamonds now with what they're buying, with what goes under your lens now?
I think we continue to see the more education happening at the consumer level. I think there's a lot of more opportunity to do it. It's more of a newer thing in India compared to United States or China or Japan, who is a much more mature market in there. So I think there's a lot more confusion about the products in there. So I think our role as a GI, as an educational institute, is to bring that education to the retailers and the consumers. And more consumers that we can educate, it's going to help the whole sector and bring new consumers into the market. So I think our vision is to ensure that every opportunity we get, we're educate the consumer before they make their purchase, right? So they know what specific product they're buying. Either that could be a diamond, that could be a color stone, pearls, which we as a GIA, we teach, we educate, we research, as well as we grade every one of them. And so through all of those mechanisms, we bring more education at the forefront.
Pritesh, we've seen natural diamonds being around for many, many years. And then, of course, there are more and more newer products coming in. The lab-growns is one part of it. And it's not just for the diamonds. It's also for pearls. There are cultured pearls. And then you have so many varieties of grown emeralds and rubies. And it's a very separate parallel market as well. And the youngsters really seem to be going in for that. How do you see, is only the wealthy and 30 and 40 plus buying diamonds? Is the younger generation going in for the affordable version? How are you looking at it?
I think the trend has been, the younger generation also looking into luxury, right? So I think they also look at it as a luxury part of it. There is a trend for younger generation to go into experience. That's another thing. When they're making their decisions, they're looking to buy a product or go for spending experience. And some of these laboratory-grown synthetic products gives them that opportunity to step in and buy those lower price point items. And then eventually in the future, they will be able to buy the natural products. So we see that as an entering category for many of the younger generation, younger consumers, that eventually they will make, when they get older, they'll be able to buy more of natural products.
As I wind down this conversation, a final question to you, Susan. So would you say that the natural is what is an investment, a long-term emotional investment, if not that, and the synthetic product perhaps is more of an aspiration? It's something that you experience.
I think that, people buy for all sorts of different reasons. And I do think that there is a wondrous story around natural diamonds, obviously. I've been in the industry a very long time, and it is the product category that the industry has focused on until very recently, when laboratory-grown diamonds in gem quality came to market. But I do think that there are a separation that occurs, and it occurred with cultured pearls and natural pearls in the pricing. When the prices fall so considerably, they coexist and they become very different products. The same thing happened after synthetic rubies and emeralds came to market in the 1890s, by the mid-1920s, they were two very separate categories. And I think the same thing will land with diamonds in the future.
Fair point that. Pritesh, Susan, thank you so much for taking time out, coming out to our CNBC India studios. We appreciate your time.
Thank you.
And with that, that's all the time that we have on Commodity Champions. Thank you for watching.
Hello and welcome to News Center. I'm Parikshit Luthra. US President Trump lashed out at both Israel and Iran, accusing both nations of violating the ceasefire agreement. In a stern statement, Trump even used an expletive and warned both nations. US President told Israel not to drop any bombs on Iran, saying, and I quote, "Bring your pilots home now." End of quote. Missile sirens were heard in Tel Aviv and parts of Israel. A few hours ago, Israel's defense minister accused Tehran of launching new missiles. In violation of the ceasefire, he ordered the country's defense forces to respond to Iran's violation with intense strikes in the heart of Tehran. Iran is denying Israel's claims. According to Reuters, Iranian officials have denied firing any missiles at Israel. Hopes that the ceasefire will hold is sparking a sharp drop in oil prices and a relief rally across global stock markets. Trump's announcement of an end to the 12-day war came after Iran retaliated against US strikes on its nuclear sites by attempting to attack a US military base in Qatar. Iran missiles were intercepted over the skies of Doha, and the US officials reported no casualties. Here is the US president issuing a warning to both Israel and Iran.
Israel, as soon as we made the deal, they came out and they dropped a load of bombs, the likes of which I've never seen before. The biggest load that we've seen. I'm not happy with Israel. Basically have two countries that have been fighting so long and so hard that they don't know what the they're doing. Do you understand that?
To take this discussion forward, I'm now joined by former Indian diplomat Deepak Bhojwani. He served as our ambassador in several Latin American nations. Also on the program with us is Middle East expert Zahak Tanveer. He's also the founder of the Milli Chronicle. Thank you very much for joining us on the program today. Ambassador Bhojwani, let me begin by asking you, Trump there was extremely angry that both Israel and Iran are not listening to him. Do you feel this ceasefire that he announced is going to hold?
It seems so. It seems that both sides have accepted the ceasefire. The question is whether the timing was such that each felt that they could unleash some missiles at each other or at the other and get away with it. Iran said they were retaliating to Israel and vice versa. But I think it's quite clear that if the past days are to be believed, President Trump has the sort of influence to enforce a ceasefire. I think Iran would like to have a ceasefire, but and now it's clear Mr. Trump has told Israel that they better not drop any bombs. Unless Israel is determined to go rogue on President Trump, I think it'll hold. Well, for how long, we don't know.
Right. Zahak Tanveer, if I can get you in, do you think if Israel decides to break the terms of a ceasefire, will Donald Trump be able to rein Israel in and stop them?
Thank you, Parikshit, for having me on your show. If you look at the pattern of Israel, I don't think so that Israel has ever broken the treaty. If you look at what happened between Israel and Hamas, Israel as a state has always stick to the deals. So I believe, as of now, Iran and Israel, both of them have signed the ceasefire, but both of them are also claiming that the ceasefire has been violated. Israel is claiming that Iran is sending the ballistic missiles. At the same time, Iran is also claiming that Israel is violating the ceasefire. But Israel and the United States have been able to efficiently defang Iran as of now, but Iran as a state, the nuclear ambition is not just political ambition of Iran, it's the spiritual ambition as well. They've been waiting for the Messianic figure, and they've been doing this nuclear program for a long time, preparing for the Messianic figure. So I don't think so. As of now, Israel and United States have pushed Iran back 20 years. The 20 years of engineering and $1 trillion economy have been crippled in just 10 days. But when you speak from the perspective of the sticking to the ceasefire, I personally believe that Israel as a state will do it, but Iran won't do it.
Right. Let me go back to Ambassador Bhojwani at this point. Ambassador Bhojwani, a very important statement from the Israeli government stating that Prime Minister Benjamin Netanyahu convened the Security Cabinet and together with the Defense Minister, IDF Chief of Staff and the Director of Mossad in order to report that Israel has achieved all of the objectives of Operation Rising Lion and much more. Do you feel that Israel is now ready to stop here?
It's hard for me to say what Israel does and thinks, but it's clear that Israel's ambitions and its intentions are strategic. It wants to dominate the West Asia, starting from Iran westward, and it has already dominated a considerable part of the Arab world. The Arabs are almost silent at the genocide that is occurring in Palestine. And while they may be making some noises, they're doing nothing to prevent it or even go actively against it. The blatant illegal bombing of Tehran when negotiations were on has also been met with certain degree of hypocrisy. So Israel has achieved considerable mileage by being able to bomb and get away with it and then claim that they're honoring a ceasefire as if to say that this was not their fault and it was provoked by Iran and so on and so forth. So as far as I'm concerned, Israel has acted illegally. The US has acted illegally. They've got away with it because what we are living in today is a world where the so-called rules-based international order that the West boasts so much about, and by the West, I include Israel because it has identified with the West wholly, solely, in a de facto and a de jure way. So they're all basically acting against what they claim to be an international rules-based order, and they've got away with it. So what happens is that in Iran, which is considerably weakened, and West Asia, the Arab world, well, the part of it that is willing to stand up against Israel is also considerably weakened. So Israel has achieved a tremendous amount of gain in its strategic sense. They're also in occupation illegally, as per the world at large, as per the United Nations. You ask anyone, they have a prime minister who's been called an international criminal by the International Criminal Court, the same court that called Putin a criminal. And of course, the Great West went along with that and said Putin is now a pariah, but Netanyahu is not. The US has even so far as to sanction 4 of the ICC judges. So what we're living in is a world which has been...
All right. Let me also get in Zahak Tanveer at this point. Zahak, what do you think was the off-ramp that was offered to Iran and Israel, both, in order to have this ceasefire?
Well, as per my opinion, the off-ramp will be the economic relief, because the Iran was threatening of the closure of the Strait of Hormuz. And the Strait of Hormuz was not only the economic crippling point for the Arabs and the China or India, it was also for Iran itself. As Abdulaziz Sagar, the founder of the Gulf Research Center, recently pointed out that if Iran tries to close the Strait of Hormuz, then obviously it will be fighting back. It will be definitely hitting its own economy. So I believe this would be one of the major points of bringing Iran and Israel to the talking table, because the Arabs, especially the Saudi and the UAE, were really worried about the economic fallout of this conflict.
Right. Just last night, Ambassador Bhojwani, it was looking like all hell had broken loose in the Middle East, with Iran striking US bases in Qatar, in Iraq. There were reports from Bahrain as well. So the entire Middle East was very, very tense. This morning, we get reports that there's been no significant damage to Qatar. President Trump has spoken to the Qatari Emir. J.D. Vance has spoken to the Qatari Prime Minister. The Qatar leaders have spoken to Iranian leaders, and all is sorted out. What role do you think Qatar played in this?
I think Qatar would have considerable influence, because it has been a kind of, if not a balancer, it's been a sort of an interface between the Arab world, the Iranians, and other countries, the West particularly. What seems to have happened is that Iran, I mean, again, I'm conjecturing, I don't know. Iran seems to have tracked US assets. They perhaps had to make a show of it. And if I remember right, Mr. Trump claimed in one of his statements that they had known about this, the Iranians had told them about it. So there were no human casualties, and one missile got through. Happening was
right, Ambassador Bhojwani, we'll try and rectify your feed. Your video has frozen right now. We'll try and correct it as soon as possible. Maybe you can log in again in a short while. But let me go back to Tanveer. Tanveer, you know, the role of Qatar in all of this, do you think it was all pre-decided, with Iran informing Qatar where it's going to attack? Why is it attacking? Do you think somewhere Iran had been given this face saver and this was the off-ramp that, yeah, you can carry out these attacks and then just have a ceasefire?
Exactly. It happened. As the New York Times reported that 3 Iranian military generals already informed Qatar that there will be the U.S. attacks from the Iranian side on the U.S. base in Qatar. And this is not the first time. This is the second time. If you look back at 2020, when Qasem Soleimani was eliminated, Qatar was the one who gave bases to Donald Trump's, during his first terms. it was Qatar who gave the basis, and you would see the next day or the third day, Qatar was in Tehran consoling and giving the condolences to the Iranian supreme leader. So yeah, Qatar was already informed by the Iran that this is some kind of face saving for the Iran, because Iran has lost a lot in this war. And the second point I would definitely like to make here, as the former ambassador Bajwani was mentioning, that Arabs are silent over this. I would say that Arabs are watching silently, but yeah, the Iranian militias have unleashed a lot of hell and chaos on the Arab world in the past 20 years. You see the case of Lebanon, you see the case of Syria and Yemen and Iraq, and you see what they did in the other Arab worlds like the Bahrain. So the Arabs know what Iranian militias are up to, and if you compare the statistics of the mayhem and the bloodshed and the killings the Iranian militias have done on the Arab world and the Muslim world, you would definitely find it surprising that it's triple than what Israel has done in Palestine, in Gaza, or West Bank. So I would definitely disagree with him respectfully that the Arabs are silent, because Arabs know what Iranian regime is up to. But at the same time, the Iranian regime is also the existential threat to Israel as well. So for the past, 30 years, Iran has been threatening Israel that it will gonna be wiping off Israel off the map. So this is not how a state works.
Right. Let me go back to Ambassador Bajwani. Ambassador Bajwani, welcome back to the program. Going forward, do you think Israel will continue its operation against Gaza? And how long will these ceasefire violations continue? Because Iran has said that they'll agree to the ceasefire if Israel stops firing. Israel is saying the same. How long do you think this fighting between the two sides could continue now?
It's hard to say, because Israel is an agent provocateur. With all due respect to your other guest, Mr. Tanvir, I disagree that Iran is creating havoc. It's Israel that is the occupying force. And if anybody doesn't want to believe that, well, that's up to them. And the Palestinians have been suffering not just a genocide now, they've been suffering occupation for decades. So Iran is not interested, in my opinion, in, of course, they see Israel as an illegal power. They're an illegal occupation of Arab lands. And also the US was responsible partly for the Iranian revolution, which brought in the Shah in the 50s, Mr. Mossadegh, and this is US officials, high-level officials have confirmed that it was a coup engineered by the US. So there is a history behind this. Now, as far as Iran is concerned, my belief is that Iran is considerably weakened, sure, because it has massive forces rallied against it. It just wants to continue with its life. True, it is a theocratic state. True, a lot of people don't like that. Fine, including in their own country. But there are several countries, including those supported by the West, which are under regimes which are not popular entirely among their own populations. But that's what it's all about, this world, the strategic world. Now, the point is, Iran will I don't think they will provoke any confrontation if they're left to themselves. But I think that Israel, which is an occupation of even more Syrian land than they had occupied earlier, and clearly this is illegal, no matter what anybody says. You can check your records, ask the United Nations. It is an illegal occupation of lands. So Israel is the provocation here. The Hezbollah, Hamas, the Syrians, etc., are all Arabs. They may be Shia in Lebanon, right, sure, but they are people living in their own country who are resisting Israel.
All right. And, you know, there are a lot of reports on social media, of course, as to how Donald Trump has done a India-Pakistan on Israel and Iran, essentially announcing a ceasefire before either of the two could do so. He went on to say that both nations came to me asking for a ceasefire. Do you think Israel was on board with what Trump was about to announce?
Who's the question addressed to?
To you, Ambassador Bajwani.
Okay. Well, again, it's very difficult to say what was done and what was said. My impression from the reports I read, I don't have inside information. I mean, I don't think many people do. But the fact is that Iran was in negotiations and talks with the Americans. indirect, whatever, in separate rooms or whatever. Hello? Hello?
Yes, sir. We can hear you.
Hello, can you hear me? Yeah.
Yes, sir. We can hear you.
Okay. So the basic thing is that there were talks ongoing, and I understand that Steve Witkoff and perhaps another representative of the Trump administration was also attempting to reach through to the Iranians, who had said very flatly over the past few days that if Israel continues this bombardment, there's no question of talking. I also understand that the Iranians had said that we have a right to peaceful nuclear development for power, for nuclear power. And this apparently was another issue with the Americans. Now, the fact of the matter is, and here again, I'm going out on a limb. I don't know if your viewers would like this or not. The fact of the matter is that Israel has a nuclear bomb. It is not a member of the NPT and refuses to sign it. Iran has abided by its NPT obligations, and it is a fact that it does not have a nuclear bomb. The US people even the US Director of National Intelligence said so as recently as in March. Trump doesn't want to believe that. So what he's been doing is been talking at the Iranians, not to the Iranians, in my opinion. He's been wanting to attempt a regime change, and that's led to all this.
All right, we've completely run out of time, but thank you very much, Ambassador Bhojwani and Tanveer, for joining us on the program. This is a story that we will continue tracking. It's not ended. There is a ceasefire, but both sides don't seem to be respecting it for the moment. We're taking a break here on News Center, but coming up, India and US are still working towards a trade deal, but it's looking difficult before the 9th July deadline. Why? And what happens now? We'll speak to former Indian ambassador to WTO, Anjali Prasad, on the possible concerns. Welcome back to News Center. India is keen but not desperate to sign the US trade deal before the 9 July tariff deadline. We learned from sources that negotiations are stuck on agriculture, dairy and genetically modified crops. Officials from the Commerce Ministry are set to visit the US soon for the next round of in-person negotiations. However, Finance Minister Nirmala Sitharaman has said that a deal with the US is close, adding India's effective tariff rate is far lower than what is being perceived. I'm now joined by Anjali Prasad, former Indian ambassador to the World Trade Organization. Thank you very much for joining us on the show today. Anjali Prasad, ma'am, we have been seeing how the United States is putting pressure for us to open up our agriculture sector, our dairy sector, and they also want access for genetically modified crops. Now, these are red lines for us. It seems that it's getting difficult for India to make a compromise here, and officials are now indicating that perhaps a deal may not be possible And if that doesn't happen by the 9th of July, we will be slapped with a 26% reciprocal tariff as it stood on the 2nd of April, the day the tariffs were announced. Do you think the government is now taking a right stand by saying that let's not be desperate, no need to make further compromises, let there be further talks?
Thank you for having me on your show. I must say that the government is taking an absolutely correct position. We should stand firm on this. The agriculture sector, as I had said in an earlier show of yours, is extremely sensitive. And as you know, almost 60% of our population is dependent on agriculture and allied sectors, which includes dairy. GM crops are against human health, and therefore we should stand very firm on not allowing entry of these crops into India. And therefore I support the government in its position that we should not be arm twisted into this trade deal.
Right. What will be the impact on India, ma'am, if a 26% reciprocal tariff even comes into effect, while the average tariff before the 2nd of April was around 2.3 to 3% on the US side? If our exports are subjected to a 26% tariff, how bad will things be for India?
I want to emphasize that India is a domestic market-led economy. It is not a trade-led economy. Let's first get that very clear. Trade has been a very small percentage of our GDP all through, ever since we have recorded data. Less than 2% perhaps. Now, yes, there might be some loss of exports in the immediate term, but let's not forget that there are importers on the other side as well who are importing our products. And there would be domestic pressures on the US administration by those importers as well. So I don't think we should be desperate. We should be in a hurry. We should call the bluff and wait and watch. I don't think there would be a major calamity on our exports or sectors.
Right. Ma'am, what do you think is the impact of geopolitical tensions, such as the US role and direct involvement in the Iran-Israel war? You've also seen the flip-flops of America when it comes to India and Pakistan. Donald Trump has gone on to say that he wants to have a trade deal with Pakistan, how Pakistan is a great country. He even hosted General Munir, Asim Munir of Pakistan, the Field Marshal of Pakistan, for lunch at the White House. This was a break from protocol. You're hosting an army chief. You're not hosting the head of government, but an army chief for lunch at the White House. Do you think these factors also play when it comes to negotiating a trade deal? These things may make the Indian side a little cautious.
You know, from what I have gathered, from whatever I have read of the negotiations, none of this is obviously out on the table. What is out on the table is a pure trade negotiation, which has to be in national interest and mutual interest of the two. Now, the two economies, as you know already, are highly asymmetrical. We are, at best, a low middle-income country by per capita income. So, the two economies cannot call themselves equals or negotiating on a level playing field. They are focusing mainly on our market, and that is their major interest. So we should be very, very cautious. Geopolitical factors, of course, remain in the background, but I do not think they are influencing the negotiators who are absolutely on the right track here.
Right. Thank you so much, ma'am, for joining us on the program, making important points that India should not be desperate. We should sign a deal which is only in our national interest and not offer far-reaching compromises to the US government, because we don't know how they will act on the trade deal and the promises made today in the next few months. That's all we have time for here on News Center. Thank you for watching. Goodbye.
gives me great pleasure to welcome here on Voices from the Valley, someone who's been a mentor to us, a mentor to Young Turks, and someone I've had the privilege and the pleasure of speaking to in the past. He is, of course, well known as the father of the Pentium chip, but more importantly, he's a man who's had his eye and his pulse on changing technologies, and we are at a crossroads at an intersection of a pretty big tech chain. So it would be nice to hear his views on that. He's also just been awarded India's highest civilian honor, the Padma Bhushan. Vinod Dham, ladies and gentlemen, thank you so much for joining us here this evening. May I request you to join us up on stage and get the event started. Thank you so much, Mr. Dham. It's an absolute pleasure to have you here with us. Ladies and gentlemen, a big round of applause. So let me start with that. What was it like being in Rashtrapati Bhavan, getting the Padma Bhushan, Mr. Dham? You've got the microphone right next to you.
You know, I was getting goosebumps twice. Once when the President of India enters the Darbar Hall, and you're all seated, and they play the drum a little bit, and then all Jan Gan Man, our national anthem. Somehow, growing up in India, right from the first, second grade, like most of us, you had heard it, you had sung it, and now here we normally don't sing it. And when you go back and it happens, it really brings a lot of emotions back. And that's what happened to me. I mean, it's a beautiful building. I shouldn't call it a building. I don't know what the right word would be. And interior is, you know, enormous. And the whole thing was done with a lot of pomp and show. The presence has a lot of these well-dressed, I don't know, they are Army, Air Force people standing behind. And of course, Modi ji is also there, and the Home Minister is there. And I must tell you, this happened on the day after or 2 days after the whole unfortunate incident in Kashmir. And I think maybe the same day. And I was just going to be taking my flight from San Francisco, and the limo was going to come pick me up. And my wife and I were going to go to this ceremony, and she just said, "What if they cancel it?" And I said, "Yeah, there's a chance that they might." And luckily for me, I called the Home Ministry, the contact I had there, and he said, "Please take the flight. There is no way it's going to be canceled." And I must say that even during the interactions that I had with Prime Minister Modi that evening, which the Padma Bhushan gets an extra time with him after the photography session, I was looking for some sign of stress or, you know, concern or anxiety or rush. No, not at all. Not only he spent adequate time with each one of us, and we were in Ashoka Hall at that time taking photographs, but there was a annex where all the guests, like my wife and my brother who were there, were to wait for us to come have snacks. And they said that he made it a point to go to that entire hallway and meet all the guests as well, which is just remarkable. So I'm sold on that man. If there are people here who don't like him, I apologize to them. But I just always pray that he lives long enough and really puts us back on a track, because a country like ours has been off track for a very, very long time. And then sometime it felt like it's coming on track, and then he'll go off track. We need somebody to stay there long enough to really keep it on the track so it stays on track no matter what happens in the future.
Well, we'll talk about the AI track and the semiconductor track in India in just a bit. But, you know, what a journey it's been for you, coming to the US with $8 in your pocket to now being awarded the Padma Bhushan. You know, did you imagine such a future for yourself?
Well, no, I didn't. But I must say, the reason I came with $8 was mere stupidity. Not that I didn't have more money or I couldn't afford to have gotten a little bit more exchange if I needed to. I had applied, you know, it was typical back in the 70s. You apply to the campuses, and once you pick where you want to go, and I picked University of Cincinnati because they had a semiconductor lab which had more sophisticated equipment than the semiconductor company I was working in India. You could go from literally cutting a ruby, which is almost like making a mask, to fabricating the entire wafer in the lab, on the campus, packaging it, and then testing it. I mean, it was unthinkable. So that's why I picked them. And they were writing to me for a year and a half, and somewhere I read that you have free tuition scholarship, and you have an assistantship for $325 a month. Then I told my mom, I said, oh, I don't need any money. I just need enough money to go from here to there. And the government of India could only give you $8 then anyway. Although I could have probably used some context to get some more money exchanged, but I felt no need for doing that. So I come down here, I go to meet with the foreign student advisor, Mrs. Mary Campbell. And by the way, like some of you, when you're that young, in your early 20s, and you come and you have corresponded with Mary Campbell for a year and a half, you have some imagination about who she would be, how she will look like. There's some kind of a secret about feeling. So I had this lot of expectation I'm going to meet Mary Campbell finally. And of course, she was a wonderful, petite lady from South Carolina with the southern accent, and I had my Indian accent. You can imagine how beautiful this country is. They don't really mind any accent. And I sat down and she said, how was your flight? How was your journey? I said, everything was fine. And then she's expecting me to get up to leave because there are other foreign students too waiting to meet her. And then she looks at me and says, something wrong? I said, yes, ma'am. She says, what? I said, I just arrived yesterday and I found out that the efficiency will cost me $90, which is a room that you share with somebody. And the health insurance is $10 per month. That's $100. And I assume I'll need a little bit more money to survive with food, right? So she gave me $125 from what she said to me, and I didn't know what the meaning of that word was back then. She went to the other room and came out and gave me in $20 bills and a $5 bill, $125 cash, and said, return it at $25 per month once you start making your money. And it's from the petty cash. And I had never heard of what a petty cash is, but I didn't care. I said, as long as I have this money and I can go eat a hamburger for lunch, hamburger for dinner, I am fine with it.
Well, speaking of petty cash, let's talk about what's happening with the AI race today. And I know that you were in India. You've been talking to the Indian government about what it intends to do as far as the semiconductor mission is concerned. We've finally gotten started. Speaking of putting things on track, do you believe we're on the fast track? Do you believe we're in the slow lane today?
You're talking about now
India.
The semiconductor mission or AI and semiconductor mission and the general?
AI and semiconductor both, because they are kind of converging together.
So we started off with a bang on semiconductor. So we literally, my idea and suggestion that they followed was that we need to have a semiconductor fabrication facility. And we don't need 2 nanometer. At least let's get started with 65, 40, 20. And if you can get to 14, that's good enough because a lot of products can be built on that. And we should have one packaging capability. So to that extent, they have, by the way, 6 different programs going on at different stages of the thing. But I think we still need more, in my opinion. And somehow I feel we are not as aggressively pursuing it as we were initially because there was something new about it. Yeah. So maybe I need to go back and really push a little bit harder.
What would you like to push harder, though?
I think what we need, of course, this particular fund, we had an outlay of $30 billion. I think they consumed bulk of it. There's some more need to be done. And we are in the process of creating what we call ISM 2.0, which is India Semiconductor Mission 2.0, where we want to do things slightly differently now that we have learned what works and doesn't work, and allocate perhaps even more money from the program. And particularly AI is very dear to me. And I look at AI as part of really deep tech. To me, a lot of the engineers here are basically, I'm going to assume, are software people. And when they talk about AI, they only think of AI like the AI stack. And they talk about AI stack in terms of software and algorithms and applications. To me, they forget AI cannot exist without the underlying chip that we build, right? So I built the Pentium and 486 and 386, and now those are called Blackwells and Hoppers and things like that. Not much different, just a different breed of things in different time frame. That is a very essential element of really for India to succeed in AI race. And to succeed, right now we don't build those GPUs ourselves. Although I would love to see India make its own GPUs. And I'm personally quite engaged in that process of making sure we have that capability and capacity. As you know, AI has become an arm race. And
you almost liken it to a nuclear arms race.
That's right. It's even more specifically, the chip is the fuel, the uranium that's needed, which is hard to procure, and all the countries want to keep it themselves, and that is the GPUs. And that's why I think it's important that just like India finally broke out and created its own nuclear bomb, the atom bomb, they need to really figure out a way to make this own GPU. And clearly we need all the help from USA, because even to make the GPU, designing GPU is one thing. To fabricate GPU, we do need very advanced equipment at some point. And we would need okay from America to really, because America is the farthest in this race and really own, basically, I would say, bulk of the semiconductor world. Even though most of the semiconductors are made outside of America and they're coming back, the fact very few people know is that USA still holds key to the key elements of it, and not only in equipment, but the GPU intellectual property too. And that's why they are, waxing their muscle, flexing their muscle quite a bit with China, as you know, in terms of what they can get and not get.
Geopolitics is going to weigh on some of the decisions that take shape within this space, whether it's semiconductors or AI. You talked about the US and China and export restrictions and export controls that are currently in place already. But, you've got the rare magnet situation with China flexing its muscles on that front as well. Given how geopolitics is playing out today, do you believe that a world where we could see deeper collaboration, even between allies and partners like India and the US, is a logical way forward? Do you believe that we're now going to see more deterrence coming in the way of this collaboration and partnership that was expected, anticipated, and hoped for?
So there are two elements to this arms race in AI. One is the word arm itself talks about the military side of things, like with AI, you have these killer robots, you have drone, you have autonomous anti-missile guns, all kinds of things that literally will give an edge to one country over the other country in terms of fighting military war. To that degree, I don't think there will be protection. So the answer to your question is, I think the countries like USA will be very careful about who they give the most advanced technology to, so that it doesn't get into the hands of someone where it becomes a problem for them, rightfully so. But the other side is AI is also an economic force, because it's going to completely change the way we live, the way we work, the way we deal with every aspect of our life, given a certain near period of time. We already are beginning to see some changes in that. To that extent, I think the whole world should benefit from it. And therefore, the restriction should be much lower, if any, and there should be more free exchange, especially with, I would say, trusted partners like India, who is a trusted partner today. But, the way the U.S. government is today, what happens today can change with a tweet tomorrow. So.
Or later tonight.
Or later tonight, who knows?
Yes, who knows? But one of the other debates that's raging today, and I think many governments across the world are grappling with it, India certainly is grappling with it at this point in time, is should we invest our capital, our resources, our bandwidth in creating our own large language models or not? And I know that you have a point of view on this. There are both sides. Some sides argue that, look, let's play on the application layer. Others believe that, no, we must invest back a sovereign model. Which camp do you belong to?
I personally belong to the camp that, the large language models have become almost a commodity. There are quite a few players who have developed them. And I think going at this stage and creating that type of capability, just for the sake of creating our own unique capability, I don't think it's worth it. And there are a lot of open sources. We can take one of those and really build on that and personalize it, because we do have multi-languages in our country, and we have our own culture. For example, we make a statement that nobody will ever say that in English. We are like that only. There's a book somebody wrote, and I had invited her to my fund annual event, and the title book was "We Are Like That Only." And she's explaining to all my audience, which are all Americans who had given me $200 million to invest, saying why we are the way we are. So we are unique, and therefore we will need something unique in our models to really reflect upon.
What could that be?
I don't know what could that be. That's just our regular behavior of the way we deal with every issue in life. First, we are most talkative people. So I think data will never be a problem in India.
Yes, we'll keep generating
Absolutely.
more and
they are
more.
having difficulty. They're creating synthetic data. I think if they go to India, they will never have a problem with creating any synthetic data.
Yes, that clearly is not going to be a problem. But, you talked about the social consequences, the economic consequences as well, and you believe that this is going to benefit the world in the long term. But in the near term, the fear and the trepidation around displacement, around job losses, around what this could potentially mean and do to societies, to people, how do you see this playing itself out?
So I must say that I come from a chip side, so I look at things really far more from the chip angle as to how fast is AI penetrating. To me, it's not just the large language models and various algorithms. It is to me also how the chips are promoting. So if you follow, I worked with Gordon Moore for 16 years, and late Gordon Moore, and he created a law called Moore's Law.
Yeah.
And the Moore's Law was an exponential law, which was based on an observation he made just over a few years, that the number of transistors you can put into a chip or die doubles every 2 years. Okay, this was just an observation, and it held true. He made that in 1965. It held true till almost the end of the 90s, and became Moore's Law. Now, if you look at what's happening with the, let's call it, what's his name, Jensen Huang's law. Now, Huang's law is just mind-boggling. I had difficulty even building the chips that are plotted on Moore's law, trying to mentally get my head around exponential nature of things in real life. They are doubling their performance every 3.5 months.
Yeah.
That means they are 7 times more than Moore's law. And if I take a very simplistic idea, we started 386 in 1985. To me, there were chips before that, 8086, 8088 that IBM had, and before that, Intel started with 4004, which really was the inventor of microprocessor. But it really became more mainstream at 386. And then Pentium made it a household name, so people started buying it home.
Yeah.
It took 30 years for their journey to take place. What we did in 30 years, we are now trying to do that in about 4 to 5 years. Now it brings back, if it is true, if my math is correct, it means we could be truly, in this decade itself, begin to see some big layoffs, especially from...
I wouldn't doubt your math. I don't think anyone here would doubt your math either.
And my rationale and logic, people may disagree with me, but I truly feel very concerned about the fact that, of course, we'll lose jobs. That everybody knows. The question is how soon, and are we prepared for that?
Yeah.
And if we are not, what are we going to do about it? So there's all this talk about tariffs and trade and interest rates and dollar and blah, 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 but nobody's talking about both, if we are that successful, of course, we'll have significant productivity improvement.
Yeah.
So our GDP probably will be higher, but we will have corresponding less need for people. What are we going to do with that is a much more serious issue in my mind, because, if people are idling, that's a very serious problem.
you know, if you had to start over today, and you are in many ways starting over by putting your money into startups that you're investing in, but if you had to start over today, what is the one problem that you would like to solve using all that we have by way of AI?
And the problem I'm trying to solve is to make a GPU, because it will be very unique, if not unreasonable, to have only one company make a GPU for the entire world, right? That just is not very practical, I think. But I truly believe that there is opportunity for more people. So that's where I am putting a lot of my time, energy, and money on.
As you look at what is happening in India today, as you look at what's happening in the US today, what would you say governments in both areas need to be mindful of? But more importantly, what do you believe entrepreneurs in India as well as the US who are betting on this next big tech change need to be mindful and sensitive of?
So there's a lady named Ramni Manian. She's in Chennai. And I met her. She did a similar thing with me 15 years ago. I met her then. I was in Chennai, so she held that thing. I said, what do you do? She was, at that time, GM, Ford, and all these automotive companies were coming to India. And she was teaching the American CEOs and the staff cultural sensitivity about India to make them more understanding of our culture. I think we need her to do something like that with the government of the United States today, because there is a goodwill, but they need to understand the sentiments, deep sentiments, like, as most of you know, recently in that Pak-India war that lasted a few days, who knows what the reality is, but the fact is, however it came out, it hurt deeply the sentiments on India's side. And I'm not sure they really fully grasp the depth of it and how it really changes a lot of things. Similarly, I think Indian government needs to understand when US says, we need your help, they mean it. And you need to really deeply think about not just that moment, but long-term, short-term, and around, and not just every time be coming across as a unreliable partner or not somebody they can truly bank on. I won't say unreliable, somebody they can truly bank on. It's a very difficult puzzle to solve. I'm not a politician and I'm not a diplomat, but I think, if anything, if those two countries can figure that out, I think a lot of things will flow much more smoothly than they right now do.
And the entrepreneurs, what should they be sensitive of?
I think the entrepreneurs are very smart on both sides. Actually, entrepreneurs in India are very well versed with what's going on here, by the way. I think, if anything, they need to be more sensitive about that there's a huge market. So this other company that I waited 3 years for a software guy to come through, and his biggest orders are coming from Philippines. And I don't know how the hell he went there and what he did there. But there are countries like Philippines, Malaysia, and Indonesia that have large populations. They need all the same technologies that India has. And the Indian entrepreneur who's constantly looking at US to sell things can also, I think, go there and maybe get initially it validated and get going there, and then come here with a little bit more confidence and more value than they do right now. I think that would be my reply to you.
Well, Vinod Dham, we are ever grateful to you for joining us here this evening and sharing your passion for India, for semiconductors, for technology, and for the partnership between India and the US. Ladies and gentlemen, Vinod Dham, thank you so much for joining us here this evening. Thank you so much, sir.
Hello and welcome to News Center. I'm Parikshit Luthra. US President Trump lashed out at both Israel and Iran, accusing both nations of violating the ceasefire agreement. In a stern statement, Trump even used an expletive and warned both nations. US President told Israel not to drop any bombs on Iran, saying, and I quote, "Bring your pilots home now." End of quote. Missile sirens were heard in Tel Aviv and parts of Israel. A few hours ago, Israel's defense minister accused Tehran of launching new missiles. In violation of the ceasefire, he ordered the country's defense forces to respond to Iran's violation with intense strikes in the heart of Tehran. Iran is denying Israel's claims. According to Reuters, Iranian officials have denied firing any missiles at Israel. Hopes that the ceasefire will hold is sparking a sharp drop in oil prices and a relief rally across global stock markets. Trump's announcement of an end to the 12-day war came after Iran retaliated against US strikes on its nuclear sites by attempting to attack a US military base in Qatar. Iran missiles were intercepted over the skies of Doha, and the US officials reported no casualties. Here is the US president issuing a warning to both Israel and Iran.
Israel, as soon as we made the deal, they came out and they dropped a load of bombs, the likes of which I'd never seen before. The biggest load that we've seen. I'm not happy with Israel. Basically have two countries that have been fighting so long and so hard that they don't know what the they're doing. Do you understand that?
To take this discussion forward, I'm now joined by former Indian diplomat Deepak Bhojwani. He served as our ambassador in several Latin American nations. Also on the program with us is Middle East expert Zahak Tanveer. He's also the founder of the Milli Chronicle. Thank you very much for joining us on the program today. Ambassador Bhojwani, let me begin by asking you, Trump there was extremely angry that both Israel and Iran are not listening to him. Do you feel this ceasefire that he announced is going to hold?
It seems so. It seems that both sides have accepted the ceasefire. The question is whether the timing was such that each felt that they could unleash some missiles at each other or at the other and get away with it. Iran said they were retaliating to Israel and vice versa. But I think it's quite clear that if the past days are to be believed, President Trump has the sort of influence to enforce a ceasefire. I think Iran would like to have a ceasefire, but and now it's clear Mr. Trump has told Israel that they better not drop any bombs. Unless Israel is determined to go rogue on President Trump, I think it'll hold. Well, for how long, we don't know.
Right. Zahak Tanveer, if I can get you in, do you think if Israel decides to break the terms of a ceasefire, will Donald Trump be able to rein Israel in and stop them?
Thank you, Parikshit, for having me on your show. If you look at the pattern of Israel, I don't think so that Israel has ever broken the treaty. If you look at what happened between Israel and Hamas, Israel as a state has always stick to the deals. So I believe, as of now, Iran and Israel, both of them have signed the ceasefire, but both of them are also claiming that the ceasefire has been violated. Israel is claiming that Iran is sending the ballistic missiles. At the same time, Iran is also claiming that Israel is violating the ceasefire. But Israel and the United States have been able to efficiently defang Iran as of now, but Iran as a state, the nuclear ambition is not just political ambition of Iran, it's the spiritual ambition as well. They've been waiting for the Messianic figure, and they've been doing this nuclear program for a long time, preparing for the Messianic figure. So I don't think so. As of now, Israel and United States have pushed Iran back 20 years. The 20 years of engineering and $1 trillion economy have been crippled in just 10 days. But when you speak from the perspective of the sticking to the ceasefire, I personally believe that Israel as a state will do it, but Iran won't do it.
Right. Let me go back to Ambassador Bhojwani at this point. Ambassador Bhojwani, a very important statement from the Israeli government stating that Prime Minister Benjamin Netanyahu convened the Security Cabinet and together with the Defense Minister, IDF Chief of Staff and the Director of Mossad in order to report that Israel has achieved all of the objectives of Operation Rising Lion and much more. Do you feel that Israel is now ready to stop here?
It's hard for me to say what Israel does and thinks, but it's clear that Israel's ambitions and its intentions are strategic. It wants to dominate the West Asia, starting from Iran westward, and it has already dominated a considerable part of the Arab world. The Arabs are almost silent at the genocide that is occurring in Palestine. And while they may be making some noises, they're doing nothing to prevent it or even go actively against it. The blatant, illegal bombing of Tehran when negotiations were on has also been met with certain degree of hypocrisy. So Israel has achieved considerable mileage by being able to bomb and get away with it and then claim that they're honoring a ceasefire as if to say that this was not their fault and it was provoked by Iran and so on and so forth. So as far as I'm concerned, Israel has acted illegally. The US has acted illegally. They've got away with it because what we are living in today is a world where the so-called rules-based international order that the West boasts so much about, and by the West, I include Israel because it has identified with the West wholly, solely, in a de facto and a de jure way. So they're all basically acting against what they claim to be an international rules-based order, and they've got away with it. So what happens is that in Iran, which is considerably weakened, and West Asia, the Arab world, well, the part of it that is willing to stand up against Israel is also considerably weakened. So Israel has achieved a tremendous amount of gain in its strategic sense. They're also in occupation illegally, as per the world at large, as per the United Nations. You ask anyone, they have a prime minister who's been called an international criminal by the International Criminal Court, the same court that called Putin a criminal. And of course, the Great West went along with that and said Putin is now a pariah, but Netanyahu is not. The US has even so far as to sanction 4 of the ICC judges. So what we're living in is a world which has been...
All right. Let me also get in Zahak Tanveer at this point. Zahak, what do you think was the off-ramp that was offered to Iran and Israel, both, in order to have this ceasefire?
Well, as per my opinion, the off-ramp will be the economic relief, because the Iran was threatening of the closure of the Strait of Hormuz. And the Strait of Hormuz was not only the economic crippling point for the Arabs and the China or India, it was also for Iran itself. As Abdulaziz Sagar, the founder of the Gulf Research Center, recently pointed out that if Iran tries to close the Strait of Hormuz, then obviously it will be fighting back. It will be definitely hitting its own economy. So I believe this would be one of the major points of bringing Iran and Israel to the talking table, because the Arabs, especially the Saudi and the UAE, were really worried about the economic fallout of this conflict.
Right. Just last night, Ambassador Bhojwani, it was looking like all hell had broken loose in the Middle East, with Iran striking US bases in Qatar, in Iraq. There were reports from Bahrain as well. So the entire Middle East was very, very tense. This morning, we get reports that there's been no significant damage to Qatar. President Trump has spoken to the Qatari Emir. J.D. Vance has spoken to the Qatari Prime Minister. The Qatar leaders have spoken to Iranian leaders, and all is sorted out. What role do you think Qatar played in this?
I think Qatar would have considerable influence, because it has been a kind of, if not a balancer, it's been a sort of an interface between the Arab world, the Iranians, and other countries, the West particularly. What seems to have happened is that Iran, I mean, again, I'm conjecturing, I don't know. Iran seems to have tracked US assets. They perhaps had to make a show of it. And if I remember right, Mr. Trump claimed in one of his statements that they had known about this, the Iranians had told them about it, so there were no human casualties, and one missile got through. Happening was role.
Right, Ambassador Bhojwani, we'll try and rectify your feed. Your video has frozen right now. We'll try and correct it as soon as possible. Maybe you can log in again in a short while. But let me go back to Tanveer. Tanveer, you know, the role of Qatar in all of this, do you think it was all pre-decided with Iran informing Qatar where it's going to attack? Why is it attacking? Do you think somewhere Iran had been given this face saver and this was the off-ramp that, yeah, you can carry out these attacks and then just have a ceasefire?
Exactly, it happened. As the New York Times reported that 3 Iranian military generals already informed Qatar that there will be the U.S. attacks from the Iranian side on the U.S. base in Qatar. And this is not the first time. This is the second time. If you look back at 2020, when Qasem Soleimani was eliminated, Qatar was the one who gave bases to Donald Trump's, during his first terms. It was Qatar who gave the basis, and you would see the next day or the third day, Qatar was in Tehran consoling and giving the condolences to the Iranian supreme leader. So yeah, Qatar was already informed by the Iran that this is some kind of face saving for the Iran, because Iran has lost a lot in this war. And the second point I would definitely like to make here, as the former ambassador Bhojwani was mentioning, that Arabs are silent over this. I would say that Arabs are watching silently, but yeah, the Iranian militias have unleashed a lot of hell and chaos on the Arab world in the past 20 years. You see the case of Lebanon, you see the case of Syria and Yemen and Iraq, and you see what they did in the other Arab worlds like the Bahrain. So the Arabs know what Iranian militias are up to, and if you compare the statistics of the mayhem and the bloodshed and the killings the Iranian militias have done on the Arab world and the Muslim world, you would definitely find it surprising that it's triple than what Israel has done in Palestine, in Gaza or West Bank. So I would definitely disagree with him respectfully that the Arabs are silent, because Arabs know what Iranian regime is up to. But at the same time, the Iranian regime is also the existential threat to Israel as well. So for the past, 30 years, Iran has been threatening Israel that it will gonna be wiping off Israel off the map. So this is not how a state works.
Right. Let me go back to Ambassador Bhojwani. Ambassador Bhojwani, welcome back to the program. Going forward, do you think Israel will continue its operation against Gaza? And how long will these ceasefire violations continue? Because Iran has said that they'll agree to the ceasefire if Israel stops firing. Israel is saying the same. How long do you think this fighting between the two sides could continue now?
It's hard to say, because Israel is an agent provocateur. With all due respect to your other guest, Mr. Tanveer, I disagree that Iran is creating havoc. It's Israel that is the occupying force. And if anybody doesn't want to believe that, well, that's up to them. And the Palestinians have been suffering not just a genocide now, they've been suffering occupation for decades. So Iran is not interested, in my opinion, in, of course, they see Israel as an illegal power. They're an illegal occupation of Arab lands. And also the US was responsible partly for the Iranian Revolution, which brought in the Shah in the 50s, Mr. Mossadegh, and this is US officials, high-level officials have confirmed that it was a coup engineered by the US. So there is a history behind this. Now, as far as Iran is concerned, my belief is that Iran is considerably weakened, sure, because it has massive forces rallied against it. It just wants to continue with its life. True, it is a theocratic state. True, a lot of people don't like that. Fine, including in their own country. But there are several countries, including those supported by the West, which are under regimes which are not popular entirely among their own populations. But that's what it's all about, this world, the strategic world. Now, the point is, Iran will I don't think they will provoke any confrontation if they're left to themselves. But I think that Israel, which is an occupation of even more Syrian land than they had occupied earlier, and clearly this is illegal, no matter what anybody says. You can check your records, ask the United Nations. It is an illegal occupation of lands. So Israel is the provocation here. The Hezbollah, Hamas, the Syrians, etc., are all Arabs. They may be Shia in Lebanon, sure, but they are people living in their own country who are resisting Israel.
All right. And, you know, there are a lot of reports on social media, of course, as to how Donald Trump has done a India-Pakistan on Israel and Iran, essentially announcing a ceasefire before either of the two could do so. He went on to say that both nations came to me asking for a ceasefire. Do you think Israel was on board with what Trump was about to announce?
Who's the question addressed to?
To you, Ambassador Bhojwani.
Okay. Well, again, it's very difficult to say what was done and what was said. My impression from the reports I've read, I don't have inside information. I mean, I don't think many people do. But the fact is that Iran was in negotiations and talks with the Americans, you know, indirect, whatever, in separate rooms or whatever. Hello? Hello?
Yes, sir. We can hear you.
Hello, can you hear me? Yeah.
Yes, sir. We can hear you.
Okay. So the basic thing is that there were talks ongoing, and I understand that Steve Witkoff and perhaps another representative of the Trump administration was also attempting to reach through to the Iranians, who had said very flatly over the past few days that if Israel continues this bombardment, there's no question of talking. I also understand that the Iranians had said that we have a right to peaceful nuclear development for power, for nuclear power. And this apparently was another issue with the Americans. Now, the fact of the matter is, and here again, I'm going out on a limb. I don't know if your viewers would like this or not. The fact of the matter is that Israel has a nuclear bomb. It is not a member of the NPT and refuses to sign it. Iran has abided by its NPT obligations, and it is a fact that it does not have a nuclear bomb. The US people have, even the US Director of National Intelligence said so as recently as in March. Trump doesn't want to believe that. So what he's been doing is been talking at the Iranians, not to the Iranians, in my opinion. He's been wanting to attempt a regime change, and that's led to all this.
All right. We've completely run out of time, but thank you very much, Ambassador Bhojwani and Tanveer, for joining us on the program. This is a story that we will continue tracking. It's not ended. There is a ceasefire, but both sides don't seem to be respecting it for the moment. We're taking a break here on News Center, but coming up, India and US are still working towards a trade deal, but it's looking difficult before the 9th July deadline. Why? And what happens now? We'll speak to former Indian ambassador to WTO, Anjali Prasad, on the possible concerns. Welcome back to News Center. India is keen but not desperate to sign the US trade deal before the 9 July tariff deadline. We learned from sources that negotiations are stuck on agriculture, dairy and genetically modified crops. Officials from the Commerce Ministry are set to visit the US soon for the next round of in-person negotiations. However, Finance Minister Nirmala Sitharaman has said that a deal with the US is close, adding India's effective tariff rate is far lower than what is being perceived. I'm now joined by Anjali Prasad, former Indian ambassador to the World Trade Organization. Thank you very much for joining us on the show today. Anjali Prasad, ma'am, we have been seeing how the United States is putting pressure for us to open up our agriculture sector, our dairy sector, and they also want access for genetically modified crops. Now, these are red lines for us. It seems that it's getting difficult for India to make a compromise here, and officials are now indicating that perhaps a deal may not be possible. And if that doesn't happen by the 9th of July, we will be slapped with a 26% reciprocal tariff as it stood on the 2nd of April, the day the tariffs were announced. Do you think the government is now taking a right stand by saying that let's not be desperate, no need to make further compromises, let there be further talks?
Thank you for having me on your show. I must say that the government is taking an absolutely correct position. We should stand firm on this. The agriculture sector, as I had said in an earlier show of yours, is extremely sensitive. And as you know, almost 60% of our population is dependent on agriculture and allied sectors, which includes dairy. GM crops are against human health, and therefore we should stand very firm on not allowing entry of these crops into India. And therefore, I support the government in its position that we should not be arm twisted into this trade deal.
Right. What will be the impact on India, ma'am, if a 26% reciprocal tariff even comes into effect, while the average tariff before the 2nd of April was around 2.3 to 3% on the US side? If our exports are subjected to a 26% tariff, how bad will things be for India?
I want to emphasize that India is a domestic market-led economy. It is not a trade-led economy. Let's first get that very clear. Trade has been a very small percentage of our GDP all through, ever since we have recorded data, less than 2% perhaps. Now, yes, there might be some loss of exports in the immediate term. But let's not forget that there are importers on the other side as well who are importing our products. And there would be domestic pressures on the US administration by those importers as well. So I don't think we should be desperate. We should be in a hurry. We should call the bluff and wait and watch. I don't think there would be a major calamity on our exports or sectors.
Right. Ma'am, what do you think is the impact of geopolitical tensions, such as the US role and direct involvement in the Iran-Israel war? You've also seen the flip-flops of America when it comes to India and Pakistan. Donald Trump has gone on to say that he wants to have a trade deal with Pakistan, how Pakistan is a great country. He even hosted General Munir, Asim Munir of Pakistan, the Field Marshal of Pakistan, for lunch at the White House. This was a break from protocol. You're hosting an army chief. You're not hosting the head of government, but an army chief for lunch at the White House. Do you think these factors also play when it comes to negotiating a trade deal? These things may make the Indian side a little cautious.
You know, from what I have gathered, from whatever I have read of the negotiations, none of this is obviously out on the table. What is out on the table is a pure trade negotiation, which has to be in national interest and mutual interest of the two. Now, the two economies, as you know already, are highly asymmetrical. We are at best a low middle income country by per capita income. So the two economies cannot call themselves equals or negotiating on a level playing field. They are focusing mainly on our market, and that is their major interest. So we should be very, very cautious. Geopolitical factors, of course, remain in the background, but I do not think they are influencing the negotiators who are absolutely on the right track here.
Right. Thank you so much, ma'am, for joining us on the program, making important points that India should not be desperate. We should sign a deal which is only in our national interest and not offer far-reaching compromises to the US government, because we don't know how they will act on the trade deal and the promises made today in the next few months. That's all we have time for here on News Center. Thank you for watching. Goodbye.
We're at the headquarters of a company that features in the top 50 most valuable companies in the world by market cap. The company has decided to go all in on agentic AI. We are talking about Salesforce, and joining me now to talk about the road ahead is Madhav Thattai. Madhav, thanks very much for joining us here on Voices from the Valley. It's great to have you with the OG of the agent workforce.
That's right. Agent Astro. Right
Agent Astro. So, let's talk about this. Mark Benioff has made it very, very clear. He believes this is going to be a game changer, that digital labor is going to be the way forward. And this is going to not just enhance productivity, it's also going to add significantly to global GDP. That's the bet. How is that working out?
Yeah, it's really been great. We believe that the workforces of the future are going to be hybrid workforces. We think that agentic technology has now reached a point where every customer, every business function in the future will effectively manage a workforce that comprises of humans and agents working together. We've seen a tremendous pace of innovation in the last few years, starting with the consumer LLMs. And then at Salesforce, we've really taken this stance for how do we ensure this technology is ready for enterprise? And by making it ready for enterprise, we believe that every customer experience, every employee experience is going to be fundamentally changed. And it's a bold vision for the future. We're very, very excited about it. And we think Salesforce has a key role to play in that.
What are you seeing in terms of adoption? What are you seeing in terms of traction? How much momentum do you really have today?
Yeah, we're really seeing activity and momentum from customers across the board. We have thousands of customers today that are playing with Agentforce. Agentforce as a business reached 100 million in ARR, which was the fastest growing product that Salesforce has ever had. And we have customers that are really pushing the adoption, pushing the technology at all kinds of stages of maturity. We have a great customer in the US, OpenTable, that you might be familiar with. Yeah. And OpenTable really started with starting to use these agents in the B2B side of their business, so facing their restaurants, and now has moved it to face their diners as kind of an end-to-end customer lifecycle. And so seeing some really significant adoption, momentum, growth with businesses like that. We see customers really experimenting in a couple of different patterns. We see customers that are adopting this for their full customer-facing lifecycle. Marketing, sales, customer service. And then we also see a lot of activity on how do we augment, how do we drive productivity, how do we drive efficiency with our employees. And so Agentforce is really built to satisfy all of these broad sets of use cases, and we're really seeing some pretty deep adoption and motivation for customers to try to build better experiences.
So as the momentum picks up and perhaps accelerates as well, what could this 100 million ARR look in a few years? I mean, what's the aspiration, what's the ambition that you have, the headroom for growth?
Yeah, I think when you think about the scope of the digital workforce, that is an incredibly large business. That is really, we're talking about the global enterprise. What we are really laser focused on right now is obsessing about customer success at every step of the way. That is the most important thing to spend time on. This category was created in the last 6 to 8 months. Yeah. A brand new category by which we believe workforces will evolve. And so what really matters at the moment is how do we ensure customers are driving to the right outcomes? How can they do that in a trusted, safe way? How can they make sure that they have the right data, the right business process that's genuinely going to drive those outcomes? And so we're just really obsessed with that right now, and we believe that is really the critical path to unlocking the full potential of this technology for our customers.
You know, you talked about being a category creator, so to speak, and so in a way you're kind of building out the market, right? I mean, you're setting up the templates for how this is going to be used and how it's going to be adopted. So what are some of the key challenges that you see today? What are some of the key headwinds that you see today in terms of adoption? One of the factors that a lot of people talk about is interoperability. I mean, how do you look at that? I mean, what do you see as the big challenges?
It's a really good question. When you think about building an agentic technology, we really see 3 important things that customers have to do. Number 1, they have to be able to trust that the agent is secure, that it is managing their data accurately, that it is providing the accurate experience, whether it is customer-facing or internal-facing. And if you think back, even a couple of years ago when we started on this generative journey, our focus first and foremost was trust. It's the number one value at the company. It's been at the core of Salesforce for 25 years as one of the preeminent cloud technologies. Never been more important than in this agentic world. So you have to start with trust. The next thing we really spend time on with customers is ensuring that the agent has access to the right data.
Yeah.
And this is an important question that we work with customers on. How do we ensure to drive the outcomes that you care about, that we are bringing in the right data that is going to satisfy these agents? And that started with our journey on Data Cloud. How do we ensure that the right data is activated within Salesforce and therefore available to the agent? So that's kind of the second step. And then the third thing we really spend time on with customers on is, let's really think about your business process. Salesforce has been a place where customers have done incredibly important work for their companies. Their sales process, their service process, their marketing process. These are critical functions that Salesforce already plays a big role in. And so we're deeply embedded with customers on how they drive those outcomes, how they drive those business processes. So we really spent a lot of time on that. So while we are thinking about build, the next thing to then think about as customers get down the adoption journey is, how do you manage these agents?
Yeah.
How do you observe how they're performing? How do you make them better? How do you improve them?
Yeah.
And then we get to what you talked about, which is the boundaries between organizations is something that humans cross a lot today. In order for these agentic systems to genuinely operate across business functions, even across companies, this interoperability layer is really important. And in fact, that's something that we have put a lot of investment in that we're going to be talking about quite a bit this week, is how do we ensure that our agents can interoperate across business functions and across ecosystems of data and tools effectively, so that the agents can complete their tasks.
So what is going to be new now? What is it that you're prioritizing? What should we expect?
Yeah, you're going to see a lot of innovation in every one of these pieces. We want to make sure that the build process is as easy as possible. We're announcing hundreds of industry templates, easy ways to get started. We are really innovating on how AI can assist in building agents, continue to make that better. So a lot of great investment on the build side. The second piece is observability. How do we know that the agents are performing in the way that you want them to? How can we improve this performance? How can we make sure that the outcomes that you initially set up are something that's being delivered by the agents? So this management layer, observability layer is really important. And then the third thing that we're really excited about is the interoperability. How do we make sure that these agents can communicate across org boundaries? How can they communicate with other systems? Because very often, completing a task cuts across a lot of different tools. And so that interop layer is really, really key, and something that we're super excited about our investments there.
So let's talk about investments. I mean, in terms of the investments made already, how much more do you believe you will need to do in terms of incremental investments from here on?
Yeah. The big advantage we have at Salesforce is we are sitting on 25 years of an incredibly extensible and incredibly secure and a robust platform. That is what we've inherited. And at the core of the platform is, how do we ensure customers have privacy and trust baked into every interaction?
Yeah.
How can we make sure the platform is connected to other data systems, to other tools? And the Agentforce product effectively inherits all of these capabilities from the platform. And so we have quite a running start when you think about what needs to be built. There has been a tremendous amount of innovation in the last couple of years, certainly leading up to Agentforce in the area of tooling to really effectively build agents, tooling to observe and make these agents better, and now tooling to interoperate these agents across complex architectures. And so I think there's a tremendous amount of progress that we've made on that. We're seeing customers experiment really at every stage of this. Customers like Lennar, who are using our agents for lead generation on SMS.
Okay.
They've adopted the platform and are starting to experiment with their customers. Their needs now are about observability and management.
Okay.
And so when we partner really close with these customers, we learn about, okay, these are the patterns that we now have to go build to make our testing tools better, to make our analytics tools better. Customers that have complex architectures, even going back to the OpenTable example, the customer service agent sits within an ecosystem of tools that a company like OpenTable uses. In the future, they're going to want to know how are these agents going to operate across these things. And so there's a real set of capabilities that will start to roll out on interoperability and how the agents can work in a trusted, contextual, authenticated way. You're going to see a lot more of that coming up.
You know, you just talked about trust several times, and that's sort of the core philosophy driving everything at Salesforce, including Agentforce. The balance between autonomy and putting the guardrails in place so that you can manage that autonomy as well. I mean, how much of a concern is that? How much of an issue is that? And do you also see that as an opportunity for a company like Salesforce? As you said, you enjoyed 25 years of a legacy which you're building on. Everybody else at this point in time is also talking about wanting to get into agentic AI in some form or fashion. Do you believe this is going to be one of the differentiators for you to be able to hone in this capability?
Absolutely it is. Trust is at the center of every interaction that we manage and that we work with our customers on. If you think about where customers use Salesforce, they're using it for some of their most important and critical business functions, touching their customers. And so it's absolutely at the center of everything that we do. Now, within the context of agents, a lot of attention goes to the LLMs.
Yeah.
And this is a remarkable technology because you're now interacting with technology in natural language. And that opens up an entirely new type of customer experience. It opens up a new way in which we interact with software. And so it's a phenomenal innovation. But we do not believe that the LLM alone is sufficient in an enterprise. Because in enterprise, they care about their data.
Yeah.
They care about permissions and access to that data. They care about ensuring that their business process is executed on consistently, accurately, predictably. They care about how do we ensure that these systems are improving over time. Variability is both a benefit because you can create very natural experiences, but as a business, I also want to exercise control. And so that notion of trust is really at the center of what Salesforce is about and has been for a long time. And we believe it's absolutely critical as these agents start to take on more autonomous tasks. Our ability to build, manage, improve these agents becomes equally as important.
You know, India and the significance of India as part of this agentic universe that you speak of, it is a critical market for Salesforce, both from an engineering talent perspective, but also as a market. How are you seeing, from a markets perspective, the Indian adoption, as well as from an engineering perspective, what India contributes to the agentic universe?
Yeah, so India, from 2020 to 2024, grew to be the second largest headcount that we have at Salesforce after the US. We now have over 13,000 people in India across a variety of functions, both in global functions like engineering and support and so on, but also for the local market itself. We could not be more excited about the growth in India. We saw 36% year-over-year growth in that market that we reported on in Q4. And really seeing the pace of innovation in India accelerate in a significant way. We had our developer conference in Bangalore just a couple of months ago. And the ecosystem that you see across partners, across the Salesforce developer community, across the kind of innovative use cases that customers are thinking about, has just been really exciting. That market, I think, is poised for incredible growth and incredible innovation. And so we're really, really excited to continue our investment.
But what do you see as the next big inflection point as far as Indian adoption is concerned?
So we see some patterns in India that I think are applicable to other parts of the world. And it really is this notion of, we want to start with, how do we trust and build these agents? How do we then drive to ensure that we are gaining the outcomes that we want? Hero FinCorp is a good example of a customer where they are thinking about getting 75% of their loan applications in 30 minutes. Now, that is a massive experience driver for a financial services organization. And so we really want to make sure we are very closely partnered with customers on what is the core outcome that you want to go drive, and let's ensure we're building the technology towards that. You often see, and we've seen this with prior technologies as well, when a technology is adopted kind of for the sake of the technology, that's not usually a path to productivity. For this technology, we want to be laser focused on, here's the outcome, here's the goal, here's the KPI, and let's ensure we're designing, building, and helping you manage these agents towards driving that outcome.
How do you see your clients at this point in time looking at ways to hire, whom to hire, which roles to hire humans for, and which roles to leave agents to do the job for?
Yeah, it's a great question. I think the hybrid workforce is going to take a lot of forms. Whether it's 50-50 or some other percentage is hard to predict. But depending on what part of the life cycle you're thinking about, you could have a lot of different kinds of agents. In general, I put the agents into 3 buckets. There's going to be agents that are really focused on end-to-end customer experiences. Equinox, that runs a fitness company, is a great customer of ours. And they really think about these agents being the front end for their member interaction in a highly personalized, specific to that customer way. It's not just, where can I find my next fitness class? It is, where can I find my fitness class, knowing my history, knowing where I am, knowing the things I want to do before and after, and really make it personal to my experience. And so you're going to see agents of that kind. And these agents are interesting because they will cross marketing, sales, customer service boundaries, where they're really thinking holistically about the experience. That's one class of agents. You're also going to see a lot of agents that are improving productivity. How do I ensure I have a task that an agent can augment me with, that I can perform now more efficiently than I could before the agent? And then there's a third class of agents that are doing work that customers don't do today. For example, I have thousands and thousands of marketing leads, but I don't have enough salespeople to go after every one of those leads or to qualify them. And so this kind of at-scale work is going to also become a really important part of workforces in the future. Asian Paints, which is a customer of ours in India, they're really using this kind of agentic technology to tie together all their data streams and make highly personalized recommendations to expand the scope at which they can drive very personal outcomes for their customers. So you're really going to start to see agents take multiple different forms, and we envision a future in which the humans and the agents are working in this hybrid workforce in ways that really drive these key outcomes.
You know, talking about this hybrid workforce, and again, I think there is a fair degree of fear in terms of what this is going to mean, especially what it's going to mean for younger developing economies like India. How do you respond to that fear? How do you respond to that concern?
Look, we believe that the agents are going to augment the human workforce in significant ways. We believe that the technology that brings this human plus agent workforce together is going to unlock new opportunity. It's going to unlock an expanded ability for us to build incredible experiences for our customers, personalized, tailored experiences that we could not do before. And so that is a really inspiring view, I think, of how we think about what the future is, what the future really looks like. Make no mistake, any job today is a job that will use agents in some way. So that education is really important. That skilling is really important. We have resources at Salesforce with our Trailhead capability that for a very long time has educated people, not just on Salesforce technology, but on how do you actually make your business better? And the same applies here. Whether you are in HR or in legal or in finance, you are going to use these tools in incredibly powerful ways. And so educating the workforce on how do we start to take advantage and make the best of this technology is what's really going to accelerate a lot of that development.
You know, for Salesforce, the 25-year journey, it's been, high double-digit CAGR. As I pointed out, it's in the top 50 as far as market cap is concerned. Of course, that changes depending on where your stock price is. But how much of this agentic future is going to be the engine of growth for the future for the company as you see it?
Look, we think that being the platform for the hybrid workforce of the future is the future of the company. And that really takes 2 or 3 critical components to come together. Number one, our applications are core in driving outcomes and business process for customers. Number two, the data that we bring in to activate inside of Salesforce is some of the most important data that customers have. Number three, the agentic platform that we've now built allows customers to take advantage of this highly scalable and extensible platform that they have used and trusted to drive core business outcomes and business process, and now create these agentic experiences out of it. And so holistically, being the platform where this kind of critical work happens for this hybrid workforce, we believe that that is the engine of growth for Salesforce in the future.
Let me end by asking you about what you're seeing happen in the Valley. I mean, we've gone through the ChatGPT moment, we've gone through the agentic moment, or we're in the midst of going through the agentic moment. I mean, as you look around you, what's the most exciting sort of wave or next wave that you're going to be watching out for?
Yeah, I think that we're still very much in how do we ensure that these agents are going to be operating at scale for customers. That is the position that we are in. And so for us, it is really about helping customers build these agents as quickly as possible and as effectively and trusted as possible. 2, helping them now manage these agents and this new hybrid workforce. And then 3, continue to extend the agentic capabilities over time so that they are interoperating across systems, that they're driving more automation, that they are really building the ability to autonomously complete these really business critical tasks. And so I'm just really excited about the amount of innovation that is happening everywhere, and that we get to really partner deeply with our customers on it.
Well, Madhav, we wish you the very best of luck with everything that you intend to do with agents, including naming them.
Always exciting.
Always exciting. But thanks very much for joining us here on Voices from the Valley, and we appreciate the insights that you've shared with us on where the future is and what Salesforce is doing about it to shape it. Thanks very much for joining us today. Well, that is the view here from the Salesforce headquarters on the agentic AI future, the digital workforce that we are going to see across industries and across companies take shape. From all of us here on the Voices from the Valley team, thanks very much for watching. Do stay tuned to CNBC-TV18. Log on to our YouTube channel. Catch us on Facebook, Instagram, Twitter. From all of us here, for now, thanks very much for watching.
रिटर्न ऑन कैपिटल कि अगर आप 100 रुपए धंधे में लगाते हो एंड इफ यू कांट जनरेट 15-16 रुपीज आउट ऑफ बिजनेस, तो उस बिजनेस का मतलब क्या है? फिर तो आप जाके अगर 7-8% ही करना है तो आप एफडी में पैसा रख दो. वन ऑफ द कंपनीज which is now known in the market is a company called Solar Industries. Today, the market cap is 1,50,000 crore. When we identify, it was 1,000 crore market cap. Narratives will work for a while. Right. But finally, top line is vanity, bottom line is sanity, and cash in bank is reality. It's the promoter. He's the friend, he's the enemy.
Make or break.
Make or break. वही बनाता है, वही बिगाड़ता है. Okay. There are pockets of bubbles. I am completely acknowledging that. But it should not be painted with the same brush that everything is expensive.
I remember meeting Rhythm Desai at the Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap.
Yeah, I mean, you have to search your pockets. Yeah, and I think ये मेहनत करने का time है. For you have to go at the ground level, search for companies, search for good promoters.
Finding the ultimate multi-bagger, that mid-cap or small-cap stock that will compound in such a way that it will light up our portfolios, that it will make all our dreams come true. Let's face it, this is a big wish for most of us investors when it comes to the stock market. But finding that ultimate mid-cap or small-cap stock that will lead you to riches, it's easier said than done. So in today's edition of Market Cafe, I thought, let's go and meet a man who is one of the most celebrated and the most successful mid-cap and small-cap stock pickers of India. He's got over 2 decades of experience and he has so much to share. So let me go and introduce you to Pankaj Tibrewal of Ikigai Asset Manager. I can't tell you, Pankaj, how happy I am to be speaking to you in this environment. You know, this setting, thoda relaxed lag raha hai. Ekdam. And the conversation, I think, demands it. We're speaking to one of the most legendary mid-cap stock pickers in India. So here he is, Pankaj, and about more than 2 decades in capital markets, right? And mid-caps and small-caps have been your forte, so to speak. But before we talk about mid-cap stock picking, Pankaj, I actually wanted to spend a minute to understand today's market. In 2025, we have seen such uncertainty on multiple fronts. Do you feel that return expectations need to be scaled down from Indian equities?
So, Surbhi, last 4-5 years post-COVID has been a dream run for equity markets in India. And obviously, in many pockets, we warned in September that there's a bubble brewing up. But let's divide the conversation into 2 parts. One is the domestic and one is the global. I think the big picture first on the global side, that the world is changing. The era of globalization, we were brought all in post the World War II. I think that's leading to deglobalization or fragmentation. And I think that's a big picture change we should not ignore.
Yeah.
Countries are becoming more inward looking. They want everything in the country. Protectionism is becoming a very, very big thing.
Yeah, absolutely.
And I think that leading to some kind of a macro change globally. And to me, it's not a trade war, it's a yield war. Look at the Japanese 30-year bond yield. Look at the US 10-year bond yield at 4.5%.
So that's the thing, that in a world of very severe dislocations, I mean, who would have thought that investors will start moving out of the US?
Yes.
Who would have thought that there'll be so much of trade conflict? Who would have thought that there'll be so much of geopolitical conflict? So in this world of major shifts, where are we and where is our market? And what is the kind of market that we are probably going to be in for the next, say, 2 to 3 years?
So I think in the context of the global environment which I spoke about, which is uncertain, very volatile, I think India is an oasis in the desert. And what we have been saying that growth will pick up. And look at what happened in the fourth quarter. 7.4% GDP growth. Government capex in 1 month was 280,000 crores. What RBI has done is remarkable.
Yeah.
At least in my 2 decades, Shurbi, I have never seen so pro-growth
RBI. Usually they're so conservative.
I mean,
yeah.
Hats off to them. The
Yeah.
system was deficit, durable liquidity, 3 lakh crores in the month of January. From there till now, they have pumped in more than 10 lakh crores. And the further CRR cut, which will start from September to October, will see another 2.5 lakh crores. Coupled with that, 100 basis points of interest rate reduction.
Yeah.
So I think RBI is completely pro-growth. We are the only country in the G20 countries post-COVID which has brought the fisc from 9.5% this year to 4.4%. Only
Fiscal
country in the G20 nations. So I think we have gone a long way on the fisc consolidation. Now we think is the time to start on the escalation mode on the growth. And I think all the 3 parts I am quite bullish on, which is liquidity. Incremental liquidity is better. Incremental cost of funds will be lower than last year. And third, incremental growth, both on consumption and capex, will be better than last year.
So that's the academic part of it. Now let's translate this into, again, the market question that should investors continue expecting a dream run from Indian equities? Because post-COVID, it was a complete dream run. Then it started getting volatile and patchy. So now what?
So it'll be over longer periods of time. If you look at Indian markets, 5 years, 10 years, 15 years, 20 years, finally the EPS growth and share price growth is not too different.
Yeah.
Right? What happened in the last 5 years? Nifty 500, almost compounded earnings at 18-19%, and so was the market return.
Yeah.
The mid caps and small caps compounded between 22 to 25%. Slight PE re-rating, they saw the same returns, 25 to 30% CAGR returns. I think the earnings growth will not be as charitable as we have seen in the last 5 years. You saw margin expansion, you saw balance sheet deleveraging, and everything helped on the P&L.
Yeah.
I think going forward now, our expectation is next 2 years, the earnings growth should be between 10 to 13%.
10 to 13%.
And hence, in the near term, there could be narratives, aberration, everything can happen in the short term. But over the next 2-3 years, I think returns should mimic your earnings growth.
That brings me to the central part of this discussion. The reason why we've got Pankaj on this conversation today on Market Cafe is because I keep hearing increasingly the talk or the narrative that this is going to be now a stock pickers market. Jo chhu lo, wo chale, wo wala market nahi hai.
Yes.
You have to be very, very sure about which companies and which stocks you're picking. First of all, do you agree with this assessment?
To a large extent, I agree to this assessment. And over the last 3 quarters, we are seeing glimpse of that. How do we say we are seeing glimpse of that? Starting second quarter of last year till first quarter of this fiscal year, the headline returns of the index and the median return of the index are 2 different things. What do you mean by that? Let's look at last quarter, which is fourth quarter. The NSE 500 index was about 4.5% negative. But the median return of the index was negative 11%. 7% divergence, which means few stocks are holding the index higher, they are performing, and the profit polarization is also happening there. So my sense is that it will be a stock pickers market as you move ahead, because there is a divergence between the earnings growth of NSE 500 companies. And companies which will deliver higher than expected earnings growth will be the darlings of the market.
Sure.
And hence you need to be a complete bottom-up stock picker. It is not that everything will grow.
No, that's true.
There will be few companies which will grow faster than the average. Few companies will grow below the average. And hence we believe that if you can pick up the right winners on the earnings growth side, you will be rewarded.
Which now brings me to the crux of the conversation. What is the secret sauce? Now, viewers, some of you might know this, otherwise I'll just tell you this. When Pankaj was with Kotak Mutual Fund, you joined in 2010, right? 2010. He started off by looking at the small cap fund as well as the mid cap fund at Kotak, and I think the sizes were very, very small.
230, 250 crores.
Both put together.
Yeah.
So the funds were around 230 crores, and by the time he exited Kotak Mutual Fund, which was 2014?
2023.
Sorry, 2023. So from 2010 to 2023, roughly a 13-14 year period, I think you exited when the value of these funds, or the AUM of these funds was over 50,000.
56,000.
56,000 crores. So that tells you that managing almost $7 billion worth of assets, Indian assets, at the time that you decided to, branch out in your own entrepreneur style. So that's phenomenal. So then, how to pick these stocks, these multi-baggers, these big winners?
First, let's, I think, get the macro right.
Yeah.
I think increasingly there has been a narrative over the last few months, sell mid and small and move to large cap.
Oh, yeah.
Yeah.
Even till now.
Even till now.
I think 7 out of 10 guests that I speak to, they still say that no, large caps offer better comfort, and there's still some overvaluation in SMIDs, as they're called.
So 3 points I would like to draw. And we mentioned in our quarterly newsletter, which I published in April, that on the headline basis, when you look at valuations, we acknowledge what people are saying, that mid and small caps are expensive to their history and versus large cap. So there's a relative margin of safety there. But I think devil lies in the details. So if you go a little deeper, what you find out that earnings growth in mid cap especially has been faster in the last 5 years. Even in FY25, which was a slow year, mid caps earnings grew at more than 18-20%. And going forward also, our expectation is that mid caps and small caps can offer better earnings growth than large caps. That's the one part. The second part important is the composition of the profit pool. So if I look at the top 100 companies, 52% of the profit is coming from PSU banks, private banks, oil and gas, and PSU sector, which are generally low P in nature. And that representation in mid and small cap is to the tune of 15-16%, 17%. So generally, when you look at X of these sectors, Nifty is trading at a premium to mid and small caps. So when you do a apple to apple comparison, and the third part is, when do they trade at a huge discount? Take 2018-19. You came from a huge bull run in 2017, and then you started seeing solvency issues, right? You had Yes Bank, DHFL, all kinds of skeletons were coming out, and there was a scare of solvency. This time in now last 5 years, the debt to equity and the leverage position of small and mid caps are far, far better in many cases compared to large caps also. And the last point which I want to drive, Surbhi, is that mid and small ab utne chotu companies nahi bache. Now the definition is up to 33,000 crore market cap is a small cap. Up from 33 to 1 lakh crore is a mid cap. So and they are sectoral leaders. You take tires, you take hotels, you take airlines, you take so many sectors like infra, capital goods, auto ancillaries. All these companies are classified as mid and small, but they are sectoral leaders in the sector they operate in. So I'm saying that the cycle and the texture of the market has changed. There are pockets of bubbles. I am completely acknowledging that, but it should not be painted with the same brush that everything is expensive and everything just sell and move away. I think in this market where 5,000 listed stocks, take out the top 100 stocks, you will find at least 40-45 stocks at any point of time, which will give you that kind of a value to ride on. So I believe that you have to be a stock picker, as you rightly mentioned, and there are opportunities in the market which will make you money over a 2-3 year period.
This is very interesting, because you're the second person that I've spoken to, I think, in the last 2-3 weeks, who has actually said that Indian stocks are not necessarily over expensive. I remember meeting Rhythm Desai at the Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap. And I was like, wow, that's
I won't
refreshing.
agree to cheap, but yeah, I mean, you have to search your pockets. And I think ये मेहनत करने का time है. For you have to go at the ground level, search for companies, search for good promoters. And coming to your second point on what to do, I think over a period, what I have learned is that process of elimination is far powerful than process of selection.
There are still maybe some pockets where, you know, things are a little overheated in the small and mid-cap space. So can we sort of rule them out? I mean, do you see, I don't know whether it's maybe defense or are there certain thematic areas where you do see excesses? Which ones would those be?
So, for example, one of my yardsticks is, for example, cash flows. So look at few of the EMS companies trading in India, right? Narrative is very strong.
90 times P, 100 times P.
110 times P. But when you open their cash flow statement, not all I am saying, but many of them who are trading between 25, 35, 40,000 crore market caps, the cumulative cash flow over the last 5 years, operating cash flow, is not even more than 50, 100 crores, right? That means it's a thin margin businesses, but they are hugely deploying money in working capital to drive growth. So I think that's something we need to be, just I'm giving as an example.
An example, something to be cautious about.
That narratives will work for a while, but finally top line is vanity, bottom line is sanity, and cash in bank is reality.
Is the reality.
So cash flows you can't ignore at the end of the day. Yes, for 1 year, 2 year, there could be aberrations on cash flow either sides, but over a cumulative 4-5 year period, cash flow is something we need to be taking cognizance of.
So EMS is one such pocket. What about the hallowed defense space, where again no doubting the narrative, no doubting the forward potential given what's going on, but what about the rest of it, whether it's valuations, earnings?
So many cases valuations are out of sync with the narrative which is going on. And when we do a reverse DCF, which is discounted cash flow, many of these companies are factoring in 20% growth for a next decade perspective. I'm not pinpointing any particular sector, but we need to be cognizant that what is market factoring into. And just to caution you that there is a bubble brewing up in low free float stocks, SME names, many of those which are smaller, very small in size. There is valuation, problem. So I think we need to be careful in this market also. It's not a complete, just no-brainer market. And I think over a period of time, what you need to be cognizant about 3 things which we are part of our forensic Surbi. One, that promoters are the biggest friends and enemy of the business. So selection of the right promoter at the ground level is very, very important. And I think it is becoming more and more important in this entire volatile world, right? Disruptions will be all over the place. The promoters who are clearly have a strong skin in the game, passionate, integrity is right. I think you have to identify those promoters over a longer period. That's my learning. That one thing when I reflect back over my last 20 plus years, that which has helped my companies grow in size, it's the promoter. He's the friend, he's the enemy.
Make or break.
Make or break. वही बनाता है, वही बिगाड़ता है. So you have to be very careful on the promoter side. The second most important point, Surbi, is cash flows. So what we have seen that there is a small bit of forensic we have created, that EBITDA to operating cash flow. EBITDA minus tax to operating cash flow, if anything is less than 70% over a period of time, it's a red flag for us. So 1 year, 2 year हो सकता है, but over a 4-5 साल period में, if you are not able to convert your 70% of EBITDA into operating cash flow post working capital, then there's some problem. And the third is that return on capital. कि अगर आप 100 रुपए धंधे में लगाते हो, and if you can't generate 15-16 rupees out of business, तो उस business का मतलब क्या है? फिर तो आप जाके अगर 7-8% ही करना है, तो आप FD में पैसा रख दो. So why you are running?
Well said. All the risk of becoming an entrepreneur, running a business.
Then what's the fun? And over a period of time, what we realized that
so at least 15% return on capital employed.
Over a period in India, where the cost of equity itself is 12, 11, 13 over longer periods of time and cycle. This time it could be low because interest rates are down. So I think when you combine all these things together, I think you will probably avoid mistakes. There will be some opportunities you will miss,
हाँ.
but pitch पर लंबे समय तक खेलना है. Is my, and I think longevity is most underrated. सबको कल पैसा बनाना है.
हाँ.
लेकिन इक्विटी मार्केट
सुबह से शाम तक बनाना है.
लेकिन लॉन्गर टर्म में अगर आप अपने डिसिप्लिन को मेंटेन करते हो सकता है थोड़ा अंडर परफॉर्मेंस आएगा, कभी आउट परफॉर्मेंस आएगा, बट इफ यू आर स्टेइंग इन द मार्केट लाइक दिस फॉर इंडिया फॉर द नेक्स्ट 10-15 years, I think you will make money. So it's important that you have a forensic framework, and we have a 11-point forensic framework which we have spelled out very clearly. And हमने क्या किया सुरभि कि over the last many years we went and saw how companies destroyed capital, how they became penny stocks.
Yeah,
right.
I'm going to come to that in a second. Just to recap for our viewers, so when we are saying mid-cap stock selection, at least Pankaj's basic, formula or rule of thumb: number one, promoter. Look at 80%. Promoter integrity. Number two, look at cash flows, whether the company can generate sufficient cash flows over a period of time. And number three is going to be the return on capital employed.
And balance sheet and cash and the growth.
And the growth prospects, valuations. I'll come to valuations as well in just a bit. So 3 or 4 broad filters through which you need to look at your mid-cap or small-cap stock selection process. We've done a lot of theory. I'll come back to valuation in just a bit, because that also we need to understand, whether a stock, just because it's 70 times PE, should you not touch it? I'll come back to this, but let's do some stories as well, some storytelling in between. So give us some names, some examples where you applied these filters and then, went on to at least find a multi-bagger, and some cases where you cut your losses early because you realized that the red flags were being hit.
Yeah.
Some examples, 2 decades.
So let me just put a disclaimer first that
yes.
This is not a recommendation to buy and sell. This has been my experience and my few examples I'm just sharing so that people get a better context of what we mean. So one of the companies which is now known in the market is a company called Solar Industries, right? A very less known
up and only up.
So a less known promoters in say for example Nagpur. 2006 they came for IPO. If my memory serves me right,
2006.
2006.
Wow,
if my memory serves me correct, Surbhi, they raised about 80 plus crores, and after that they just did a small dilution in 2013-14 of 100 crores, and every 3 years their top line used to convert into bottom line, right? And very strong promoters, but over a period they kept on reinvesting the cash flows back in the business for growth. Okay. And whenever you used to meet them, you used to get a sense of passion, integrity, and skin in the game. They still hold the promoter family 75% or 74.5%. And today, the market cap is 1,50,000 crore.
And now
when we identify, it was a 1,000 crore market cap.
1,000 crores to
1,50,000 crores. And last 10 years, they have been investing in defense, for example, without a single revenue coming in. Yeah. So over a period of time, what you understand is that one, the promoter quality has to be extremely good.
Yeah.
Because businesses kabhi linear line mein nahi chalte hain.
Yeah.
There will be periods when couple of years business doesn't do anything. And we have seen that in many companies. There is a slowdown. There is some external environment problem, challenges, internal challenges. And there, when you have a conviction on the business and the promoters, then you ride that slowdown along with them.
So tell me, and Solar, just for context, I mean, now we all know Solar is so big in explosives, in defense warheads. In fact, in Operation Sindoor, I think many of those warheads were used on the various missile systems that were at play. And the stock has gone on to achieve wonders as well. So on that point of staying the course, even through the rough patches,
yes,
when a company is not showing growth,
yes,
when it's going through a painful period where operating cash flows are not rising, or maybe there's a delay, or some of the usual fundamental parameters are not getting met, or margins are getting squeezed, how do you decide to stay on versus checking out, saying that red flag nahi, or
so one thing which you don't compromise is any governance issue and any red flags on balance sheet and cash flow. I think वो जहाँ मैं देखता हूँ मैं भाग जाता हूँ, whichever the narrative or the business story will be. I think if those are intact, even in a slowdown, I think what you have to check is that is the promoter more in pain than you? See, you are 2-5% shareholder in the company.
Yeah.
Promoter is 50, 60, 70% shareholder.
Yeah.
He's pained more by the slowdown than you are.
Yeah.
And I have seen that leaders of the sectors, they work harder during that slowdown and emerge stronger after the cycle from a bottom. So I think you have to get that sense during the interaction, during the conference call of the quarters, that what are they doing to come out of that slowdown and the disruption which they are facing today. And if you get the right answers, you stay on the course, irrespective of what is happening in the market. And I think there are many companies which have seen such cycles and they came out much stronger after the cycle.
So, Pankaj, this is really interesting and it's actually very, very helpful. But we have a lot of other questions. So, viewers, we're going to take a break on this episode for now. This is part one of what's turning out to be a mid-cap investing masterclass. So, this is part one. Catch us again very soon. We'll get you part two of this conversation with Pankaj Tibrewal.
Return on capital कि अगर आप 100 रुपए धंधे में लगाते हो एंड इफ यू कांट जनरेट 15-16 रुपीज आउट ऑफ बिजनेस, तो उस बिजनेस का मतलब क्या है? फिर तो आप जाके अगर 7-8% ही करना है तो आप एफडी में पैसा रख दो. वन ऑफ द कंपनीज which is now known in the market is a company called Solar Industries. Today, the market cap is 1,50,000 crore. When we identify, it was a 1,000 crore market cap. Narratives will work for a while.
Right.
But finally, top line is vanity, bottom line is sanity, and cash in bank is reality. It's the promoter. He's the friend, he's the enemy.
Make or break.
Make or break. वही बनाता है, वही बिगाड़ता है.
Okay.
There are pockets of bubbles. I am completely acknowledging that. But it should not be painted with the same brush that everything is expensive.
I remember meeting Rhythm Desai at the Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap.
Yeah, I mean, you have to search your pockets.
Yeah,
and I think
yeah.
ये मेहनत करने का time है. For you have to go at the ground level, search for companies, search for good promoters.
Finding the ultimate multi-bagger, that mid-cap or small-cap stock that will compound in such a way that it will light up our portfolios, that it will make all our dreams come true. Let's face it, this is a big wish for most of us investors when it comes to the stock market. But finding that ultimate mid-cap or small-cap stock that will lead you to riches, it's easier said than done. So, in today's edition of Market Cafe, I thought, let's go and meet a man who is one of the most celebrated and the most successful mid-cap and small-cap stock pickers of India. He's got over 2 decades of experience and he has so much to share. So let me go and introduce you to Pankaj Tibrewal of Ikigai Asset Manager. I can't tell you, Pankaj, how happy I am to be speaking to you in this environment. You know, this setting, thoda relax lag raha hai.
एकदम.
And the conversation, I think, demands it. We're speaking to one of the most legendary mid-cap stock pickers in India. So here he is, Pankaj, and about more than 2 decades in capital markets, right? And mid-caps and small-caps have been your forte, so to speak. But before we talk about mid-cap stock picking, Pankaj, I actually wanted to spend a minute to understand today's market. In 2025, we have seen such uncertainty on multiple fronts. Do you feel that return expectations need to be scaled down from Indian equities?
So, Surbhi, last 4-5 years post-COVID has been a dream run for equity markets in India. And obviously, in many pockets, we warned in September that there's a bubble brewing up. But let's divide the conversation into 2 parts. One is the domestic and one is the global. I think the big picture first on the global side, that the world is changing. The era of globalization, we were brought all in post the World War II. I think that's leading to deglobalization or fragmentation. And I think that's a big picture change we should not ignore.
Yeah.
Countries are becoming more inward looking. They want everything in the country. protectionism is becoming a very, very big thing.
Absolutely.
And I think that leading to some kind of a macro change globally. And to me, it's not a trade war, it's a yield war. Look at the Japanese 30-year bond yield. Look at the US 10-year bond yield at 4.5%.
So that's the thing, that in a world of very severe dislocations, I mean, who would have thought that investors will start moving out of the US?
Yes.
Who would have thought that there'll be so much of trade conflict? Who would have thought that there'll be so much of geopolitical conflict? So in this world of major shifts, where are we and where is our market? And what is the kind of market that we are probably going to be in for the next, say, 2 to 3 years?
So I think in the context of the global environment which I spoke about, which is uncertain, very volatile, I think India is an oasis in the desert. And what we have been saying that growth will pick up. And look at what happened in the fourth quarter. 7.4% GDP growth. Government capex in 1 month was 280,000 crores. What RBI has done is remarkable.
Yeah.
At least in my 2 decades, should be, I have never seen so pro-growth RBI.
Usually they're so conservative.
I mean,
yeah.
Hats off to them. The
Yeah.
system was deficit, durable liquidity, 3 lakh crores in the month of January. From there till now, they have pumped in more than 10 lakh crores. And the further CRR cut, which will start from September to October, will see another.
Hello and welcome to News Center. I'm Parikshit Luthra. US President Trump lashed out at both Israel and Iran, accusing both nations of violating the ceasefire agreement. In a stern statement, Trump even used an expletive and warned both nations. US President told Israel not to drop any bombs on Iran, saying, and I quote, "Bring your pilots home now." End of quote. Missile sirens were heard in Tel Aviv and parts of Israel. A few hours ago, Israel's defense minister accused Tehran of launching new missiles. In violation of the ceasefire, he ordered the country's defense forces to respond to Iran's violation with intense strikes in the heart of Tehran. Iran is denying Israel's claims. According to Reuters, Iranian officials have denied firing any missiles at Israel. Hopes that the ceasefire will hold is sparking a sharp drop in oil prices and a relief rally across global stock markets. Trump's announcement of an end to the 12-day war came after Iran retaliated against US strikes on its nuclear sites by attempting to attack a US military base in Qatar. Iran missiles were intercepted over the skies of Doha, and the US officials reported no casualties. Here is the US president issuing a warning to both Israel and Iran.
Israel, as soon as we made the deal, they came out and they dropped a load of bombs, the likes of which I'd never seen before. The biggest load that we've seen. I'm not happy with Israel. Basically have two countries that have been fighting so long and so hard that they don't know what the they're doing. Do you understand that?
To take this discussion forward, I'm now joined by former Indian diplomat Deepak Bhojwani. He served as our ambassador in several Latin American nations. Also on the program with us is Middle East expert Zahak Tanveer. He's also the founder of the Milli Chronicle. Thank you very much for joining us on the program today. Ambassador Bhojwani, let me begin by asking you, Trump there was extremely angry that both Israel and Iran are not listening to him. Do you feel this ceasefire that he announced is going to hold?
It seems so. It seems that both sides have accepted the ceasefire. The question is whether the timing was such that each felt that they could unleash some missiles at each other or at the other and get away with it. Iran said they were retaliating to Israel and vice versa. But I think it's quite clear that if the past days are to be believed, President Trump has the sort of influence to enforce a ceasefire. I think Iran would like to have a ceasefire, but and now it's clear Mr. Trump has told Israel that they better not drop any bombs. Unless Israel is determined to go rogue on President Trump, I think it'll hold. Well, for how long, we don't know.
Right. Zahak Tanveer, if I can get you in, do you think if Israel decides to break the terms of a ceasefire, will Donald Trump be able to rein Israel in and stop them?
Thank you, Parikshit, for having me on your show. If you look at the pattern of Israel, I don't think so that Israel has ever broken the treaty. If you look at what happened between Israel and Hamas, Israel as a state has always stick to the deals. So I believe, as of now, Iran and Israel, both of them have signed the ceasefire, but both of them are also claiming that the ceasefire has been violated. Israel is claiming that Iran is sending the ballistic missiles. At the same time, Iran is also claiming that Israel is violating the ceasefire. But Israel and the United States have been able to efficiently defang Iran as of now, but Iran as a state, the nuclear ambition is not just political ambition of Iran, it's the spiritual ambition as well. They've been waiting for the Messianic figure, and they've been doing this nuclear program for a long time, preparing for the Messianic figure. So I don't think so. As of now, Israel and United States have pushed Iran back 20 years. The 20 years of engineering and $1 trillion economy have been crippled in just 10 days. But when you speak from the perspective of the sticking to the ceasefire, I personally believe that Israel as a state will do it, but Iran won't do it.
Right. Let me go back to Ambassador Bhojwani at this point. Ambassador Bhojwani, a very important statement from the Israeli government stating that Prime Minister Benjamin Netanyahu convened the Security Cabinet and together with the Defense Minister, IDF Chief of Staff and the Director of Mossad in order to report that Israel has achieved all of the objectives of Operation Rising Lion and much more. Do you feel that Israel is now ready to stop here?
It's hard for me to say what Israel does and thinks, but it's clear that Israel's ambitions and its intentions are strategic. It wants to dominate the West Asia, starting from Iran westward, and it has already dominated a considerable part of the Arab world. The Arabs are almost silent at the genocide that is occurring in Palestine. And while they may be making some noises, they're doing nothing to prevent it or even go actively against it. The blatant illegal bombing of Tehran when negotiations were on has also been met with certain degree of hypocrisy. So Israel has achieved considerable mileage by being able to bomb and get away with it and then claim that they're honoring a ceasefire as if to say that this was not their fault and it was provoked by Iran and so on and so forth. So as far as I'm concerned, Israel has acted illegally. The US has acted illegally. They've got away with it because what we are living in today is a world where the so-called rules-based international order that the West boasts so much about, and by the West, I include Israel because it has identified with the West wholly, solely, in a de facto and a de jure way. So they're all basically acting against what they claim to be an international rules-based order, and they've got away with it. So what happens is that in Iran, which is considerably weakened, and West Asia, the Arab world, well, the part of it that is willing to stand up against Israel is also considerably weakened. So Israel has achieved a tremendous amount of gain in its strategic sense. They're also in occupation illegally, as per the world at large, as per the United Nations. You ask anyone, they have a prime minister who's been called an international criminal by the International Criminal Court, the same court that called Putin a criminal. And of course, the Great West went along with that and said Putin is now a pariah, but Netanyahu is not. The US has even so far as to sanction 4 of the ICC judges. So what we're living in is a world which has been...
All right. Let me also get in Zahak Tanveer at this point. Zahak, what do you think was the off-ramp that was offered to Iran and Israel, both, in order to have this ceasefire?
Well, as per my opinion, the off-ramp will be the economic relief, because the Iran was threatening of the closure of the Strait of Hormuz. And the Strait of Hormuz was not only the economic crippling point for the Arabs and the China or India, it was also for Iran itself. As Abdulaziz Sagar, the founder of the Gulf Research Center, recently pointed out that if Iran tries to close the Strait of Hormuz, then obviously it will be fighting back. It will be definitely hitting its own economy. So I believe this would be one of the major points of bringing Iran and Israel to the talking table, because the Arabs, especially the Saudi and the UAE, were really worried about the economic fallout of this conflict.
Right. Just last night, Ambassador Bhojwani, it was looking like all hell had broken loose in the Middle East, with Iran striking US bases in Qatar, in Iraq. There were reports from Bahrain as well. So the entire Middle East was very, very tense. This morning, we get reports that there's been no significant damage to Qatar. President Trump has spoken to the Qatari Emir. J.D. Vance has spoken to the Qatari Prime Minister. The Qatar leaders have spoken to Iranian leaders, and all is sorted out. What role do you think Qatar played in this?
I think Qatar would have considerable influence, because it has been a kind of, if not a balancer, it's been a sort of an interface between the Arab world, the Iranians, and other countries, the West particularly. What seems to have happened is that Iran, I mean, again, I'm conjecturing, I don't know. Iran seems to have attacked US assets. They perhaps had to make a show of it. And if I remember right, Mr. Trump claimed in one of his statements that they had known about this, the Iranians had told them about it. So there were no human casualties, and one missile got through. Happening was
right, Ambassador Bhojwani, we'll try and rectify your feed. Your video has frozen right now. We'll try and correct it as soon as possible. Maybe you can log in again in a short while. But let me go back to Tanveer. Tanveer, you know, the role of Qatar in all of this, do you think it was all pre-decided, with Iran informing Qatar where it's going to attack? Why is it attacking? Do you think somewhere Iran had been given this face saver and this was the off-ramp that, yeah, you can carry out these attacks and then just have a ceasefire?
Exactly. It happened. As the New York Times reported that 3 Iranian military generals already informed Qatar that there will be the U.S. attacks from the Iranian side on the U.S. base in Qatar. And this is not the first time. This is the second time. If you look back at 2020, when Qasem Soleimani was eliminated, Qatar was the one who gave bases to Donald Trump's, during his first terms. it was Qatar who gave the basis, and you would see the next day or the third day, Qatar was in Tehran consoling and giving the condolences to the Iranian supreme leader. So yeah, Qatar was already informed by the Iran that this is some kind of face saving for the Iran, because Iran has lost a lot in this war. And the second point I would definitely like to make here, as the former ambassador Bajwani was mentioning, that Arabs are silent over this. I would say that Arabs are watching silently, but yeah, the Iranian militias have unleashed a lot of hell and chaos on the Arab world in the past 20 years. You see the case of Lebanon, you see the case of Syria and Yemen and Iraq, and you see what they did in the other Arab worlds like the Bahrain. So the Arabs know what Iranian militias are up to, and if you compare the statistics of the mayhem and the bloodshed and the killings the Iranian militias have done on the Arab world and the Muslim world, you would definitely find it surprising that it's triple than what Israel has done in Palestine, in Gaza, or West Bank. So I would definitely disagree with him respectfully that the Arabs are silent, because Arabs know what Iranian regime is up to. But at the same time, the Iranian regime is also the existential threat to Israel as well. So for the past, 30 years, Iran has been threatening Israel that it will gonna be wiping off Israel off the map. So this is not how a state works.
Right. Let me go back to Ambassador Bhojwani. Ambassador Bhojwani, welcome back to the program. Going forward, do you think Israel will continue its operation against Gaza? And how long will these ceasefire violations continue? Because Iran has said that they'll agree to the ceasefire if Israel stops fighting. Israel is saying the same. How long do you think this fighting between the two sides could continue now?
It's hard to say, because Israel is an agent provocateur. With all due respect to your other guest, Mr. Tanvir, I disagree that Iran is creating havoc. It's Israel that is the occupying force. And if anybody doesn't want to believe that, well, that's up to them. And the Palestinians have been suffering not just a genocide now, they've been suffering occupation for decades. So Iran is not interested, in my opinion, in, of course, they see Israel as an illegal power. They're an illegal occupation of Arab lands. And also the US was responsible partly for the Iranian revolution, which brought in the Shah in the 50s, Mr. Mossadegh, and this is US officials, high-level officials have confirmed that it was a coup engineered by the US. So there is a history behind this. Now, as far as Iran is concerned, my belief is that Iran is considerably weakened, sure, because it has massive forces rallied against it. It just wants to continue with its life. True, it is a theocratic state. True, a lot of people don't like that. Fine, including in their own country. But there are several countries, including those supported by the West, which are under regimes which are not popular entirely among their own populations. But that's what it's all about, this world, the strategic world. Now, the point is, Iran will I don't think they will provoke any confrontation if they're left to themselves. But I think that Israel, which is an occupation of even more Syrian land than they had occupied earlier, and clearly this is illegal, no matter what anybody says. You can check your records, ask the United Nations. It is an illegal occupation of lands. So Israel is the provocation here. The Hezbollah, Hamas, the Syrians, etc., are all Arabs. They may be Shia in Lebanon, sure, but they are people living in their own country who are resisting Israel.
All right. And, you know, there are a lot of reports on social media, of course, as to how Donald Trump has done a India-Pakistan on Israel and Iran, essentially announcing a ceasefire before either of the two could do so. He went on to say that both nations came to me asking for a ceasefire. Do you think Israel was on board with what Trump was about to announce?
Who's the question addressed to?
To you, Ambassador Bhojwani.
Okay. Well, again, it's very difficult to say what was done and what was said. My impression from the reports I've read, I don't have inside information. I mean, I don't think many people do. But the fact is that Iran was in negotiations and talks with the Americans. indirect, whatever, in separate rooms or whatever. Hello? Hello?
Yes, sir. We can hear you.
Hello, can you hear me? Yeah.
Yes, sir. We can hear you.
Okay. So the basic thing is that there were talks ongoing, and I understand that Steve Witkoff and perhaps another representative of the Trump administration was also attempting to reach through to the Iranians, who had said very flatly over the past few days that if Israel continues this bombardment, there's no question of talking. I also understand that the Iranians had said that we have a right to peaceful nuclear development for power, for nuclear power. And this apparently was another issue with the Americans. Now, the fact of the matter is, and here again, I'm going out on a limb. I don't know if your viewers would like this or not. The fact of the matter is that Israel has a nuclear bomb. It is not a member of the NPT and refuses to sign it. Iran has abided by its NPT obligations, and it is a fact that it does not have a nuclear bomb. The US people even the US Director of National Intelligence said so as recently as in March. Trump doesn't want to believe that. So what he's been doing is been talking at the Iranians, not to the Iranians, in my opinion. He's been wanting to attempt a regime change, and that's led to all this.
All right. We've completely run out of time, but thank you very much, Ambassador Bhojwani and Tanveer, for joining us on the program. This is a story that we will continue tracking. It's not ended. There is a ceasefire, but both sides don't seem to be respecting it for the moment. We're taking a break here on News Center, but coming up, India and US are still working towards a trade deal, but it's looking difficult before the 9th July deadline. Why? And what happens now? We'll speak to former Indian ambassador to WTO, Anjali Prasad, on the possible concerns. Welcome back to News Center. India is keen but not desperate to sign the US trade deal before the 9 July tariff deadline. We learned from sources that negotiations are stuck on agriculture, dairy and genetically modified crops. Officials from the Commerce Ministry are set to visit the US soon for the next round of in-person negotiations. However, Finance Minister Nirmala Sitharaman has said that a deal with the US is close, adding India's effective tariff rate is far lower than what is being perceived. I'm now joined by Anjali Prasad, former Indian ambassador to the World Trade Organization. Thank you very much for joining us on the show today. Anjali Prasad, ma'am, we have been seeing how the United States is putting pressure for us to open up our agriculture sector, our dairy sector, and they also want access for genetically modified crops. Now, these are red lines for us. It seems that it's getting difficult for India to make a compromise here, and officials are now indicating that perhaps a deal may not be possible, and if that doesn't happen by the 9th of July, we will be slapped with a 26% reciprocal tariff as it stood on the 2nd of April, the day the tariffs were announced. Do you think the government is now taking a right stand by saying that let's not be desperate, no need to make further compromises, let there be further talks?
Thank you for having me on your show. I must say that the government is taking an absolutely correct position. We should stand firm on this. The agriculture sector, as I had said in an earlier show of yours, is extremely sensitive. And as you know, almost 60% of our population is dependent on agriculture and allied sectors, which includes dairy. GM crops are against human health, and therefore we should stand very firm on not allowing entry of these crops into India. And therefore I support the government in its position that we should not be arm twisted into this trade deal.
Right. What will be the impact on India, ma'am, if a 26% reciprocal tariff even comes into effect, while the average tariff before the 2nd of April was around 2.3 to 3% on the US side? If our exports are subjected to a 26% tariff, how bad will things be for India?
I want to emphasize that India is a domestic market-led economy. It is not a trade-led economy. Let's first get that very clear. Trade has been a very small percentage of our GDP all through, ever since we have recorded data, less than 2% perhaps. Now, yes, there might be some loss of exports in the immediate term. But let's not forget that there are importers on the other side as well who are importing our products. And there would be domestic pressures on the US administration by those importers as well. So I don't think we should be desperate. We should be in a hurry. We should call the bluff and wait and watch. I don't think there would be a major calamity on our exports or sectors.
Right. Ma'am, what do you think is the impact of geopolitical tensions, such as the US role and direct involvement in the Iran-Israel war? You've also seen the flip-flops of America when it comes to India and Pakistan. Donald Trump has gone on to say that he wants to have a trade deal with Pakistan, how Pakistan is a great country. He even hosted General Munir, Asim Munir of Pakistan, the Field Marshal of Pakistan, for lunch at the White House. This was a break from protocol. You're hosting an army chief. You're not hosting the head of government, but an army chief for lunch at the White House. Do you think these factors also play when it comes to negotiating a trade deal? These things may make the Indian side a little cautious.
You know, from what I have gathered, from whatever I have read of the negotiations, none of this is obviously out on the table. What is out on the table is a pure trade negotiation, which has to be in national interest and mutual interest of the two. Now, the two economies, as you know already, are highly asymmetrical. We are at best a low middle income country by per capita income. So the two economies cannot call themselves equals or negotiating on a level playing field. They are focusing mainly on our market, and that is their major interest. So we should be very, very cautious. Geopolitical factors, of course, remain in the background, but I do not think they are influencing the negotiators who are absolutely on the right track here.
Right. Thank you so much, ma'am, for joining us on the program, making important points that India should not be desperate. We should sign a deal which is only in our national interest and not offer far-reaching compromises to the US government, because we don't know how they will act on the trade deal and the promises made today in the next few months. That's all we have time for here on News Center. Thank you for watching. Goodbye.